morning, everyone. I'm Alexis Christoforous.
And I'm Brian Sozzi, and this is the first trade for Monday, December 16th.
Staying grounded, Boeing reportedly looks to cut back production even more for those troubled 737 MAX jets, and the stock is sliding in the pre-market. We've got the latest.
All over but the signatures. The White House says the trade deal with China is done, but could it actually leave America weaker than before? We'll dive in.
And a big step back. PG&E shares tumble in the pre-market as California's governor rejects a settlement deal. What this means for the future of the utility linked to deadly wildfires.
Let's check out those futures here ahead of the opening bell. Some green to kick off this week. Lots of news to digest, most specifically that trade deal from China from late last week. Dow futures up 74 points.
We'll get a full check of those markets for you in just a bit. But first to today's big story.
Boeing may be pressing pause on building those troubled 737 MAX jets. The stock is under pressure here in the pre-market after multiple reports that Boeing is considering cutting back on building its MAX jets or suspending production altogether. Editor-in-Chief Andy Serwer joins us now. Andy, this situation seems to now finally be spiraling out of control.
Yeah, I don't know. That may be a little strong, Brian, but obviously the trouble continues, and I think it's safe to say it's getting worse. There was a board meeting in Chicago over the weekend. We're still waiting to get word from that official word, that is, but it does look like the company is going to further ratchet down the production of this jet. They already did that previously, reducing the number of planes they're making, which are actually just going into storage right now. They're not actually being taken for delivery by the companies. But it's another big blow for the company, no doubt.
And the FAA now says there are a dozen milestones that must be completed before they get these jets back in the air. They're looking at possibly having them return in March, maybe April. What does that do to Boeing's bottom line? I mean, they have outstanding orders for some of these jets.
Well, you can tell that by what's going on in the market. You mentioned the pre-market trading in Boeing is very weak. The stock is down about 13%. You can see here over the past 12 months, the stock is down 8%, while the market, of course, is up over 20%. So Boeing shareholders really suffering. And I think, Alexis, to your point, though, the relationship between the FAA and the signature aircraft manufacturer has deteriorated. Now, some might say it was too cozy to begin with, but right now these two entities, the FAA and Boeing, are at loggerheads, no doubt.
And there could be a pretty big ripple effect here. Just consider the Boeing supply chain.
Yeah, over 200 companies directly supply Boeing, Brian, and obviously this is a huge deal for the U.S. economy. I mean, that's how big this company is, and then there's thousands of other companies feeding into those 200. And then, of course, what does it do in terms of Airbus and its competitive perspective as well? And then all the airline companies like American, United, Southwest, and American in particular are two that are connected to this plane.
Yeah, you mentioned American. They're actually extending their cancellations for this jet until at least April 6th. I guess the question is, even if and when they get these jets back in the air, will airlines want to fly them, and will us passengers want to be on them? That's the other big hurdle for Boeing.
It is, and I know, Alexis, people who, when they fly, check those cards they never did before.
Right.
What plane are we on?
Right.
Is it a Boeing plane? Is it an Airbus plane? If it's a Boeing plane, is it a 737? And so that kind of scrutiny from passengers is something that, a company, an airline company, is loath to have. And so what does that do to Boeing's competitive position sort of over the longer haul? I mean, it's clearly not good. And, this is a company that has this long history, a proud history. They make great products, but this particular plane is definitely under scrutiny.
Might be time to call in Warren Buffett out there at Berkshire.
Yeah, and that speaks to, the CEO, how strong and secure is his
Are you
tenure.
surprised that Muhlenberg survives, Dennis Muhlenberg, as CEO? I mean, he went before Congress. Now he's got more problems with this jet.
Well, at some point, I think he's going to end up being a casualty here. I mean, just because the thing's extending so long. So
right.
At some point, his tenure's going to be up anyway, Alexis.
All right, Andy Serwer, thanks so much.
Thank you.
Time now to head down to the New York Stock Exchange and check in with Yahoo Finance's Scott Gamm, who has his eye on what is moving there before the bell. Scott, good morning.
Good morning, Alexis. We've got stock futures up today. The market looks like it wants to build on Friday's gain when we heard that the U.S. and China had reached a trade deal. So you got this halo effect going on this Monday. In terms of specific names, take a look at PG&E shares, the stock tanking in pre-market trading, down over 20% after California's governor really rejecting some of these restructuring plans going on, saying that they don't meet the standards of regulators. Now, even with this this decline, the stock is set to open below $10 a share. That is significant. And then also some merger news to tell you about. International Fragrances and Flavors is merging with DuPont's nutrition unit, creating a $45 billion consumer giant. We've got IFF shares down in pre-market trading. DuPont shares are up. And then finally, Micron shares getting a pop in pre-market trading. This after scoring an upgrade from Susquehanna Research, basically saying that industry dynamics are improving for the company. The stock, by the way, is up more than 60% so far in 2019, guys.
Scott, I thought this was the afternoon seeing you down there so early.
Hey, we're here all day.
All right, Scott Gamble, talk to you soon. Coming up here on the first trade deal done. We'll look into the phase one trade deal with China and why the markets are so optimistic. Let's take a look at European markets right now. European markets, some green over there as well. The FTSE 100 up about 185 points. The CAC 40 and DAX also in the green. Yahoo Finance's Tom Belger joins us now from London. Tom, Britain's Prime Minister Boris Johnson is welcoming his new MPs to Westminster after his landslide election victory last week. What's the latest with Brexit?
Well, we could see this week, as early as this week, the vote on the Brexit deal. The government's been tight-lipped about when exactly the crucial vote will be, but Britain's new MPs will be sworn in this Tuesday and Wednesday, many new Conservative MPs in Parliament, and then the government has to set out its agenda in Parliament in something called the Queen's Speech as early as Thursday, so we could then see MPs vote potentially Thursday, Friday at the very earliest. Johnson's massive majority, though, means all the expectations are this Brexit deal will cruise through Parliament, and that would bring to an end almost a year of unprecedented political deadlock at Westminster, which saw MPs block both Boris Johnson and his predecessor Theresa May's Brexit withdrawal deals. Britain would then be on track to leave on the 31st of January. It's worth just saying quickly, some news out today cast a bit of a shadow over Boris Johnson's victory celebrations. We've got the latest flash estimates for PMI in the UK in December, hitting a 3.5-year low. But it doesn't seem to have dented stocks. You can see the FTSE 250, still doing pretty well despite those figures today.
All right, Tom, there is news, believe it or not, outside of Brexit. There's a big deal between London-based Cineworld and Canada's Cineplex chain. What are the details there?
Yeah, well, Cineworld's announced a $2.1 billion deal for Cineplex. This would add 1,700 screens to the Cineworld empire, making it the largest in North America by the number of screens. That's pretty remarkable. Seems to be part of a trend towards consolidation in this sector, partly to fend off the threat from some streaming services.
All right, Tom Belger for us in London. Thank you. The top trade negotiator for the U.S., Robert Lighthizer, is praising the phase one trade deal with China. That's expected to nearly double U.S. exports to China in the next 2 years. Here's what he told CBS yesterday.
This is done. This is something that happens in every agreement. There's a translation period. There are some scrubs. This is totally done, absolutely.
All right, here to break this down with us is Roger Baker, Senior Vice President of Strategic Analysis at Stratfor, and Cesar Rojas, economist at Citi Global. Thank you both for joining us this morning. Cesar, I'm going to start with you. Do you believe Lighthizer? Is it a done deal, or what are the chances we get an escalation yet in these trade tensions?
Great. It's a great question because so far the details have not been announced, so we're still light on the details. And also we're still light on whether there's going to be a signing ceremony in January. The most important thing is how this deal is going to be enforced. Whether there is going to be a potential snapback of tariffs if one party does not comply or not. So to that extent, the uncertainty that is around the deal is still making that we're not there yet.
Roger, has anything really been accomplished with this Phase 1 deal? You know, I was talking to a couple people in the markets, involved in the markets, and this deal has been largely poo-pooed.
Yeah, we're not seeing a whole lot that's been done other than a temporary hold on escalation in the trade competition between the United States and China. Certainly, we don't get another round of tariffs added, at least in the near term. We get some minor rollbacks of a part of the tariffs that are already in place. So this is more of a lull. There's a lot of structural components between the United States and China that are simply not addressed at all in this deal.
You know, there's also, Roger, this is for you. Economist Stephen Moore said that last week was President Trump's best week in office. He brokered the new NAFTA deal, if you will, the USMCA. He also got some concessions from China. Would you agree? Is that a milestone for President Trump's presidency?
I mean, I guess from a perceptional point of view and from the way in which the administration wants to shape itself as fixing or solving or making new deals, other people could argue that these deals would not even be issues for the president to sign off or make agreements on had they not altered NAFTA to begin with, had they not started the trade war with China. So I think that's a political question much more than it is one that goes into the economics or the structure of trade.
Cesar, does the deal make you more excited about the U.S. economic potential in 2020?
What we continue to believe is that as long as these trade deals start to reduce the uncertainty that has been clouding on the global outlook, we could continue to see a very strong U.S. economy. So far, these headwinds from the international outlook have not been that strong on the U.S. We are seeing now that there is a rebounding in the global manufacturing. If these uncertainties that are fading continue to do so, we could see a global upturn that could eventually help the U.S. as well.
Did you mark up your U.S. GDP estimate?
So far, we're still expecting that we're above consensus on U.S. GDP growth. We expect 2% next year, consensus around 1.5, 1.7. And the main reason is that beyond these idiosyncratic factors from the U.S.-China trade war, we're seeing a rebound in some residential investment. We're seeing a rebound in investment that has been delayed. So to the extent that these positive headlines continue to strengthen this business sentiment, we could see a potential upturn as well for the U.S.
You know, Roger, if you look, we are light on details with this trade deal, but one thing it seems to be is agriculture focused. Is this good news for our farmers? Because some of them are speaking out against this deal, saying it doesn't nearly do enough to move the needle for them.
I think it might be good news for some. The problem with making these giant bets on agriculture and basically government-demanded purchases on agriculture is that they can be promised or not promised, but you've got to decide on your planting cycles. You've got to look at all of those aspects. So it's not necessarily going to give them that confidence or the continuity that they need. And it's something that we're not sure what the timing of the Chinese purchases will be and how the Chinese are going to play when and if they do. And then there's going to be the secondary implication that we'll need to take a peek at, not just in the United States, but if China just shifts to some large purchases from the United States, what does that do to places like Brazil, Argentina that may be counting on sales to China?
And Roger, as for the USMCA, now Mexico looks like it's coming. Somebody from Mexico is going to come over here to Washington to talk about new language in that deal that says that U.S. labor inspectors should go over to Mexico and make sure that their reforms are in place. Is that a deal breaker? What does that mean for the deal?
Well, I think it could be certainly a challenging factor, but I think right now there is some momentum from this administration to be able to just showcase that it is successful in some of these deals, even if some of the underlying components still need to be worked out.
All right, we'll leave it there, guys. Roger Baker, Cesar Rojas, good to see you.
Thank you.
Coming up here on the first trade, backing down. The Hallmark Channel changes course on an ad after a major backlash. We've got your news bites coming up next. Let's take a look at today's news bites. As the House gears up to vote on impeaching President Trump, Senate Democrats are laying out their plans for a trial. Senate Minority Leader Chuck Schumer wants the trial to begin just after the new year, with witnesses including acting White House Chief of Staff Mick Mulvaney. Majority Leader Mitch McConnell met with White House officials last week and has so far signaled he wants a quick trial. After a tense and dangerous year in Hong Kong, Chinese President Xi Jinping has reiterated his support for its leader, Carrie Lam. They met today in Beijing, where Xi praised the chief executive for her courage and holding fast to the, quote, one country, two systems principle. Lam has faced harsh criticism for how she's handled months of anti-government protests. Delegates from more than 200 countries have left the United Nations Annual Climate Summit in Madrid without meeting certain goals originally set by the 2015 Paris Climate Agreement. After 2 weeks of negotiations, the delegates failed to strengthen the targets for cutting emissions or to create a carbon trading system. And Hallmark Channel is putting ads featuring same-sex marriages back on the air. The cable network apologized for pulling the ads from the site Zola.com. It showed two brides kissing. Hallmark Channel now says pulling the ads was the wrong decision. The conservative group 1 Million Moms had objected to the commercial. Coming up on the first trade, it's not just Facebook looking to capitalize on your personal data. We dig into another popular site that's big in the business world. Don't go away.
It's not very often that you get to look behind the headlines, especially in the world of business news. But a site called Talking Biz News may give us an interesting view on how news gathering is changing. Editor-in-Chief Andy Serwer has been looking into the site and is back with us now. Andy, we all know this site, and you really dug into the site and what's going on and what's happening with the brand.
Yeah, I mean, Talking Biz News is obviously not a world beater. It is just something that covers, a website that covers basically the comings and goings of business journalists. And that's fine as far as it goes, but it turns out that this site has been sold. It was run by a University of North Carolina journalism professor who is now at Quinnipiac in Hamden, Connecticut. And he sold the site to a company called Quoted, which is controlled and run by two PR firms. And you can't tell that by looking at the site.
Stop right there, because I hear journalism site owned by a business site, owned by two PR firms. I hear possibly inherent conflicts there. Is that what you're finding?
Yeah, I mean, I think that's safe to say. And, you know, as I said, they didn't disclose, they don't disclose on the site at all that they own this Talking Biz News site. And then when they bought Talking Biz News, they didn't put out a press release and say we bought it. And they said, well, it's not that big a deal. Why should we put out a press release on it? But I think there are potential conflicts of interest. For instance, if you look at the client lists of the two PR firms, Alexis, it's a whole manner of financial services companies, and you can see what kind of conflicts of interest there may be there. But there's even more to it than that, because Quoted is a company that connects journalists to PR firms and experts, and if you sign up for that, you can sign up for free, but then you're connected to these PR firms, and you know, if something's free, you're the product, and that's what's going on here.
How do you think they can look to make money off of this business that they purchased from that veteran journalist that had owned the site?
Well, that's what's interesting as well, Brian, because if you use Talking Biz News, your information can be updated into this Quoted website. Yep. And the Quoted website, which owns Talking Biz News again, is a freemium site. So journalists use it for free, but companies pay, and they pay for the data, and they pay for the listings, which include the journalists' bios and information about journalists as well. Oftentimes you're signing up knowing that, but if you're just on Talking Biz News, it seems that your information is ported over without you knowing it. And of course, if you look at the terms of service at Quoted, your data can be used and sold in various ways that you might not be aware of.
Yeah, even one of our reporters, right, here had their information shared, and they weren't aware of that.
They weren't aware. And the other thing is, when you put these queries out, supposedly they were private and confidential because you didn't want other journalists to know what you're doing. But then Quoted was tweeting out the queries so that any other journalist might see it as well. So it's a little bit of an uncertain environment there, I think.
Sticky is what I'm going to call it.
Yep. Yeah.
Andy Serwer, thanks for looking into that. Interesting stuff.
Thank you. The opening bell is coming up here next on The First Trade. Here's a look at the action in overseas markets. We'll be right back.
Welcome back to the first trade. We're about 4 minutes away from the opening bell. Stock futures are higher across the board. Look at the NASDAQ, up better than 0.5% right now. Let's go around the bell with Keith Bliss. He is CEO of IQ Capital, and Tom Essay, founder of the Sevens Report, along with Yahoo Finance's Jared Blickery over at the Wi-Fi Interactive Board. Welcome to a new trading week, everybody. Keith, I'm going to start with you. What are you keeping your eye on this week? Of course, trade continuing to be front and center. What are you focused on?
Trade data, some economic data that we got coming at us this week, and also just kind of seeing how the year kind of meanders out here. The markets have been really quiet despite the melt up that we're already starting to see. You know, Bank of America Merrill Lynch came out with a report over the weekend that said that we're poised for a melt up in the markets in the first quarter. And what that basically means is that you may get some sharp moves, but the trend overall will be higher. And I think we'll see that going into the end of December as well, and set us up well for 2020.
What does a melt up look like?
Well, melt up looks like, despite you experience cognitive dissonance at times during the day. You might have some bad economic data, or you might have some political theater and shenanigans going on in Washington, D.C., but the market just continues to trade higher. And I think we've seen that a lot in 2019. I mean, if you look, the economic data has been excellent here in the United States, as we know, with a few minor blips here or there, not so great around the world, although it appears that we're bottoming out, but yet the market just continues to grind higher, grind higher, grind higher.
Tom, we had some trade experts on earlier, and they were saying that even though the U.S. is saying that we have a deal with China, there could still be an escalation in trade tensions. If that were to happen, would that sort of interrupt any melt up in the market early next year?
Yes, I think so. I think the situation is still generally unsettled with Europe, and on a trade basis. We keep every 3 months or every 3 weeks, we keep getting sort of another threat. None of that has come to fruition, but it remains possible. Meanwhile, the U.S.-China trade deal, I mean, it's great. You know, yay, we have one, but it doesn't really say anything too specific. Hopefully it gets signed in January, but even when it gets signed, it's unclear at that point what they're signing and how quickly that will actually begin to translate to better growth and to a reduction in trade concerns. I think the market is kind of on autopilot into the end of the year right now, barring any major surprises. But part of me thinks that at the beginning of 2020, people will look around and be like, wow, we're really at a high valuation. Exactly what have we priced into this market?
Tom, speaking of autopilot, Boeing shares are under a lot of pressure in the pre-market. Not good news from them. What appears to be bad news from them coming later today. What do you do with that stock here?
Yeah, I think you wait. If you own it and you don't love it, you may want to step out of the way a little bit, because I think that we probably see a little bit more to go on Boeing. Will Boeing be a great long-term buy at some point? Absolutely. They will make it out of this 737 mess. They will do the right thing. They will get production ramped up. The plane will get back into service. And 10 years from now, people who buy Boeing, after it comes in a little bit, will be very happy. But for now, look, there was a disconnect between when people thought this production would start again and the plane would start flying, and now we're seeing that realized in the share price. I'd stay out of the way in the short term.
What about you, Keith? Staying out of the way of Boeing?
Yeah, I think that's sound advice right now. And also what I would do is look underneath Boeing. Remember, Boeing puts out the finished product, but you've got all kinds of manufacturers and other suppliers, some of them public, some of them private, but the biggest supplier of fuselages, for example, to Boeing is called Spirit Aerospace. And there's reports that they now have backlog of 50, 75 fuselages that are just kind of sitting on the factory floor waiting. So I think that's one of the bigger risks with Boeing, not necessarily just their stock price, but also how it translates back down through the supply chain with some of those companies. Now, Boeing is not like the housing market. You know, they offer the nexus of a lot of manufacturing and other economic activity, so it'll be muted in its impact, but it is something to keep in mind. But to your first question, yes, I'd stay away from Boeing right now.
All right, here we have the opening bell with Clifford, the big red dog, over at the NASDAQ, and Scholastic Botox over at the NYSE.
That's quite the pair.
That is quite the pairing. All right, we're just going to leave that one alone. But we're starting the day in the green here with the Dow up 89 points. Hey, Tom, China today got some good data out of them. Industrial output, retail sales, both higher. Who really has the leverage here? I mean, if these numbers are to be believed coming out of China, can they wait and get the best deal possible for themselves?
No, I don't think so. I think the U.S. still very much has the upper hand. I think China targeted 6% annual growth for 2020 at the recent economic planning session. That's, so far under what we're used to seeing from them. There's no question the Chinese economy is facing significant headwinds, and they're structural headwinds is the thing. They're trying to execute a large-scale economic transformation. That slows growth and takes time, and it very often comes with bumps in the road. So I think the U.S. still has much the stronger hand. Whether or not we have the political will to see it through, I think, is the much bigger question.
Tom, I'm sure you're watching the retailers here. The holiday season is coming to a close, but a lot of these stocks, the trading action is pretty ugly. Macy's, Kohl's have seen some big declines over the past few weeks. What do you make of the action? Are we seeing a disappointing holiday season?
No, I don't think we are. I think that really what people have to continue to remind themselves of is that there's a big disconnect between retail stocks and consumer activity. Look, 10, 15 years ago, they were all the same thing, right? But we all know the world has changed, and you get these legacy big box stores, and they're grinding. They're still trying to figure out how to survive and how to grow in this new economy. So I think consumer spending overall is doing very well. I know we had a mildly disappointing retail sales number on Friday. Had to do with probably a shorter month than anything else. The economy is good, unemployment is low, and wages are on the rise. That means consumer spending is going to be just fine. I think retail broadly will continue to face headwinds. You've got to pick your stocks, though.
All right, Jared, the NASDAQ here in the early going up about 0.75%. What's leading that advance this Monday?
Yeah, we have chip stocks outperforming right now. We can see Micron is up 3.5%, AMD is up over 2%, along with Applied Material and Lam Research. The big cap stocks largely in the green, nicely as well. Apple's up nearly 1%, Microsoft up a third, along with Alphabet. All three of those stocks at or near record highs right now, and Facebook finally getting back on track after a two-day slide. It's up about 2/3%. Looking at the sectors that are leading today, we have energy with crude oil fairly strong overnight, tech, healthcare, financials, materials, all outperforming. To the downside, we got real estate, which has been getting smoked recently, along with industrial, still in the green, but underperforming thanks to Boeing.
Keith, later this week we'll have the latest presidential debate on the Democratic side, obviously. When does the market start to care about the election?
What's the election date?
Fair enough.
That's when the market will probably start to care. Listen, I think that if you talk to most people, most practitioners in the market, like me, who look at trends, look at history, look at presidential cycles, I've said it before on this air, there will be a massive trade deal, not just a phase one, phase two done before Election Day. If the economy continues to expand, if the market continues to expand, it's going to be very hard for any Democratic challenger to defeat President Trump in the general election. I think that's what the market's really paying attention to. As long as the economic data keeps trending positively, both here and now, if Europe and China are bottoming out, then that's going to be, a rising tide lifts all boats, so to speak. I think it's going to be hard, and I don't think the market's going to really care about the debate.
When you say massive trade deal, what do you mean by that?
Well, they've already started phase one. I think they've still got, like we've been talking about, like you've been talking about on your air, they've still got some work yet to do, right? They're managing the market a little bit, right? They're dribbling it out. They get through the first phase where they're talking about agricultural products being spent, and then it'll be really about technology transfer and IP protection, those sorts of things. So I think they've got a lot more work to do. My suspicion is certainly by the beginning of summer we'll have everything buttoned up with China.
Wow.
We heard Jared talk about semiconductor stocks leading the advance today for the NASDAQ. Do you think there's more upward potential there if this deal with China, as Keith seems to think, is really going to happen, perhaps in a big way, come summertime?
Absolutely. Yeah. And in fact, that's one of the sectors that should do the best. There was a time when steel was really, the steel sector was the underlying indicator of the economy. Well, we're in a new economy now. I think semiconductors are almost the new steel, in so much as they are a gauge of global growth, because everything that powers growth needs a semiconductor nowadays. And so I think that sector can continue to rally, even though valuations are stretched, even there's a little bit of concern about supply demand in that specific market. If we get a trade deal, a bigger trade deal than what we currently have, yes, I think semis can continue to outperform.
Jared, yeah, semis absolutely still rocking. We'll get those Micron earnings later this week. But you know what also is rocking? commodities. You also have a copper rally doing pretty well. You have oil starting to catch a bid too.
Yes, we do. Crude oil now holding above 60. That had been prior resistance, really 58, 59. And if we look at a longer term chart, we can really see this. And as you mentioned, copper too, really bouncing back. It was up 6 of the last 7 days, something like this. This is WTI crude futures going back 1 year. We can see it's largely been in this trading range. We did have this brief spike on the Aramco attack in September, but largely just trading in this range. Now, we had broken above before earlier in the year, and then we got the trade conflict ramping up because of President Trump and whatnot, and we saw it decline. But we might be in a space where we can see 60 to 65 as a new trading range for crude oil. Depends. It's at the top of a trading band right here. Could sell off a little bit to the lower side, but I'd say 55, 56 is pretty good support right now.
Sticking with oil, Keith, I know you were watching the Saudi Aramco IPO.
Yeah.
We had been talking about it when you were here prior. Finally went public. What's your take?
Well, it's clear. I think it's indicative of where they went public. You know, I think there was a lot of institutional investors I know, both here in the United States and around Europe, that are really starting to push back on that valuation.
That $2 trillion.
Yeah, I mean, listen, there's still concerns about the political environment around MBS, what's going on over there with regard to human rights and press rights and freedom of the press, and there's still some concern about how much oil does Aramco and Saudi Arabia still have in the ground that they can actually get out. So there's the political drama that goes on over there. There's questions about the stability of the country really longer term from some institutional investors. And then there's also questions about the actual value of the commodity with which they produce. So that's why I think they got a lot of pushback, and they were going to keep getting delayed whether it was going to happen in New York, London, or Hong Kong. So that's why they went public on their own exchange.
Yeah.
Everything we're seeing with Aramco and the questions regarding their business, doesn't that make one, or shouldn't that make one appreciate Exxon a little bit more? With a higher dividend, more of a well-run business?
Yeah, I think so. You know, when you get the oil majors, the fully integrated guys like Exxon or Chevron or one of those, and then even some of the midstream players that are playing down in the Eagle Ford or Permian Basin, those are true, authentic businesses with lots of transparency and visibility in there. And yes, I mean, listen, I've always been a big believer that we should be moving and migrating towards alternative sources of energy. We will have to power the world going forward, but we're not getting rid of crude oil for the next 100 years. So you really look for a good company like an ExxonMobil to invest in, as opposed to maybe an Aramco.
Tom, we've got about 2 weeks left to 2019. What are you looking at here in these next 2 weeks in terms of if somebody wants to get into the market here late stage?
Yeah, I think that we're going to see a continuation, barring any surprises, especially on trade. We're going to see a continuation of the past few weeks, which is cyclicals outperforming. This market is on a bit of autopilot, I think, into year end. There are no major events now that trade is done that can really upset the apple cart. Lost in all the trade drama last week was a pretty dovish Fed message that basically the Fed said, look, we're here for you. We're not even thinking about raising rates anytime soon. So I think you go cyclical. You can look at financials as well into year end. Then I think everybody kind of picks their head back up, looks around and says, okay, where are we on valuation? What are the future growth prospects? And is the risk reward appropriate at these levels?
Welcome to the Market Melt-Up, folks. Tom Essay, good to see you. Keith Bliss, always good to see you. And Jared Blickery, thank you. Coming up here on the first trade, just do it. Nike's earnings are due out later this week, but could the trade war with China run over its bottom line? That's next.
All right, we're a few minutes into the trading day. Let's see what's moving the markets here at the open. Yahoo Finance's Scott Gamm has his eye on it all down at the New York Stock Exchange. Hey, Scott.
Hey there, Alexis. Well, we've got a trifecta of record highs right now. All three major stock indices opening at records. So we'll be watching to see if they can close at records. But nonetheless, we're keeping an eye on shares of Boeing right now, down over 3% on this Wall Street Journal report, suggesting that the company is weighing either suspending or cutting back production of the still grounded 737 MAX jet. Now, if you look at Boeing stock, at least over the past 6 months or so, the level right now is approaching its recent low back in mid-August, which was at about $320 a share. By the way, that mid-August level was the low for the stock since the most recent 737 MAX crash, which took place in March. So that's just something to keep in mind as we watch the fallout from this story. Even with the decline today in Boeing, the stock is still in the green for 2019. A lot of folks might find that hard to believe. Another Dow component we're keeping an eye on today, Disney. The stock is up slightly. We know it's been on a tear over the past month or so amid a successful unveiling of Disney Plus. That's its streaming service. Well, today we hear that Disney will be launching its Disney Plus service in France in a partnership with Vivendi's Canal Plus platform. And then one more stock we're keeping an eye on, Urban Outfitters. It's down this morning after getting a downgrade from Loop Capital. They are worried about promotional activity. That's just code for lower prices, guys.
Scott Gamm, thank you. We also have our eyes on Nike. It's set to report its latest earnings later this week. The stock has been on tear so far this year, up more than 30%, but it could be facing more pressure from competitors, namely Adidas. Here to give us a preview of what to expect is UBS retail analyst Jay Soul. Jay, always good to see you. Can Nike be stopped? I was looking at Twitter over the weekend. They dropped the Air Jordan 11 bread lines around the store. What stops this company in 2020, if anything?
Well, Brent, I think you're making a good point with the demand for cool styles like that, the one you just mentioned. But no, not much can stop Nike. I don't think Adidas can stop Nike. I think that, barring just a change in the macro economy, really Nike's innovation and their digital connectivity with consumers has been great, and that's the keys to success.
Is Under Armour even in the discussion here?
Well, Under Armour's in a transition. They need to improve their supply chain. They need to re-elevate their brand, and they're really not that strong in footwear right now, and that's where really Nike obviously is really strong. So Under Armour's not really a threat.
I'd love to get your take on the whole swoosh controversy in the MLB, right? Baseball fans up in arms. Now the swoosh is going to be prominently displayed on the front of MLB jerseys starting in 2020. Is the backlash going to hurt them at all? Or is this just free press for Nike?
I don't think so. I was watching an NBA game over the weekend, and I noticed that, every NBA team has the little corporate logo on the shoulders. Nobody's talking about that anymore. At the time, it was the same kind of thing. Oh, you're ruining the jersey and the look of it, and I don't hear any talk about it anymore. You barely notice it. I think it's going to be the same thing with Nike. People will get over it.
Nike will enter 2020 with a new CEO, John Donahoe. Have you met with him? What have you heard about what changes he might make to the company?
Well, I haven't met with him, but I think that one reason he is the CEO is that he's been very involved in making the strategy since he joined the board, in 2014. And so I think what it says is that he's very much a digital person, global growth, focused on e-commerce, and that's exactly where Nike's going. They made the announcement they don't want to partner with Amazon anymore, or the news came out they don't want to do that. So they have a big plan to really connect directly with consumers and sell things directly through their own channels, and that's what he's there to do.
And is athleisure still a thing, and is it a big thing for Nike? Because we know really at the end of the day, they're all about sneakers.
Yeah. Athleisure is a huge thing, Alexis. People want to be comfortable. They want to be casual. We see it in all parts of the world. We're seeing sportswear, which is sort of, basically athleisure.
Streetwear,
Streetwear taking share in every major geography. So, streetwear is here to stay, and it's still working.
We'd love to get your thoughts more broadly on the holiday season. You're in the stores, you're talking to people and contacts. To me, it seems more promotional.
Well, Brian, you're right. It has been more promotional. And I think that if we think about the broader economy is really good. But we focus on the mall and specialty retailers. And I think the point was made on your last segment that there's a lot of disruption happening in retail. And so the regular, traditional brick and mortar retailers are having trouble adapting. And it's, the winners are Amazon and companies like that. And, it's a struggle for some of the ones that we're more familiar with.
What about Adidas in the new year for Nike? How much do they need to worry about them? What can Nike do to continue to resonate with the shopper?
Well, really, what Nike's all about is making sure they have great product and they have the coolest athletes in the world representing their product and wearing their product on the court. And that gets kids all over the world and people who look up and admire cool athletes and cool celebrities to want to buy the product. And really, Nike and Adidas are both trying to do the same thing. And their job isn't so much to compete with each other. It's to sort of compete with everything else that people are going to spend their discretionary dollar on, whether it's movies or books or entertainment. That's who Nike and Adidas are competing with. And that's why you've seen 40 years of consecutive growth for Nike and Adidas over time.
You have a neutral on the stock right now.
I do, and that's really about valuation. If I was just rating a company,
Okay.
Nike would be a buy. But look, at a peak multiple here, everybody's excited about the quarter. Everybody thinks there's upside to numbers, and that's our view too. But when there's no difference between our view and the stock's view, we tend to have a neutral rating.
All right, makes sense. Jay Soul, thanks for stopping by.
Alexis, thanks so much.
All right, oil is holding steady near a 3-month high on optimism over a U.S.-China trade deal. We've got Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board with our commodities report. So how will this affect oil going forward, Jared?
Well, this should be good for the price of crude oil. We see it holding just above $60 a barrel here, which had been previous resistance. Not a lot of action overnight, relatively quiet. But if we look and see what happened Friday, we did get a nice boost on the trade growth, not concerns, but actually kind of a relief rally, if you could call it that. This is what's happened over the last year. Now, we can see that $60 a barrel has been resistance, and it is just above it right now. To the downside, 50, 51, 52, that has been support. If crude oil can break above $60 a barrel like it did in here, this was before the trade war really reignited in May, it could get to $60, $65 a barrel. That could become a new trading range. We'll have to see.
Jared, I know obviously you're also watching Aramco. Jefferies dropped the hammer, initiated coverage at underperform this morning.
Yeah, it's all about valuation. So right now it's about a $2 trillion company. Good for them, but their dividend yield is about 3.8%. And Jefferies is saying that if they want that dividend yield to come back up to entice investors, they're going to have to get down to a $1.6 trillion valuation. If you think about that, that's just erasing $400 billion of shareholder capital. It might not trade that low for some time, but we have tremendous supply coming on next year, especially in the second half. So we'll have to keep watching that.
All right, Jared Blickery on the Saudi Aramco beat. We'll talk to you soon. Coming up here on The First Trade, winning the game at the box office. The big weekend for The Rock's latest Jumanji movie and what that means for Disney's Frozen 2.
Here's another look at how markets are starting the week on Wall Street. Up arrows, big rally for the Dow, up 149 points, thanks to that trade deal with China. We'll be right back with companies to watch. Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. DuPont's Nutrition Biosciences unit will merge with International Flavors Fragrances. The deal will create a new consumer giant worth more than $45 billion. The boards of both companies unanimously approved the merger, and as part of that deal, DuPont will also receive a one-time cash payment of $7.3 billion. PG&E is scrambling to rework its bankruptcy restructuring plan after California Governor Gavin Newsom rejected the deal. Newsom said the company's proposal falls woefully short of California's safety requirements. He's demanding that the utility make big changes if it wants access to funds that will help it pay wildfire claims. That includes a $13.5 billion settlement with wildfire victims. And Uber Eats India may be feeding its competition. Uber is reportedly in talks to sell its food delivery business in India to its local competitor, Zomato. The deal reportedly would be valued at about $400 million and would allow Uber to invest between $150 to $200 million in Zomato. TechCrunch says that deal could be announced as early as this week. And Amazon may be facing a strike during its busiest season. The German Verdi Union is proposing a strike at Amazon warehouses in that country. They are demanding better pay and working conditions for Amazon employees there. Unions have been staging strikes against Amazon in Germany since 2013 in hopes of forcing it to recognize collective bargaining agreements. And Jumanji, The Next Level, soared at the box office this weekend, taking in over $60 million in the U.S. and Canada and knocking Disney's Frozen 2 from the top spot. The Sony film, starring Dwayne Johnson and Kevin Hart, is the third installment in the Jumanji franchise. Now, despite getting bumped from number one, Frozen 2 still passed the $1 billion mark worldwide at the box office. And coming up here on The First Trade, why you're seeing so many new flavors of Coke and other products filling the shelves at your local supermarket. We go inside the grocery wars next. You may notice that you're seeing more and more interesting new products on the shelves of your local supermarkets lately. Brian, I know you and Heidi Chung took a closer look at what's causing this product overload madness. And it has to do with something called SKUs, SKUs. First off, just tell us what those are.
Take it away, Heidi.
So those are stock keeping units. That's where we get the SKU from. And those are what retailers use to sort of manage their inventory, but also identify products. So the numbers that you see on the barcode, when you scan that, each product and each variation of the product has their own specific SKU. So let's think about Coke, for example, right? A classic can of Coke has its own SKU, but Diet Coke will have its own SKU number. And then if you have different sizes or different flavors, they all have separate numbers. So as you can imagine, crazy amount of SKUs when you go to a grocery store or retailer. But yeah, so we wanted to look more deeply into why these companies are expanding or contracting certain SKU counts.
I think it boils down to data. We talked to executives at Hershey, Gatorade, which was just here, releasing a new SKU or telling us about caffeinated Gatorade. That is a perfect example of a new SKU. Ultimately, they're using data to anticipate consumers' needs. They have a lot of these big name food companies have data at their disposal like never before. So a product like caffeinated Gatorade fits the new need of a person who's working out that wants a caffeine jolt. That would be someone like myself.
But also, why does this all matter? Well, the consumer is such a big part of our economy, right? 2/3 of our economy to be exact. But the consumer is also so very fickle. So their tastes are changing constantly. Some people 10 years ago didn't want any sugar. So then Coke had to come out with zero sugar. They had to come out with lower sugar. And all those different variations eventually started taking over the grocery store aisles. Now, Overall SKU counts, surprisingly enough, though, have contracted a bit when we take a look at the 3-year average. But within specific categories, we're seeing expansion and proliferation as opposed to other categories. Now, I want to go over some of those categories with you because it's so interesting. It kind of speaks to the consumer trends that we are seeing. Contraction, though, let's start first with candy. Chocolate candy seeing a bit of contraction in the aisle, so fewer SKU counts there, as well as carbonated beverages, bottled juices, cold cereal, milk, and ice cream. On the flip side, where are we seeing the expansion? Well, beer, alcohol, cider, and liquor. Skincare, which kind of fits the trend, right? We're seeing so many people come out with new skincare products, bottled water, bacon, pet food.
Because why not bacon? Because why not bacon?
Exactly. And so those are the kinds of areas where we're seeing expansion and contraction.
But what about the cost to these companies to come up with a product that can be so niche, it really doesn't pay for them to make it and sell it?
It's funny you mentioned that. And I think the perfect example is Gatorade. For them, as long as they dominate that part of the shelf and they crowd out the likes of Powerade and whatever other upstart brand is coming, for them it's good. You may not buy a full-calorie, old-school Gatorade, but you might buy the new one with caffeine, and for them, that's still a win.
So they are adding SKUs, but they're also expiring certain products that just aren't really performing as well as they would anticipate. We spoke to a couple different companies that compile these data for these different retailers, and they told us, well, think about it. Bleach, you don't need very many flavors of bleach. But on the flip side, when we just heard
I don't want any flavors of bleach.
Yeah, I was going to say, not to ingest that whenever possible.
Different scents of bleach, excuse me. But also when we think about Coca-Cola, their most recent earnings report, they told us that their skinny cans outperformed by a super wide margin compared to the regular one. So it's paying off.
I'm excited about caffeinated Gatorade.
Interesting.
I'm pumped.
Interesting stuff, guys. Thanks for looking into the SKUs. All right, that's going to do it for the first trade for this morning. I'm Alexis Christoforous.
And I'm Brian Sazi. Keep a close eye on Boeing stock today. Now let's get one more check of the markets with Scott Gam down at the New York Stock Exchange. Scott?
Hey guys, well, we've got all 3 major indexes at record highs. We'll see if they close at record highs. Now, the Dow right now is being led by names like Goldman Sachs, Cisco, Dow Inc., and Pfizer. And of course, we have been talking about Boeing all morning. It is the worst performing stock in the Dow right now, but believe it or not, the stock is actually coming back. Earlier this morning, it was down over 3%. Now it's down just over 2%. And of course, the Wall Street Journal is reporting that the company may suspend or cut back production of the still grounded 737 MAX jet. Now, even with the declines in Boeing stock right now, it's still up about 4% so far this year. Boeing stock has been quite resilient, even with all this headline risk. And then another name that's been coming back over the past half hour or so, PG&E. The stock is still down about 16% right now, but it was down even more earlier this morning. And we've got California's governor rejecting some of the restructuring plans going on in that company. But that's going to do it for us on the first trade. Wi-Fi AM is coming up right after this. Stay with us.
Good morning and welcome to Wi-Fi AM on this Monday morning in New York. Here at Yahoo Finance, I'm Dan Roberts. We've got Brian Chung and Julia LaRoche on the couches. To start off the week, let's see what the markets are doing. They're up. We have obviously very good news about trade. A phase one deal, or so we're told. The Dow, NASDAQ, S&P, all in the green. The Dow is up about 160 points. And let's talk more about that trade news. U.S. trade negotiator Robert Lighthizer says that a phase one deal with China is, quote, totally done. And he says it will nearly double U.S. exports to China over the next 2 years. Jess Smith is live in D.C. with more, and she can tell us to what extent we can really be excited about this phase one deal. Hi, Jess.
Hey there. Ambassador Lighthizer does say the deal is done. It just needs to be translated and scrubbed by lawyers. On Friday, Lighthizer told me that he expects a signing sometime in early January. He expects it to be in D.C., but we just don't have a specific date on that yet. But they're shooting for early January. Lighthizer says that China is committing to buying $32 billion more in ag goods over the next 2 years. And then they'll try to buy an additional $5 to $10 billion worth each year. Now, China, we should note, has not publicly committed to those numbers yet, but Lighthizer says in total, China is agreeing to $200 billion more in purchases over the next 2 years. That's in the ag, energy, manufacturing, and services sectors. And while some argue this phase one deal doesn't go far enough, Lighthizer defended the deal on CBS this weekend.
We are right where we hope to be. Tech transfer, real commitments. IP, real specific commitments. I mean, this agreement is 86 pages long of detail. Agricultural barriers removed in many cases. Financial services opening. Currency. This is a real structural change. Is it going to solve all the problems? No. Did we expect it to? No, absolutely not.
While President Trump wants to start phase two negotiations immediately, Lighthizer says he wants to see how phase one goes. He wants to implement that and then look at phase two. He says negotiating all of the phases, getting everything done, could take years. Dan?
Jess, as you mentioned, China hasn't necessarily confirmed certain details that Lighthizer is claiming. And so right now, as we've been through so often, what we're hearing is mostly the U.S. saying, here's what China is saying it will do. And so we have to kind of take certain officials' word for it. You know, there are those who say that they won't really believe that we have a concrete deal in place until we see, say, President Trump and Xi Jinping standing there, signing a piece of paper, shaking hands. What do you make of that? How much can we really believe what we're hearing when it's only from one side?
Well, we have heard from China that there is a deal, and I think that's significant because in the past when we've heard, okay, we have this deal done, we're very close, we haven't heard from China. So the fact that China is saying there is a deal, I think, is very significant. I was in a briefing with Ambassador Lighthizer on Friday, and reporters really pushed him about, is this deal actually done? And he says, yes. He says this is done. It's 86 pages long. He says it just needs to be translated and gone through by the lawyers. So he's really insisting that it is done. And we don't expect to see a signing with President Trump and President Xi. Lighthizer told me that he thinks it's going to be on the ministerial level, so on his level at this point. That could change. He says nothing is set in stone at this point, but that's what we're watching as of right now.
Jessica, 86 pages, anything in there substantively about any sort of the sticking points that have really been the inflammatory point of these debates in the first place, that being the forced technology transfers, also intellectual property theft, or those things that will be negotiated in phases 2 and 3?
There are IP provisions in there, and there are also forced technology transfer provisions. One Lighthizer told us about was that China will no longer be able to use transferring technology as a requirement for gaining market access. And then he says there are also provisions about counterfeits and trademarks. So while we don't know the real specifics of this yet, they haven't released the full text yet. That'll be a few weeks before they do. Lighthizer insists that there are still structural issues in there, though there are a lot of things that they're going to need to do in future phases.
All right, thanks, Jess. We'll check in with you soon.
Of course.
Well, Boeing is now considering suspending production of the 737 MAX jet altogether, as we all wait to see if and when those jets might get back up in the air. Yahoo Finance's Alexis Keenan can tell us more. What is happening here, Alexis? So the date kept getting pushed and pushed and pushed, and now, according to reports, maybe we won't see those planes again.
Right. So we first heard about the potential that the whole production line for Boeing 737 MAX could be stopped down completely. Back in July, at the end of July, during the second quarter earnings call, this was mentioned, and Boeing has said that depending on how regulators react, that they may have to make adjustments that could be slowing it down further or the altogether halt. At that time, they had said that in April, they had already reduced production from 57 aircraft per month down to 42 per month. So a full stop down would be a significant decrease in the number of aircraft that Boeing is producing. But of course, they're also accumulating and they're being stored by Boeing, and Boeing is having to negotiate as they go with customer by customer on how this is all going to go. You know, they've already realized $3.6 billion in increased production costs, as well as put aside $6.1 billion in customer concessions. So the numbers are adding up. And what we're hearing from the Wall Street Journal is that Boeing's board could decide as early as today what they're going to do, a full stop down of this production line versus bringing it down below that 42 number.
I mean, you're talking about some of the implications of this. Let's talk about jobs. What does this mean for the folks working at Boeing? Are we talking about job cuts here?
And it's not just, possibly, it's not just the folks at Boeing either, right? Because this supply chain consists of what is approximately 600 different global vendors. They too have a very carefully coordinated timeline during which they deliver parts to Boeing. So this has really global repercussions if they do make further reductions of any kind. Though I do want to mention what Boeing has told us in response to the Wall Street Journal's reporting. They're saying this. They say, we continue to assess production decisions based on the timing and conditions of return to service, which will be based on regulatory approvals and may vary by jurisdiction. So Boeing acknowledging there that there could be approval in one country before another country.
So it seems like this is surprising because Dennis Muhlenberg and the Boeing management had been optimistic that maybe they can get the 737 MAX back into the skies by the end of this year.
Right.
Looking at the clock right now, probably not going to happen right
no.
at this point.
And the FAA
Why the sudden
has,
change?
Yeah, the FAA has acknowledged as much. It's reported that Muhlenberg and the FAA chief Stephen Dickson met on Thursday, and at that time, Dickson had said that Boeing's timeline looked pretty unrealistic is the word that he used. And so it looks like this is going to go all the way into definitely 2020. And right now we're looking at possibly a February timeline, although American Airlines has already pushed their return to service, it's saying early April. So they're being a little bit more cautious there, even in that regard.
And just to be clear, even if production is completely halted on new 737 MAX jets, does that necessarily mean that the existing ones that have been built, but obviously they're fixing the safety issues, will not go back into circulation, or they still could?
No, yeah, I don't think those are mutually exclusive. Right. I think that certainly the FAA could make some movement and the certification process could go forward. But this is really just, it sounds like Boeing trying to decide whether the bigger cost savings for cash flow purposes is to slow the production versus stop it down altogether. And there's also some reporting from Bloomberg saying that employees would rather have something finite to rely on, knowing that there's a full stop down rather than taking it week by week by week. Although they also reported at Bloomberg that no immediate layoffs are anticipated because there's already some stop downs that's embedded into the holiday timeline.
I see. So it is possible that however many 737 MAX jets exist and have already been made will at some point get approved to go up in the sky, but they won't make any more new ones.
Possibly.
That's a possible outcome.
Yes, absolutely.
Interesting. All right, thanks, Alexis.
You're welcome.
Coming up here on Wi-Fi AM, Uber might be selling off one of its international business divisions. We'll explain. Welcome back to Wi-Fi AM. Markets right now are higher. The Dow inching up, all three major indices in the green. Let's get some more insight with our friend Scott Gam, live on the floor of the New York Stock Exchange. Good morning, Scott.
Good morning, Dan. And all three major indices are also at record highs right now. We'll see if they can close at those record levels. That's the more important thing. The Dow right now is being led by names like Pfizer, Cisco, Goldman Sachs, and Apple. The laggards, as we've been talking about all morning, include Boeing, McDonald's, and 3M. Now, when you have a day where Boeing is down and Apple is up, like today, you can still have a positive day for the Dow. You kind of have this tug of war going on between the two most powerful stocks in the Dow, Boeing and Apple. Boeing, by the way, is coming back. It could very well close the day in the green. And also, to give you a sense of the risk-on environment here, take a look at yields. We've got the 10-year Treasury yield moving more meaningfully above that 1.8% level as investors continue to digest all of this trade optimism. Whether or not it gets to 1.9% remains to be seen, Dan.
All right, thanks, Scott. Great to see you down there, and we'll check back in with you soon. Well, DuPont is selling off its food science unit to International Flavors and Fragrances for $26 billion. The deal will create a new consumer packaged goods giant worth more than $45 billion. And Heidi Chung knows a thing or two about CPG companies and can help us out. So what will this mean for everyone? I mean, DuPont currently not really a consumer-facing brand in some sense.
Right, and a lot of people, when you think about DuPont, you think about Dow DuPont, which was the former company before DuPont was sort of spun off earlier this year. They broke up into three separate companies. Now, what IFF does, which is the International Flavors and Fragrances Company, though we don't necessarily talk about it all the time, it's so deeply rooted inside foods that we see today, and home service goods as well. So all the different products that you use at home with fragrances in it, this company is essentially making all of that, right? So when these two companies come together, this makes a lot of strategic sense, at least according to a lot of analysts that have made comments on this specific merger. Now, when you think about the rise of food this year, we can't stop talking about plant-based protein, right? But think about what DuPont does for plant-based protein. They make pea protein, soy protein, they make the binders that go into a lot of these products as well, and then you combine that with IFF, and that sort of creates this huge company that's going to supply to a lot of these U.S. food companies. So that's why this deal actually is very, very important for consumers as well as investors.
Right, because IFF made a big acquisition a year ago. I was going through their annual report. I forgot, it starts with an F, can't remember the name of it. But it was a sizable acquisition where the CEO talked about it in the letter. And I think you make an interesting point that this is the stuff that is in basically the food, the products that we buy every day. And I think that's interesting that you brought up the vegan plant-based meat.
Right, so some of the specifics though when it comes to this deal, the IFF CEO that is currently serving will take over as CEO and chairman when the merger is completed. They expect the deal to be completed by early 2021. Now it still needs to get the check off from regulators. So until then, it's a deal that is going to happen. IFF saying in a statement that both boards have unanimously approved this merger.
So from DuPont's angle, I mean, why have this merger, right? I mean, this will create a company that's over $45 billion. Isn't it just creating the scale that they broke up in the first place with Dow DuPont? Do they see any sort of cost saves?
Right, so $300 million or so within the first 3 years is what they're saying right now, and it just makes sense because this IFF business is not something that DuPont already has, right? So in that case, they can sort of cut out that extra cost and become this really big powerhouse in the CPG space that's able to pump out a lot of these products and supply to a lot of the big players in the space.
And let's make sure that we define, when you mention that they make the binders, we're not talking about binders like
binders, no.
Ring binders, no.
Ingredients.
Right, when you think about a burger, you bind it together with something, right? So it's like that, binders.
I'll say quickly, it's weird to see that the acquired stock is going down with the acquiree going up right now. I think it's down over 6%.
Usually
IFF.
it's the opposite.
Usually it's the opposite.
The buyer
Very
takes a little bit of a hit because they're spending. Really interesting. Okay, Heidi, thanks so much.
Thank you.
And we'll stick with food. Let's talk about Uber. Uber is reportedly in talks to sell off its food delivery business in India. That is according to the Wall Street Journal. And the buyer for India's Uber Eats could be one of its competitors, Zomato Media. You say Zomato, Brian. I say Zomato.
I was thinking that.
This is likely a sign that Uber is now trying to slim down in its effort to achieve profitability, which is interesting because you remember that leading up to Uber's IPO, Uber was sort of pumping the idea that, well, we're not just ride sharing. Look at all these different businesses we have. The Uber Eats business itself alone is worth $20 billion. We think, Uber thinks. And now, lo and behold, slimmed down because of the increasing pressure on these unicorns to make money.
I think I was actually just reading an article in Business Insider where they were talking about Derek Khosrowshahi. He said about a month ago that, look, if we're not in that number 1, number 2 position when it comes to the food delivery, why does it make sense? And I think that's actually a really interesting point because sometimes here in the U.S., like we all know the names that you see, I mean, especially here in New York City. So if you go to another country, you got to think about, okay, who are the players? Who's been here the longest? Yeah, okay, you have a huge market share opportunity, but I mean, how much is it really worth if you're, I don't know what number you're ranking? When does it make sense?
There are different players in other markets.
They really are. Oh my gosh.
Just Eats is huge. And we don't really talk about I don't even know if they
Deliveroo is
another one. Yeah, that was I saw it in France this summer,
I mean, I think that this really reflects the different strategies that we see with Uber and Lyft, right? Uber is buying in heavily on the Uber Eats delivery service. And you don't want to extrapolate too much from what's going on in India because it's a different market than the United States, but you wonder to what degree maybe this spells a little bit of trouble for its Uber Eats businesses in other corners of the world as well, whereas Lyft has not put any money into that service. They've been trying other things. Last week, they decided that they were going to expand into the car rental space by offering a pilot program. Right, very interesting, but they're focusing entirely on just automotive vehicle, getting from point A to point B.
Yeah, transportation.
Exactly, but it's kind of unclear which is the better winning strategy right now. But it's interesting to see that divergence.
It's not. It's never a one size fits all. Never a one size fits all strategy. And just like I want to share like an anecdote about Uber Eats. Where it really made sense for me was when I was in Bentonville, Arkansas, and I wanted to order food rather than go out. So it was more convenient to use Uber Eats down there. I don't use it in New York City.
Right.
But I was using it in Arkansas.
Right.
I'm with you. I always talk about how it's funny. I mean, there's sort of no loyalty, but at the same time, there's loyalty just because of you use the thing you're used to.
Yeah.
Like I don't necessarily, when I lived in New York, I never used anything other than Seamless. It wasn't because I thought Seamless, I feel I love Seamless so much more and I hate the others. It's what I had used from the start.
Well, it's also just about what restaurants are available. For me, I have no brand loyalty at all whatsoever to Seamless versus Uber Eats. It's just if I want McDonald's, I'm going to go to Uber Eats because I know it's available on that platform.
Well, it was exclusive on Uber Eats for a while, though that is not the case anymore.
Yeah, I got it on Postmates this weekend. I had some McDonald's while Alec was at the gym.
And I've never used Postmates in my life, so it is a very finicky, crowded business. Coming up here on Wi-Fi AM, we will tell you what stocks are trending right now on YahooFinance.com.
Time for today's trending tickers. The first one is Live Nation Entertainment. Shares were rebounding. Actually, they're pretty close to around zero after tumbling almost 10% on Friday afternoon. That was after the Wall Street Journal reported that the U.S. Justice Department is preparing to launch a case against the concert promoter for forcing music venues to use its Ticketmaster subsidiary and bidding up ticket prices. Live Nation and Ticketmaster merged in 2010, and with an 80% hold of the market, Ticketmaster was held to an antitrust agreement to allow competition in the space. The Journal reports that Live Nation is denying that it has violated the terms of its agreement with the government. Interesting, guys. But it's true. Ticketmaster is every site. Every venue, every time I go up to any concert, it's always Ticketmaster.
It feels like a monopoly, and the ticketing industry is really, really dirty and bad. I mean, that's not controversial to say. I mean,
You've covered this industry.
Oh, the number of fees, the amount of people now who get early access because they're card holders. It used to be just a sliver, but now a regular person has very little chance of actually getting a ticket to a hot concert, even if you're waiting there and you click the second they go on sale. It's like, oh, 70% were gone from Amex pre-sale. I mean, there's all kinds of problems with this business.
I gotta say, I'm not a big concert goer. I know maybe I'm missing out on life, guys, but it's just not my thing. So I can't explain it from a customer's viewpoint.
Sports.
Yeah, but I mean,
same here.
It's no surprise that you hear a concert at MSG for a big name artist, right? Comparable artists from today, I can't think of any, but to 10 or 15 years ago, I mean, it's exorbitant now. I mean, you try to go see Taylor Swift, Anderson .Paak over at MSG, and a regular ticket will cost you $130, $150. And on resale, because people mostly buy these tickets because they have the early access, even though they don't intend to go, they try to flip them on a StubHub or on a Vivid Seats or on some sort of those resale platforms. And people who want to go to these concerts have to pay 4 to 5 times the ticket price rate.
That's another problem. I mean, I guess how do you cut back on that? But a lot of people buying the tickets first round are only buying them to resell them and scalp them.
Which is weird, though, because those resale platforms appear not to be all that profitable either. I mean, you consider that eBay with StubHub, right? Yeah. eBay now trying to explore maybe rolling off their StubHub business. Well, StubHub was supposed to be one of these companies that was supposed to provide a lot of, alpha because they charge so many fees to buy those tickets on resale.
Well, maybe there's an opportunity for someone to come in and disrupt.
Well,
sounds like there's some issues existing, and
name your price ones, and
the weirdest thing is still will call. You have to still show up in some cases to pick up the tickets.
Or places that don't allow phone ticket.
Right,
like, what are you doing? I have to get a piece of paper.
That's a whole other point. But another ticker that we're watching today is chipmaker Micron. Shares are currently trading up over 4% after Susquehanna upgraded the stock from neutral to positive this morning. They were citing improvement in its DRAM and NAND businesses. Those are types of chips beginning in May next year and extending through late 2020. While the story for chip stocks has actually been the buildup of inventory, Susquehanna writes that that actually expects possible shortages and tightness of demand by mid-2020, suggesting that the slump for chip makers could be over. They say the price target, get this, $85. Ooh. That's quite the upside.
Almost double.
For this stock. But, chip makers have been in view for a lot of this year. It's been not so great for them. Very rocky, very volatile, caught up in the trade war.
Trade war susceptible, but now kind of coming back. We were just talking last week about AMD was up big.
How much of this, though, is tied to the trade war and some of those concerns kind of dissipating? Do you guys know?
The Susquehanna didn't point to anything. Okay. They didn't even mention the word trade in this particular note. They just say that the fundamentals seem to favor, some sort of rebound. They didn't say it, but there are some technologies down the line that could support this. One example being Xbox announced last week that they're going to have whenever you have a new console, they're obviously trying to update with whatever the brand new types of technology are. So that's a large demand for chips, PCs, laptops, smartphones, and whatnot. They were just saying 2019 was just not a great year. The trade war is one part of it, but another big part of it is that just there wasn't any new tech to take on these.
It's actually a good point because I'm trying to think what were the big tech announcements of this year?
Well, early this year, or really more last year, these stocks were getting a boost because they were making the chips for crypto mining rigs. And although there are still Bitcoin mining rigs and they all have chips, it's kind of come down a little.
That was the thing they were always talking about on the earnings call, is this mining, the whole mining. And
another type of gaming.
Yeah, got it.
Yeah. Speaking of gaming, just briefly on Friday, AMD was up big because, I don't know if it was because of this, but it was news we discussed. AMD announced a blockchain partnership with a blockchain-based gaming platform in Estonia. So I don't know if it'll even lead to anything, but AMD going to be helping with marketing and promotion of blockchain-based gaming. So, and then they use their chips for the games.
What kind of games are going to be on that platform?
It's sort of like VR. Like, it's here, but it's still not here.
Right, like 5 people are actually
even
using
VR devotees, you ask them, like, is it here yet? And they're like, no, it's still not. It's not quite mainstream. All right, coming up here on Wi-Fi AM, how Netflix is getting friendlier with brands, even without ads on Netflix. Welcome back to Wi-Fi AM. Amazon might be facing a strike during its busiest season. The German trade union Verdi is proposing a pre-Christmas strike at Amazon warehouses in Germany. They're demanding better pay and working conditions for Amazon employees there. And of course, unions have staged strikes against Amazon in Germany before. That has happened a few times since 2013 in hopes of forcing Amazon to recognize collective bargaining agreements. And of course, not the only example in the world of unions or workers complaining about or taking action against Amazon.
Especially, I mean, come on, this time of year, I can only imagine every time I walk into my building, just stacks of Amazon and Walmart packages like flooding into the lobby. So, I mean, this is definitely the busiest time of year. I can't imagine what it's like being in a warehouse. I mean, if you're talking about leverage,
I was just going to say, great time to do this.
Probably the time to do it.
The Amazon is likely to just, they need to do whatever they need to do because they cannot have the warehouses not flowing.
And this is not a unique story to Germany. We've heard about strikes here in the United States as well. But I think that for any company like Amazon that is operating in many different countries, especially in Europe, you have to be mindful of how collective bargaining and union negotiations in those countries are a completely different game, especially in logistics and transportation, right? I mean, you hear all the time about strikes for airlines, train operators, all other types of businesses in Europe, in the UK, in France, Germany. So it should be no surprise that this is something that's going to periodically occur and probably should occur even more often, right? And the more power Amazon gets, the more profits that they make, the more demands there's going to be from workers, rightfully so, to be paid fairly, I think. And in other countries, it might be easier to unionize and to have those collective bargaining agreements than in other countries.
Especially when you're, not only that, just talking about a massive player in the space, but you also have the world's richest man at the helm of your company.
Right.
So it's only going to add further attention to some of these issues.
Although that alone is not going to make him say, okay, give him whatever.
No, of course not. But I think it also, people will start talking about it more often. I mean, you often see the ratios of CEO pay versus worker pay, those sorts of things. Doesn't necessarily help.
Yep. All right, let's talk about Netflix. Netflix, as you know, famously has no ads on the platform. But as the streaming wars heat up and Netflix faces more competition than ever before, it is getting friendlier and friendlier with brands in other ways. Netflix partnered up with Subway for a Green Eggs and Ham sub timed to the release of Green Eggs and Ham on Netflix. Of course, that is based on the Dr. Seuss book. And in another cross-promotion example, Netflix charged the clothing brand Diesel a licensing fee to make outfits for one of Netflix's most popular shows, Money Heist. Now, these examples are from a new New York Times story today. So, guys, you wonder if this will be kind of the way around Netflix doing ads. I mean, I keep saying we're seeing more and more analyst notes that predict that as the streaming wars get hotter, Netflix will eventually add ads.
No.
I do not think so. I do not think so, but this is one way for it to get additional revenue. You say, hey, want product placement in the next season of Stranger Things? Well, make sure that they're all drinking Coke. And then, well, is that an ad? But what I don't expect anytime soon is actual advertisements.
Okay, I actually kind of like it. I'm not going to lie. I know, Stranger Things, because I like the JCPenney, there's just some nostalgia there. It made me think of this, and this was actually mentioned in the New York Times article, was E.T. was eating those Reese Pieces. I mean, he could have been eating M&Ms, but I gotta say, as a kid, I loved. Did I say Reese's?
Sorry.
Reese's Pieces. Reese's.
No, I prefer Reese Pieces.
I like Reese's Pieces. I know it's a Reese's piece. Whatever. I'm gonna say it my way.
Well, there have been.
We're laughing with you now.
There have been major product placements to some of these shows for a while now. Now, I don't know if those were paid, but some of these shows, I'm forgetting that there was one example where it was very overt.
Well, and this is the thing about sponsored content, right? I mean, this has been happening for years. This is not the first time Netflix is doing this, right? But sponsored content, SponCon, if you will, in the industry.
Oh, I will.
Is basically, it's as targeted or it's as successful as it is in the situation that you just mentioned, right? If it hits that nostalgia, if it hits something that's memorable, or it just reminds you of something from the past, then it's good sponsored content. If they just put like an accurate MDX in a movie that's set in the 80s for no apparent reason, then people will get angry at that too. In the same way that they might get angry if Netflix were to put advertisements in place. So it has to be smart content. So it seems like Netflix has done a pretty good job at making some of those subtle sponsored content placements. But at the same time, if they overdo it, people won't notice. People are not stupid.
You have to do it the right way. It just reminds me of like Marty McFly, and he gets that Pepsi, like in the Back to the Future 2, and he gets the Pepsi, and it's like, it just looks so cool because he's drinking that cool Pepsi.
I never saw the sequels. It's sort of on my to-watch.
Great movie, but it's all about about you have to get the placement just right.
Right.
But I gotta say, that sandwich from Subway, can we just talk about that for a second? That looks repulsive with the green eggs. I cannot
Yeah.
even imagine. Ugh, like,
I feel like I've already seen some
What?
eggs at Subway that have been.
In other words, Julia, you do not like green eggs and ham? You do
No,
not
Sam,
like
I am. No, Dan, I am.
All right. Let's stick with streaming. AT&T will be launching another streaming platform, and we're not talking about HBO Max. That is set to come out in spring of 2020, but now AT&T announcing it will also roll out another separate platform called AT&T TV. That will come in February 2020. The service is currently being tested in 15 U.S. markets. It will require a self-installed AT&T TV box instead of a satellite. So really bringing you back to the days of the cable box. But the box will take voice commands, it will offer live TV, and it will have over 55,000 titles. So all of these players are rushing to get in, and many of them launching simultaneously multiple different services, although so is Disney. I mean, Disney has ESPN Plus, Disney Plus,
Which is a huge
and Hulu, which it now has full ownership of, and now, of course, surprise, surprise, it is bundling all three. So soon enough, we're seeing the rebundling, which is very ironic. But man, AT&T TV, sound good?
Well, you just totally turned me off when I heard that I have to get some sort of box and install. What? Why can't I just turn my TV and like sign up something and like not have to do any sort of installation?
Right, it's a cord
lazy
cutter's
millennial.
way to install a box to get access to your streaming services. Like,
Yeah, it's a little
it's unfathomable.
why can't I just
one
log
retort would
on?
be, you already do have to have a box of some sort for
Smart
the
TV,
other
right?
things.
Don't I
If
just
you
have a smart
Roku, Apple
TV?
TV? Well, now, if you're to buy a new TV now, some of them are coming with
Whatever
that.
my TV
But
is, I think it just has like a smart thing in it.
Smart TVs do
Okay.
suck, though.
You don't have
Hey.
any kind of little device, a black box.
I don't think so.
Like a Chromecast or a Roku.
I have some
that's
Wi-Fi.
what TV set.
That's a
Regardless,
physical device.
Here's my thing, okay? I have so many apps on my phone or on my iPad now because every single streaming service appears to have their own thing. And here's another one. This AT&T TV is just another one. I mean, but the problem is they also keep changing it, right? There was a point in time where if you wanted to watch ESPN, you would have a separate app called Watch ESPN, and then there'd be a separate app called ESPN if you just wanted to see sports scores.
Yep.
And they said, oh wait, actually surprise, you have to delete Watch ESPN and then migrate everything over to the regular ESPN. It was the same thing.
Well, and now
with
Plus
Fox,
just lives in the main
Fox
ESPN
Sports,
app.
regular Fox. You have to have a Fox Sports Go. Like,
Oh, I know
it's
from trying to watch the Stanley
unfathomable
Cup.
to me to watch sports on a streaming app because you have to go through like this maze on the App Store to figure out which is the actual
Why
app
can't
to
they
watch it on. It's
all
so
just
confusing.
be together? Like,
Well,
why can't I watch my Disney Plus
think
and my
someone is going
Hulu
to
in
come
one
to
and
do
then
that.
my
Someone has to.
It's
sport?
going to cost a lot of money, but people are getting frustrated enough that soon there will be something to pay for. It'll be expensive, but and it's a portal, and it gets you all the other things. Like Roku is right now, but there's no, Roku subscription service. It's just the box.
I mean,
but
see, that's
what
the
if
thing.
someone could
But
offer you
how-
a subscription to the subscriptions?
But at the end of the day, though, we see it with the media blackouts right now when you have your actual cable package, right? Those negotiations are so difficult because it's only 4 or 5 players that are really fighting with one another. So who's going to allow a media aggregator to come into the space and then bundle all these services together, right? It's not really clear to it's clear to me that people want an aggregator so that they can just go to one app and then access all this content, but it's not clear to me who would be able to do that.
AT&T TV, not the best
I
name.
mean, Apple is trying, I guess, but
Not the best name
I've
I've
heard terrible things about C.
I do like HBO.
Sure.
Yeah.
Peacock, fine name. It matches the brand.
Too many apps.
AT&T
It's
TV.
Too many apps. Too many apps.
It's going to be like
Doesn't
really
roll off the boat.
fragmented
Like
in
5
how
different
many
times.
$6.99, $7.99, $11.99, subscriptions are we going to all dole out for? I don't know.
Right. Hulu, Vudu, Roku, YouTube. They all have crazy names, but
ridiculous.
we get used to them once they become brand names. AT&T TV. It doesn't
T's,
sound
yeah.
pleasant.
Too many T's.
Coming up here on Wi-Fi AM, we will talk to a CEO who just gifted 13 Cadillacs to his employees.
All right, welcome back to Wi-Fi AM. I'm Scott Gamm on the floor of the New York Stock Exchange, joined now by Peter Tuchman. Okay, so record highs across the board. It seems like we say that every day. Is that a problem in and of itself, though?
You know what? I don't know if that's. I mean, it's never a problem, right? You know, normally you would have seen if we had been hitting these levels and then that there was a bubble underneath, and the market sold off, and we saw these thresholds and these markers without support underneath them, it would be a problem. But I would say for the year, every time we've hit them, whether we've retraced a little bit or not, the market has sort of inched its way higher and higher and higher.
All right.
I think it's important to note that there's a case for the bulls and the bears here today.
All right, explain that quickly.
Okay, so we're on December 15th. You know, for the first time, I think in December, even though we've been hitting record highs, it feels kind of like a Santa Claus rally. What does that mean? I think there's a bit of a markup. There's fear, there's so many factors going involved. Obviously, we have a little more of clarity about a deal, phase one in the China thing, so that's not a negative thing. We've got coming into the last 2 weeks of the year, which has always traditionally been a positive time of year.
All right, let me just interrupt for one second, because a month ago, November 15th, we hit Dow 28,000, and you and I were wearing the hats.
Correct.
Do we get to Dow 29,000 before the end of the year? You're going to have to print more hats.
I think I may. I really may. I'm actually going to call when we're done with this show. I kind of think we're going to inch our way there pretty quickly. This market, it doesn't feel like anybody really wants to sell the market here, right? You've got lots of reasons to buy it. You don't particularly have any particular reason to sell unless you're going to take some profits into the end of the year. I think you're going to have some tax selling coming into the last couple of weeks, but I still think there's a bid in the market, which means that there are people who did not buy it yet, fear of missing out. There are people who are sort of marking up their positions coming into the end of the year. It's been one of the great years. We have people who bet against the China deal who are now covering their shorts. We have people who are buying it because interest rates are lowered. Last meeting that the Fed had the other day sort of told us that we're going to keep steady on that. That's no fear in the market.
So a market melt up for the end of the year instead of last year, which was a meltdown.
Correct. And you and I have talked about it for the last couple of weeks. I think we're really trading in a mirror image of last year. October, we hit record highs. Interest rates were rising. We spiraled down to that day, that Christmas Eve low. This year, October, record highs, lowering interest rates, the fuel on the fire, a little bit of clarity in the China story, which is what took us down last year, the complete reversal, and the market's going higher and higher and higher.
And yet you still have a lot of stock-specific stories, right? Boeing down because of the worries over the MAX, and yet that's not affecting the broader market.
Well, you know, it's kind of funny. I kind of bet against the market this morning, and I was wrong because I really thought that the Dow was going to drag everything down.
Yeah.
That stock is getting hurt in a big way. A couple of their suppliers are also, but the market doesn't seem to be fazed by it.
All right, Peter, got to leave it there. Thank you so much. As always, we're going to have more market coverage on Wi-Fi AM coming up after the break. Stay with us.
Welcome back to Wi-Fi AM. Lower interest rates this year spurred more mortgages and refinancing. United Wholesale Mortgage is one name that benefited, and it expects to double its mortgage broker volume production this year. To celebrate, the company's CEO gave away 13 Cadillacs to employees. And joining us now to discuss from Pontiac, Michigan, is Matt Ishbia, the CEO. Thanks for joining us, Matt.
Yeah, thanks for having me.
So this is a very feel-good story around the holidays, and you guys had some success. Let's just start with the company and how you did this year. How do you attribute the growth?
Yeah, we had a great year. The growth is all tied to our people. You know, we got a lot of great team members here, almost 5,000 people here in Pontiac, Michigan, working together hard every day and doing a great thing for consumers and brokers across America. So we're real proud of that. And the mortgage broker channel, where people are finding that that's the best place to get a mortgage, is growing. And we're excited about that growth, and we're a part of it.
Matt, sometimes around the holidays, we see these stories where a company does well, and so they give every employee some crazy percentage bonus. Instead, you guys, the way you handled this, did you raffle off the cars? It was random, right?
Yeah, it was actually a combination. We did a couple different things. We raffled off the car. We also, gave away 30 cruises to the Bahamas, along with, we brought in the Chainsmokers to entertain our team there for the holiday party. So we really just wanted to make it a big celebration. When you win and you have a great year, you celebrate with your team. My background is sports, college basketball, and so you want to have a fun time, and it's all about team and family. And I got 5,000 great team members, so we wanted to celebrate together, and that's what it's all about.
Hey, Brian Chung here. So I feel like we hear a lot of stories in the press about a lot of these big tech companies and how workers feel like they're not being treated or being compensated fairly. I mean, in your view, it seems like you guys are doing something completely different. I mean, why is that important? Why do you need to do things like this to engage your employees? Do you find that has resulted in an attitude change at work? What's the benefit of doing something like this?
Well, the benefit is you take care of people that take care of you. You do the right thing. And so for us, it's not about making one more dollar. It's about being successful. It's about winning and being great. And as a team, you got to do it as a team. You win as a team and you lose it as a team. And so it's a no-brainer for our company to do the right thing by our team members. These are just some of the small things. We do more and more things like this all the time, but this was a big thing to celebrate the best year in company history. And so we went a little bigger than normal, but it's, you got to celebrate and win together. It's not just the CEO. I'm not that great. I got 5,000 amazing people. They make me look good. And so we got to take care of it, each of them, and celebrate together as a team.
Matt, you mentioned your background in college basketball. I know that you actually won a title at Michigan State under Coach Izzo. I'm just curious, while we have you, what's your take on what has happened with the NCAA changes and the ruling that in California, at least, they are going to allow college athletes to do paid endorsement deals?
I think it's great in general. I played a long time ago. I wasn't that good, but I was on a great team, a national championship team, and seeing guys on the team and other people that maybe were struggling to get a meal, but signing autographs and doing things for kids all the time. I think it's great to help people out and do the right thing and give them a little opportunity to make a little bit of money while at the same time being amateurs and playing at the school that they love and being part of a university like that. So I think it's a win-win. They just got to figure out how to do it the right way, but I'm supportive of it for sure.
All right, Matt Ishbia, thanks so much for joining us. Good stuff.
Thanks for having me.
Hallmark Channel is putting ads featuring a same-sex marriage back on the air, and it's apologizing for pulling the ads in the first place. The ad is for the wedding site Zola. Hallmark Channel said it was the wrong decision. Now, the network faced backlash initially for having the ads, then it pulled the ads, and it faced much bigger backlash, including initially from conservative group 1 Million Moms. The ad shows two brides kissing, and it is a Zola ad. Now, Hallmark Channel will run the ads again. So guys, this, to me, it's like an example of, okay, it probably shouldn't have pulled the ads in the first place, but once you've pulled the ads to appease one group that complained, now you reverse it because more groups are upset. Now you just look like you don't stand for anything.
Yeah, and I was actually on the parent company, Crown Media's website. They have a tab that says diversity. I read about it. I did not see anywhere on that tab about LGBTQ, that community. And I just think now, guys, it's 2019, we're going into 2020, and if you aren't comfortable with that, with two brides kissing, I'm sorry, you're just going to isolate a lot of people, and I think more people are supportive of the LGBT community than not supportive. So if you isolate one group that just is not cool with that, that's fine. But it's hurtful to so many people to not be okay with it. And I've got to give a shout out to Signet CEO was just on here, and she was talking specifically, that's a parent company of Kay Jewelers, Jared, you name it, how they are embracing and bringing in more marketing catered to that community, because she said basically it's double digits percentage of people getting married who are LGBTQ. So,
I mean, from Hallmark's perspective, though, it's just, I don't think they're making up with the LGBTQ community by now putting the ads.
No, they're not. They said they want to work with them, but the damage has been done at this point. And because one group is, we're so upset because of this ad. Again, I go back to this. It's 2019. It's 2020.
Yeah.
And by the way, it is legal in the U.S.
Yes.
Gay marriage is legal. So
Yeah.
at this point, if you're yanking the ads because a conservative group didn't like it, well, now you've shown your cards. And I sort of already had a vague sense that Hallmark Channel was kind of conservative, right? I mean, a lot of the stuff on there is religious stuff. But man, once you've pulled it, to undo it, now it's too late.
It just doesn't
PR
feel true. It doesn't feel genuine.
I mean, one thing, to be fair, I think I'd love to see the numbers for Zola. Whether or not,
Yes.
I mean, maybe this has been good for Zola. I mean, obviously,
I think
you put
that's
that advertisement out there,
Yeah.
and maybe
Awareness.
you didn't expect to get this much attention.
Awareness of
So-
Zola. And by the way, we're in an era when people want brands to stand for something.
Yes, exactly.
Nike did the Kaepernick campaign.
Yeah.
They knew it would alienate some people, but they decided, look, we're going to get pegged politically one way or the other anyway, so let's be proactive and take a stand. We've decided to show that we're with Kaepernick, and now Hallmark, I mean, so what do they stand for? Nothing.
You got it. You're 100% right. Even Walmart took a stand on LGBTQ issues in their home state of Arkansas, and you cannot just turn and look the other way or, okay, I'm not okay with this ad. You need to stand up for people.
Yep. Really good discussion.
Yeah.
Coming up here on Wi-Fi AM, we will be back with the latest product to jump into that plant-based craze, and it isn't food. Welcome back to Wi-Fi AM at Yahoo Finance. The plant-based craze is now hitting footwear. Reebok announced its new vegan sneakers. The Float Ride Grow will be hitting shelves in fall 2020. And our sneaker correspondent is live in the newsroom. Yahoo Finance's Reggie Wade. Reggie, what is going on here? Vegan sneakers?
Yes, vegan sneakers. You're absolutely right. First we go plant-based burgers, now plant-based sneakers, and this is kind of the next evolution. We talk to a lot of people. We talk to StockX CEO, we talk to people who run Stadium Goods, and we always ask them, are we peak sneaker? And they're like, no, the sneaker market has room to grow, and this is where it's going to grow, vegan sneakers. And I think it's genius by Adidas, who own Reebok, to say, we're gonna make a vegan sneaker, but we're gonna do it for the Reebok brand. Grow that one out a little bit.
And Reggie, down here in the studio, we have one sneaker you sent down for us, the Kariuna.
Yes.
And now this is not the Reebok sneaker we were just talking about, but this is another plant-based
another
one?
vegan. Yes, the Reebok shoe comes out in 2020. This is a plant-based sneaker, 100% plant-based sneaker. This is made out of bamboo leaves, oils instead of glue, and this is what you're going to see more of. This goes for $98. I'm not sure how much the Reebok one's going to go for. I'd say probably about $120, but this is really the future. This is really lightweight. I think people really want brands that, feel that they take a stand for what they believe in, and you're going to see more and more of this as 2020 hits.
You remember, Reggie, it's Julia. It's so interesting to me because I wasn't even thinking about my sneakers not being vegan, or, I mean, I never thought of them that way, but being, I guess, made of animal byproducts, if that's what that is. So do you think this is also a sustainability play? And, oh my gosh, the sneakers were...
That's where the
Yeah, is this a sustainability play?
I think it is. A lot of brands are seeing that their customers want to have sustainable products, but I think they're hitting a very specific market. Not all sneakers are going to go this way, because if you talk to sneakerheads, they don't want vegan Jordans. They want leather on the Jordans. They want leather on the classic retro sneakers that used to have leather. So I think this is a very specific part of the market that these sneaker companies will go after. I think it's very smart. It's about time they start doing that.
Reggie, I've got one shoe here. You've got the other one.
Yep.
Just in terms of the durability of these things, though, right? I mean, it's made out of different materials. What's your take right now on how long you might expect these to last?
I haven't worn these. Unfortunately, they didn't send it in our size. But I talked to the president of Cariuma, and she said these are really durable. She said these shoes stand up, and the rest of their lineup stands up, and they feel pretty durable. I don't know what you think, Brian, but I think these will hold up in a good rain.
Yeah, I think so too.
All righty, Reggie.
Thank
Thanks so
you.
much. Good stuff. Now, we will take a break from Wall Street to find out what is happening on Main Street. It's our small business segment, and our guest today is a female entrepreneur with multiple companies that has made Oprah's O-List 5 times. Dawn Lancaster is the owner of Pure Energy Apothecary, and she's joining us from Williston, Vermont. Hi, Dawn.
Hi, thanks for having me.
My pleasure, and I love Williston, Vermont, so nice to have you joining us from there. Went to college nearby. Let's start with your first company, Carved Solutions, which was soaps, and you sold that business. Tell us about that.
Correct. So our original claim to fame was your initial monogram, personalized name, custom carved soaps that we really offered nationwide with many different retailers. And one day, the wonderful Adam Glassman happened to see us, and the next thing we knew, they loved us, and we found our way onto the O-List.
Dawn, it's Julia. I want to hear about the process of making the O-List. What is it like when you find out you have multiple products that have made this list? And just how meaningful is it to be on that list from an entrepreneur's perspective?
It's absolutely phenomenal, the way that the folks of the O Magazine really do curate, and they really take the time to look at a product and see, how it fits for them, and Oprah likes it, doesn't like it. But as an entrepreneur and a business owner, when she actually puts her stamp of approval on your product, it is really like winning the Grammy, because it lets people know that they can trust you, they can trust the company, they can trust the product quality, and it's something they can depend on.
Hey, Dawn, Brian Chung here. So we're pretty close to Christmas. A lot of, concern that because this holiday shopping season was actually shorter than previous shopping seasons, that maybe it might change the way that people shop or the rate at which people are shopping. I mean, what have you seen in terms of volumes for your products so far now that we're getting in within a week of Christmas?
Today is a crazy busy day across the board, both still at Carved Solutions and at Pure Energy Apothecary. We're shipping like crazy. Our retailers are very, very busy. They're really trying to secure all the sales that they can, but it's nice to be able to have something that is, guilt-free pampering to give someone that's consumable.
Dawn, it's interesting to have you on because we did, you mentioned Adam Glassman from Oprah Magazine, and we had him on just recently talking about this year's Oprah's Favorite Things list, and we were talking about how much of a boost it can be to a small business to be on that list. So great to get your perspective. Tell us while we have you about your new company and the skincare products.
So Pure Energy Apothecary, in short, really birthed out of Carved Solutions. It was an extension of Carved Solutions, and it's finding a solution for healthy, non-toxic, plant-based products, but in your mainstream boutiques or your mainstream grocery stores with ingredients you can actually read at a price you can really afford.
All right, Dawn Lancaster, thanks so much for joining us.
Thanks so much.
And we'll be right back here at Wi-Fi AM after a quick break. Welcome back to Wi-Fi AM. Jumanji, The Next Level, soared at the box office this weekend. It grossed over $60 million in the US and Canada, and it knocked off Disney's Frozen 2. from the top spot. It's a sequel to the movie with Dwayne "The Rock" Johnson and Kevin Hart, and it's the third installment in the franchise. Despite getting bumped from number 1, Frozen 2 still has now passed the $1 billion mark worldwide. There's Danny DeVito. He's in it too, I guess.
I didn't know he was in there.
I didn't. Yeah, I love it. I didn't realize that the previous Jumanji did so well. I remember seeing the ads for that and being like, okay, pass, but it was a huge hit, and I'll tell you why, I suspect. Dwayne
The Rock,
Johnson.
duh.
The Rock is just the biggest star on the planet.
massive.
When he goes to China, when he goes to Russia to promote movies, man, people go nuts. Nuts.
I'm a big fan of The Rock. I actually saw him in the airport one time in security line, just putting that out there. But I mean, he's the reason I watched the show Ballers. I don't even think Ballers is that great of a show, but I love the show because of him. So,
I mean, it just speaks to everyone's like, oh, I'm so sick and tired of these studios just remaking movies. Like, get original. But with numbers like this,
hello.
How could you not?
That is original.
And I will say, even though I haven't gotten around to watching it, I'd be willing to watch it. But I do remember thinking that the premise of the previous one is very clever, which is they're all kids playing the game, but in the game they're given characters, different bodies. So it's sort of like a little bit multi-level where, The Rock is playing, I think, a girl who is playing the game as that
Interesting.
character.
Spoiler alert.
So he has to be, he's himself with his own voice.
Oh, you must
but
have loved
he's supposed to be a
Westworld.
girl with
Interesting.
I didn't watch it. I sort of like that double.
I've only ever seen the first one with Robin Williams.
Right,
This is
me
like
too.
a video game, not the board game. Man, that board game one was scary when I was a kid.
Yeah,
oh
that was
my
a scary
gosh, that
movie,
was
the
scary.
Robin Williams one. I guess that's why I read it's the third one in a franchise, and I was like, it is? But I guess we're
I also
counting the
didn't know that,
original
right.
as the first, and then you got two.
Look, they make the money,
Rock ones.
and that's all that matters.
Well, look at Fast and Furious. I mean, there's a reason they called him franchise
I love
Viagra.
Fast and Furious, though. I like that.
He's franchise Viagra. He brought back Fast and the Furious. Killed it. What are you going to see in the theater between now and New Year's?
Star Wars. Oh my gosh, Star Wars.
absolutely.
I'm already crying like
There you go.
watching the
And I hated the
trailer.
last one. I'm still gonna go see it though.
Now, when
I
you say
hated
the last one, do you mean Solo or Last Jedi?
Last Jedi, terrible.
Oh, really? You
terrible
hated
movie.
it?
Terrible
Oh,
movie.
I thought it was cool.
Screenwriting
Good.
was horrible.
I guess I'm pretty easy to please.
That was
Just
one of
last
the
night, we
smartest
rewatched-
acquisitions ever.
Yeah, absolutely.
Ever.
Absolutely. That and Pixar and Marvel.
Yeah.
A trio of really smart Disney moves. Just last night, we finally downloaded Disney Plus in order to rewatch Force Awakens, and then we'll rewatch Last Jedi.
deleted it?
You need to watch The
No, we hadn't
Mandalorian.
signed up
Watch
yet.
The Mandalorian. It's amazing.
Haven't started that. Okay, that's the show for today. Thanks, guys. Thank you for watching. That is Wi-Fi A, and we'll see you back here tomorrow. But don't miss On the Move. That's our next live show. It starts in just 2 minutes.
It's 11 a.m. here in New York City, 90 minutes into the trading day, and we're watching a rally on Wall Street, hitting record highs across the indexes. It really is a done deal, or is it? Questions still swirl around the U.S.'s Phase 1 trade agreement with China. Boeing fallout, the company reportedly considering suspending production of its 737 MAX jet amid uncertainty about the future. And taxing questions, a new report claims Fortune 500 companies avoided more than $70 billion in taxes during the first year of President Trump's new tax law. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for being with us. Well, our top story today, trouble for Boeing. The company, according to a report, is considering suspending or cutting back production of the 737 MAX as uncertainty grows over the plane's return to service. Yahoo Finance's Alexis Keenan has that story. Alexis?
Julie, Boeing's board is said to decide as early as later today. That's according to the Wall Street Journal. They'll decide whether or not to halt production of the Boeing 737 MAX altogether or simply reduce the level of production as they did back in April. If you'll remember, during the second quarter earnings call in July, at the end of July, Boeing announced that they had reduced the production rate from 52 planes per month of the MAX to 42 planes per month. That's what they've been doing ever since, though this, of course, could have repercussions for Boeing's employees as well as global suppliers. There are approximately 600 firms that contribute to creating the MAX aircraft, along with 100 kind of smaller suppliers. But of course, the U.S. economy at large as well impacted by this, as Boeing cannot move these planes, cannot deliver these planes to its customers, that impacting and weighing on the trade deficit for the U.S. Boeing has already accounted for $3.6 billion in increased production costs. They also had set aside a $6.1 billion in customer concessions. So that's approximately over $9 billion so far. Also, the slowdown has impacted the cost to produce each plane, Julie, because the Boeing's fixed production costs, while they've stayed the same, producing those 42 planes per month just isn't the same. They had planned to ramp it up to 57 planes per month. That we've seen has not happened. Boeing is telling Yahoo Finance this morning, in response to the Wall Street Journal's reporting, that it will continue to assess production decisions based on the timing and conditions of return to service, which will be based on regulatory approvals and may vary by jurisdiction. Boeing there saying that it's possible that the Boeing 737 MAX could be recertified in one jurisdiction before another, so not necessarily consenting to a global consensus on getting those back up in the air, which we've heard so much about. Also, American Airlines announcing that they have pushed their return to service all the way into April, and other airlines we're hearing may be following. Julie?
Alexis, thank you. It's Adam here, and I want to introduce this hour's panel, Invesco Investment Solutions Senior Portfolio Manager, Alessio De Longes, and Yahoo Finance's Brian Sozzi. Alessio, let's start with this. Dennis Muhlenberg from Boeing met with the FAA Administrator Stephen Dickson last week, and Dickson was saying, slow down, slow down. So the message was that Boeing, even they were building what? They went from 52 737 MAX a month down to 57 to 42, but even that was too much.
Being responsible for asset allocation, unfortunately, I cannot comment on individual companies, and I'm sure Brian can opine much more in detail than I can. What I will say that within the, despite this type of news, from a macro level for the sector, given airlines rolling up to the industrials, we actually are fairly positive on the overall sector, on the industrials. And it's consistent with a rotation that we believe that the rotation from growth into value is here to stay for the next few months. Industrials are one of those sectors that screen most strongly with value characteristics. And now, given that we also have some upside views on oil prices, one needs to, with respect to airlines, one needs to balance that a little bit. So now, obviously, this supersedes the company-specific news.
What amazes me, Adam, is that the stock prior to this was still up for the year, and I think it's still up for the year. And it's amazing how investors continue to give the management team the benefit of the doubt, and the stock trades as if there won't be a dividend cut. The company will probably pay out more than $4.5 billion in dividends this year. Now, Should there be a cut? Potentially. This situation is getting worse. You're taking out of a plane that represents about 80% of their operating income. That's a big chunk of your business.
But that chart doesn't look like that, does it?
Yeah. At some point, you're going to have to see some dumping here. It's amazing to me that the investors are sticking with this company when clearly there's cultural problems at Boeing. They're getting worse. Also now production problems.
There's the other issue, too, is that the airlines, some are saying, as Alexis pointed out, they'll take delivery once they can take delivery of the aircraft as soon as possible. Others are saying they want to wait until possibly next fall. You know, one of the things that happens when this plane comes back into service is that it hurts the airline's ability to price tickets. You would have too much supply, essentially, of seats, and it would force a price war for the airline. So they're not as eager as you may think to get the plane back.
What happens to the planes that are just sitting there? The hundreds of planes that are sitting there, they have to be refurbished too. This won't change overnight.
And the other question is, are customers of the airlines going to refuse to fly on these planes even when they come back? So are the airlines willing to take that risk that they could see that kind of a hit? I don't know. I don't know the answer to that. All right,
the oxygen out of the room with that one.
Sorry, let's move on to Micron. It's one of the best performing stocks in the S&P 500 right now. And Scott Gamm is on the floor of the New York Stock Exchange with the details. Scott?
Hey there, Julie. That's right. We're seeing about a 5% gain in Micron shares right now. And we talk a lot about how important this semiconductor space is for the broader market. So you are seeing a follow-on effect, not just in the semis, but in the broader tech sector because of this gain coming amid an upgrade from Susquehanna Research. The analysts say with regard to Micron that industry dynamics are improving. We should also point out the stock is up more than 60% so far this year. Another name we're watching right now, PG&E, the stock getting hit big time, down 15%, although believe it or not, it was down even more earlier this morning. This as California's governor says that the company's restructuring plans really don't meet the standards of regulators. Now, even with this decline, the stock is now just below $10 a share. That's a key level for the stock. And then finally, Urban Outfitters, the stock down slightly. It was down a lot more earlier this morning. The company getting a downgrade from Loop Capital amid worries about promotional activity. That's just code for lower prices, guys.
All right, thank you very much. So after over a year of negotiations, the United States and China reached a Phase 1 deal Friday. Trade Representative Robert Lighthizer touted the deal yesterday and said it is, quote, totally done. Let's go to Washington and Yahoo Finance's Jessica Smith, who's got more for us on what happens next. Jess?
Well, Ambassador Lighthizer does say the deal is done. It just has to go through a legal and translation process at this point. He says China is agreeing to buying $32 billion in additional agricultural goods. He says they will over the next 2 years, and then they'll also try to buy an extra $5 to $10 billion each year. And in total, China is committing to $200 billion in additional purchases in ag, services, manufacturing, and energy. We should note China has not publicly committed to those numbers yet, but that's what the U.S. side is saying here. There is also a provision on IP protections, forced technology transfer, and currency. And while some argue the deal doesn't go far enough, Lighthizer says he's right where he wants to be. Let's watch.
Anyone who thinks you're going to take their system and our system that have worked in a very unbalanced way for the United States and in one stroke of the pen change all of that is foolish. The president is not foolish. He's very smart. The question was how big was the first phase going to be? This is going to take years.
President Trump has said that he wants Phase 2 negotiations to start immediately. Lighthizer says that he wants to see how Phase 1 goes, get that implemented first, and then move on to the next phase. He did not say how many phases there could be, but says he wants to get through Phase 1. He told me on Friday that he expects a signing sometime in early January, and he expects that to happen in Washington, though those details are still being worked out. The deal would go into effect 30 days later. Adam and Julie.
Jess, thank you. And joining us now to discuss is Eurasia Group Director for China, Michael Harrison. Michael, Lighthizer is seeming to sort of bring some rationalism to the process here, trying to manage expectations, right? But if you look at what the administration has been saying, particularly about those agricultural purchases, and what he said as well, there's been a lot of skepticism about that. Do you buy it? Do you think that it's a reasonable target?
I think the targets are very aggressive. The targets also are probably the part of the deal that matters the least to Robert Lighthizer and really broadly to the business community. He's much more focused on making these structural changes to China's economy that he discussed in the interview you showed. So I think his advisors, President Trump's advisors, are wrestling with this challenge. These purchase commitments are the part of the deal that matter most to President Trump. Most of the rest of the policy community and business community focused really on the substance.
But those purchase commitments, we heard, I think I was reading one article, 5 times in the past, the premature announcement that we had a phase 1 deal, the Chinese would begin buying, and they never did. Why do we think that's going to change this time around?
Well, I think now that you do have a deal that's agreed and you have a commitment on the U.S. side to remove some of the tariffs, will at least bring China into the market. And I think from Beijing's perspective, this is a pretty attractive deal for now. They don't get everything. Most tariffs are still in place, but they've reduced the risk of further escalation, and they haven't had to make really deep concessions on the issues that are really at the center of this trade dispute, particularly over technology issues. So for China to be able to purchase a lot of U.S. goods, much more preferable than having this threat of further escalation and having pressure to give in on tech issues in particular.
How likely do you think a full-on trade deal with China is announced before the election?
Very unlikely. I think you see just how difficult it was to make progress on this phase 1 deal, and these are relatively politically easy measures on both sides. Phase 2 deal is going to mean China, again, making some steps on issues like subsidies for its domestic technology firms. And on the U.S. side, it will require additional tariff relief, which is going to put President Trump under pressure to show that he's actually accomplished something in exchange for tariff relief. So the political bar is high. We head to an election, just throws in more uncertainty. I think very, very unlikely that we see a phase 2 deal before the election.
It's interesting that you point out the dichotomy between what the president wants and between what the business and policy community wants, because the markets seem to be on the side of the president in this case. Well, is that fair to say, Alessio? Because we see markets pushing towards record highs here, even as we don't necessarily have those structural reforms that Michael's talking about.
I think the market has we've been at this for 3 years, right? So the market knows that by now it has gotten accustomed to the fact that we're not going to have a binary outcome, that one day we sign the deal and it's either good or bad. We are at this for the long term. Under this administration, this is the new way politics are done. The market is now reacting very well, even to a deal that you could, if you analyze in details, you could see the flaws and you could say, okay, good progress, but the market is reacting well because this is happening at a critical time when the data globally is actually starting to rebound. So if you attribute the bulk of the data deterioration to the uncertainty around trade, and you are able to just remove the uncertainty and the probability of a further deterioration in these negotiations, especially after what we saw with Hong Kong, the market takes it very asymmetrically, right?
So what upsets the market as we go into 2020? We have a presidential election year. China has no reason to really budge or do anything till after the election. And we have a president who shoots from the lip. So what does the market need to be aware of as we go through the next 6 months, 10 months, full year?
I think it's really 2 things. So one is the possibility that phase 1 deal, phase 1 falls apart. Not my base case, but this deal is going to be continually under stress from tensions in the broader relationship. Hong Kong, we've got an election coming up in January in Taiwan, South China Sea, U.S. actions against Chinese technology companies. All of this is going to stress the deal. And for example, if these tensions really flare up, it's going to make Beijing that much less likely to step up and make huge purchases of U.S. soy and U.S. pork and other goods. So that's the first risk. Second risk, harder to quantify, is what happens outside of tariffs. I think the U.S. Trump administration and Congress are going to be throwing a lot at China, again, on technology companies, national security measures. Tech really is the focus here. Beijing is going to be doing similar steps to really reduce reliance on U.S. technology companies. So this is harder to quantify than tariffs, but has a big impact on U.S. tech firms for whom the China market is important, and Chinese tech firms and their global supply chain. So this tech war shifts further to non-tariff measures, and that's something that I think absolutely people, particularly in the tech sector, need to be watching.
And we will too, and we'll have you back to talk about it. Michael Hirson of Eurasia, thank you so much for being here. Appreciate it.
91 companies did not pay a dime in federal income tax in 2018. That's according to a new report from the Institute of Taxation and Economic Policies. Fortune 500 companies avoided $73.9 billion in taxes under the first year of President Trump's Tax Cuts and Jobs Act. Yahoo Finance's Kristen Myers joins us with the details. I got to imagine that this is going to be a headline, not just today, but for several days going forward.
Yeah, absolutely. So it was obviously a big headline when we all found out that Amazon had paid $0 in taxes on $11.2 billion in profits. And at the time we found out, actually Amazon's not alone. They had a lot of other companies joining them, and now we're getting this new report from ITEP that kind of looks at corporations and their tax avoidance. 91 companies essentially are also avoiding paying taxes. And this is from 379 companies in the Fortune 500 that are actually profitable. So these are all companies that should be paying something in tax, and they are actually paying $0. So it's not just Amazon, it's also companies like Netflix and Starbucks and Delta and JetBlue, who we have all done reports on that are doing pretty well, and they're essentially avoiding, the tax burden that you and I and everyone else has to pay.
I wonder how this has changed over time, because, of course, the argument for the tax reform bill in the run-up to it was that the U.S. as a nation, collectively, the corporations pay a higher tax rate than they do in many other countries. So it was a competitive argument, right? Were these companies also taking advantage of, there have been loopholes even before, right? Is it different? Is their tax structure different under this than it was before?
Right. So that's a great question. So the answer is both yes and no, right? So for a company like Amazon, last year was not the first year that they actually avoided paying tax. They had also avoided paying tax the year before, in 2017, before the TCJA was passed. However, we are actually seeing corporate tax avoidance increasing throughout the years. So from 2003 to 2015, 18 companies avoided paying taxes. And that number is just now steadily increasing over time to now we have over 90 companies. The corporate tax rate has lowered last year, or rather in 2017, the effective corporate tax rate, even though they were supposed to be paying 35% before, the new TCJA, they're only paying 13.5% roughly. Now that number is down almost 11.3%, roughly is that corporate tax rate. So they are avoiding paying more tax. They're getting more money back in refunds. That's according to the Treasury Department. And we're also now having more companies also able to avoid their.
Where's all this money going? It's clearly not in CapEx. What are they just buying back stock to pump up their stock price?
Yes, that is absolutely what they're doing. 2018 was actually the first year that stock buybacks actually increased CapEx. That was the first time that ever happened. Now, we actually have seen some bumps in CapEx. There has been an increase on, global capital expenditures. But frankly, we have a lot of headwinds in the economy. We are hearing a lot of companies coming out in their earnings calls and saying, listen, that there's a lot going on right now. We have the U.S.-China trade war. I know you guys were just talking about that. It's preventing companies from wanting to spend more. So they've been taking that money and they've been running with it. They've just been buying back shares. They have not exactly been investing as much into the economy as the politicians believe that they would. The deficit is just increasing. We added $2 trillion to our national debt with this new tax clause.
All right. Well, we're going to talk to a representative from that organization a little bit more about that report in the next hour. Kristen, thank you for breaking it down for us. Appreciate it. Coming up, articles of impeachment, how lawmakers are poised for an historic vote in Washington this week. Plus, boom or bust, why some of 2019's highly touted IPOs went from Wall Street darlings to major disappointments.
Welcome back to On the Move. I'm Jared Blickery. We got stocks at record highs again. The Dow is up 168 points, or 0.6%. S&P 500 is up a little bit more, up 0.8%. Nasdaq is up over 1%, and the Russell 2000 outperforming them all at 1.14%. Let's take a look at the 10-year T-note yield, because that is up today. It's up 6 basis points. We've had a lot of swings in this, and with this outperformance here in the T-note, we are seeing outperformance by value and cyclical stocks. Momentum stocks taking a little bit of a hit, underperforming as well as some of their counterparts in low volatility. We're also looking at the U.S. dollar index. Now, I'm going to take a one-year look here because this is a pretty important chart that we've been tracking. We are right at the lower end of this trend channel that has been in place for some time, and it looks like we're breaking down. So we've got to keep an eye on this. A lot of people had called for the dollar to break down back here and back here and back here. Never happened. We'll see if it happens this time. Let's take a look at the Dow heat map here. And we got a lot of green on the screen, except for Boeing. Boeing is down to critical support now. We don't want it to fall underneath 320. That would be bad from a technical setup. But lots of other stocks at or near record highs. Apple, Microsoft, JP Morgan, all those stocks outperforming. We also have United Health. That's up 2.76%. And now for the year, nice rally that started in the middle of October, beginning of October, and that's up about 18% year to date. So we're going to take a quick break, but we will be back in 1 minute.
Taking a look at the markets, the Dow, S&P 500, and Nasdaq all trading in the green as investors digest a mixed picture for stocks as we look toward 2020. Our next guest anticipates a strong year for the global economy, but says it will become more challenging for investment returns. Joining us to explain all of this, Nuveen Chief Investment Strategist Brian Nick. And Brian, I wanted to ask you about this because last week there were a lot of articles about the January effect. What we're witnessing right now, some people selling their stocks to take the tax advantage, intending to buy in January. What do you think? A good strategy? Are we seeing that juice the market a little bit?
Well, we may be seeing that juice the market. I think we're also seeing news that will tend to be beneficial to stocks. Some of the removal of some of this uncertainty around trade, around Brexit. I think that's what's really supplying this little oomph upward at the end of the year. I think what's interesting about the January effect and the idea that people are selling their stocks is we've seen individual investor flows out of equities all year. It's been the most powerful outflow that we've seen in a market that's kind of been rising throughout most of the year. A little bit more volatility than normal, but not a lot. So I'm not sure how many investors are really in a position now to say, I feel great about where I am. I'm going to be, selling stock in the new year. I think it's more a case of you might start to see sort of this fear of missing out rally in 2020 with investors, kind of individual investors, supplying maybe the next leg up in the rally if we get one next year.
Yeah, it seems it's almost like the narrative has shifted all of a sudden, right? Where we spent the bulk of 2019 asking ourselves, when is the next recession? Is it 2020? And when is it going to happen? Or is it 2021? What you're highlighting is basically there could be a sudden shift in sentiment here that the January effect could be even more powerful this time around. Is that what you're suggesting, that that's the risk?
I think the risk heading into next year is that we're already valued for this recovery or for the lack of recession. There's no reason to our minds that the U.S. economy needs to slow down. We think actually the global economy will accelerate next year, but we're priced for that. The last time we saw U.S. stocks at these PE ratios with the end of 2017 when everybody was pricing in the tax cut. Well, there's no tax cut coming in 2020. So what we're left with is relatively rich valuations, what we think is going to be a disappointing year again for corporate profits, and that leaves stocks looking a little bit toppy. So for us, I think it's going to be a more modest year. Even if we get a January effect, we think as the year drags on, the news isn't going to be quite as good for stocks as it is for the economy as a whole.
So that suggests then if there are retail investors who have been holding back this year and they finally say, oh, it's too good to resist, I have to get in, that perhaps, as usual, they're going to be timing wrong.
We still think that stocks will outperform bonds and cash next year, just not by anywhere near the margins they did this year. And actually, in our 2020 outlook, we pay specific attention to not just the outlook for 2020, but the 2020s. And stocks today, coming into 2020, into the new decade, look much more richly valued than they did coming into the last decade. So investors who have been sort of poised, sitting in even their index funds for the last 10 years, getting 13% a year, we think it's going to be about half that return in the next decade, even if you're invested the entire time.
Do you think the market has fully priced in the Fed's 3 rate cuts this year?
I think those rate cuts will continue to have a beneficial effect. We saw the home builder number this morning, just kind of blew the doors off the number, 76, all-time high. No point during the housing bubble in the 2000s did we see a number that high. So I think that's still having positive effects for not so much the consumer, but I think certainly for residential construction. I just think that cumulatively, the global easing this year has been more important than just what the Fed did. And I think that will continue to feed through in a positive way into next year, and I think decrease the chances we're going to have an abrupt slowdown.
For those of us who might be chicken little when it comes to equities, you talk about diversification and fixed income. What does that look like, especially with, people are raising alarms or at least red flags about the corporate debt load right now?
It really is diversifying somewhat away from corporate debt, specifically high yield, where we've seen spreads fall below that 350 level, which felt like it was sort of a point of resistance, and now we're down in the 330s. We're underweight that sector, but we don't want to be, going whole hog into treasuries.
What do you want to be in, though? So how do you diversify that?
Emerging market fixed income, securitized MBS. We still like the investment grade part of the market. We think relative to high yield, that looks relatively inexpensive and also safer. So we've been preferring quality, even though we don't expect there to be a recession. We just think growth stays low. We don't think any single asset class knocks the cover off the ball next year. But if you're in as many different games as possible with respect to diversification within fixed income, portfolio should do better.
I think that focusing on the perspective coming from credit markets and rates is actually even more important and expands to equities as well. You were alluding to the pricing effects. And the performance of stocks versus bonds in 2019. If you actually roll back 2 years, because 2019 started off of the low of the sell-off in 2018 in Q4. Mm-hmm. If you actually do on a 2-year rolling basis up to September 30, stocks and bonds on a global basis match their performance, which means that by and large, for the last 2 years, you have not been compensated for taking risk. Another way to look at it is actually the answer is in bond yields. The collapse in bond yields has inflated the valuations and the performance of asset prices, including equities on an outright basis. But when you neutralize for that effect, i.e. start comparing credit versus equities, if we do get an acceleration in the economic data, earnings will be the primary beneficiary, assuming we have no rate hikes. So there is, when you look at it on a relative basis, actually, paradoxically, I think equities have the biggest upside than any other asset class, assuming
and we'll see if some of that money on the side starts to flow in. Thank you very much, Brian Nick.
Thanks for having me.
Well, lawmakers are expected to make history on Capitol Hill as the House gets set to vote on the articles of impeachment this week. The House Judiciary Committee releasing its full report to the public today, explaining the charges being made against President Trump. Yahoo Finance's Rick Newman is here. I assume he has been pouring through the documents as he does.
There's no shortage of them.
Yes, exactly. So what stands out to you from the reports that we've gotten?
The report today is, there now are several reports along these lines. And basically this is just making the case in plain English why the House thinks President Trump should be impeached. And they are going to impeach President Trump this week, it sounds like. There could be a small number of Democrats who actually don't vote for impeachment, but the Democrats have a 36-seat majority in the House, so they can afford to lose a few seats and still impeach him with a solid majority. And then, we kind of know that the beginning of 2020 is going to be the Senate having a trial.
What does that trial look like? There were the articles over the weekend and last week that Mitch McConnell is coordinating with the White House, yet he's the jury, he's one of the jurors. That looks a little bit, can you do that? And the next one is this possibility that he may not allow any witnesses. Can he do that? Or could The Democrats go to Chief Justice Roberts and say, we want to subpoena. Could the Chief Justice then issue subpoenas? I mean, I'm not a lawyer, so.
Well, I mean, there's no clean template for this. I mean, a lot of it is what the Senate decides to do. And it's the catch here is the Republicans have a 53-47 majority in the Senate. But that means if there are 3 Republicans who think there should be witnesses or the trial should go in such a way, then they have a lot of power to say that's how it's going to go. So, think about people like Mitt Romney, right? And some of the, we know the more moderate names, Susan Collins, and Lisa Murkowski of Alaska, and there may be a couple others. Yeah. So if you get enough of them saying to Mitch McConnell, we're not going to go along with the total whitewash here. We want this to be a proper trial. We want to have some witnesses. You could get them. And one of the things to watch for. So the conventional wisdom is that there's a foregone conclusion here, which is that the Senate is not going to convict President Trump. But what if John Bolton testifies and we learn something else that's explosive? Who knows what might happen? So even if the Senate does not convict, we could still learn new information that impacts the 2020 election.
Alessio, as an investor, presumably your base case is that there is no impeachment, that the Senate does not vote to approve impeachment. Do you assign some level of probability that it does happen? Because presumably that would be a market-moving event if indeed it happened.
I think you can certainly attach a probability. When we look down at the numbers, suddenly the probability doesn't look that low, right? But ultimately the question is, and then how should the market react? Because you can draft so many different scenarios of why this could be good or bad for different candidates at the next election. Ultimately, obviously, impeachment does not have any economic impact. It only has an economic impact if you go really through the indirect channels of confidence and the altering the outcome of the election. And we have already conditioned so many layers on this that the investment visibility of this outcome becomes very little. Will you have some volatility? Absolutely. But I think it's one of those things that you use as an opportunity to stick to your strategy, because there is very little economic medium-term information in this.
Let's say the odds of the Senate convicting Trump are, let's say 5 to 10%. What if that happened? Well, then Trump left office. We would have President Mike Pence. And I don't think any substantial policy changes would happen. If anything, he might ease up on the China tariffs, for example. So, to my mind, even if President Trump leaves, should not be a market-moving event. It probably would be for half a day, but Mike Pence would be just as friendly to markets as Trump is, and maybe even friendlier.
Interesting. All right, Rick Newman, thinking several moves in advance.
We're going to have a great civics lesson in 2020.
I love it, and you'll be here to provide it for us. All right, coming up, the UK's Boris Johnson faces an uphill battle as British manufacturing hits a 7-year low. Plus, before we go to break, let's take a look at some of the top trending tickers on Yahoo Finance today. We talked about Boeing; those shares down more than 3%. It is just after 11:30 a.m. here in New York City, about 2 hours into the trading session. We've got a rally going on in stocks, particularly strong in the tech-heavy NASDAQ, which is up by 1%. Let's look at oil prices as well today. It's interesting because we've got energy stocks higher today, even though oil's not moving that much. It's up about 1/3 of 1%, but it is above $60 a barrel, $60.27. Boris won. Now what's next? Where things stand in the UK following last week's historic election. Big year or troubled start? We're breaking down the top fads from the 2019 IPO market and royal status. Queen Elizabeth is in the market for a social media director. Find out how much it pays to wear that crown. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Glad you are with us. It was supposed to be the year of the unicorns. 2019 brought the public debut of some of the hottest, most anticipated startups. But while the Dow broke record after record this year, some newly public companies were left in the cold. So let's look back at some of the biggest fads of the IPO class of 2019, see how they performed. Dan Howley joins us with the grades and the scores. Dan?
Yeah, 2019 gave us some of the most high-profile IPOs in years, and while some soared, others, well, tanked. And between the Beyond the Meats and Ubers, some clear trends emerged. And we'll start, of course, with the unicorns. We're talking about the likes of Uber, Lyft, Smile, Direct Club, Pinterest, CrowdStrike, Zoom, the list goes on. And some of these companies even managed to make money. Go figure. But others didn't. Uber was off 38% from its IPO price as of December 9th, while Lyft was down 37%. Smile Direct Club was even worse, down a staggering 64% from its IPO list price. Zoom, however, was up an impressive 83%, and CrowdStrike was up 44%, and even Peloton was up 20%. From its IPO, despite that terrible commercial that we all know about now. Enterprise software also had a huge 2019, thanks, of course, to Slack, CrowdStrike, and Zoom. And PagerDuty, CrowdStrike and Zoom obviously did well, but Slack has fallen 8% from its IPO price because of slowing growth and competition from Microsoft and its Teams software. PagerDuty has dropped 2.4%, and like many of this year's big IPOs, it just isn't profitable. China also had a big year for the IPO market, with some of the biggest gains coming from Luckin Coffee. The company stock is up more than 78% since it's debuted, and it's not slowing down, but it is incinerating cash as it continues to open more and more stores in China. And there's also China's Douyu, a game streaming service similar to Amazon's Twitch, and unlike Luckin, that company's stock has plummeted 38% since its IPO. The reason? Stiff competition, and of course, it's not profitable. And biotech and pharmaceutical companies also had huge IPOs in 2019. 10x Genomics, which produces gene sequencing platforms, saw its price jump 62%, and Bridge Biopharma, a clinical stage biopharmaceutical company that works on genetic diseases, is up since its launch 117%. That's pretty bonkers.
Yes, indeed it is. So, interesting year for IPOs, to say the least. Kathleen Smith, Renaissance Capital's head of the IPO ETF, joined us now to talk more about these companies. So, interesting. Maybe we live in interesting times. That's the old proverb. For IPOs, it definitely was an interesting year. What really stood out to you? What was the highlight for you of all of these unicorns that Dan just went through?
Well, I think certainly we can say what Dan said. It's been the best of times and the worst of times in the IPO market. We are finishing up the year ahead of the S&P 500 based on the returns on the IPO ETF. But in between, we've had some major disappointments, including Uber, Lyft, large deals that have just fallen flat on their face. And the markets absorb those, and actually the IPO market learns lessons from those kinds of IPOs. And basically the market said no more when WeWork then tried to come out. And that's a good thing. The public markets have a certain amount of discipline in them. Usually you expect the IPO market to be the party place, but it isn't. And so it's a lot more cautious. And I think that sets a good tone for what we're going to see in 2020.
And what is that tone in 2020?
Well, we're going to start out with a very big private company that's going to tap the IPO market, and that's Airbnb. They have a very high private valuation of 30-some billion. And instead of going the regular way of an underwritten IPO, Airbnb is going to try to do a direct listing. Now, we have some experience, and the market learns from direct listings how they do, and they haven't done very well. Slack had a direct listing, and it hasn't traded well. Maybe in part, Dan mentioned about competition with Microsoft, but it's our belief that the direct listing hasn't been a great mode of going public for investors, maybe just fine for the companies that want to sell at the highest price, as many shares as they can. So we have that, and we also have Spotify that tried a direct listing. So a very important IPO that's going to happen early on in 2020 is going to be Airbnb. And then we expect to see the lineup as all these unicorns, we have 200 or so worth $1 billion or more privately that are anxious to get liquidity. And the IPO market's kind of a picky place these days. So it may be a buyer's market. We're enthusiastic about 2020.
When do you think Grubhub hits it? That's kind of like the next one. It's Airbnb and Grubhub are the big ones that people are kind of looking out for. And then maybe whatever happens to WeWork, or if they decide to eventually try it again, probably not. But where do you see Grubhub?
Stripe, there's social finance. There's just a huge number. So we're expecting them to try in 2020. And the other thing about 2020, it's an election year. And usually in election years, the IPO market kind of gets pretty choppy toward October and November. And so we're thinking that a lot of companies are going to want to try to rush to get to market in early part of 2020.
By the way, I think you mean Postmates.
Yes, that's what I meant. Yeah, my bad.
Do you get the sense that the market is willing to, or the market has priced in another year of losses for these big name companies? A lot of these stocks have traded down. We know mall losses are coming next year, but at one point does the market say, you know what, okay, we know Uber is losing money, we're going to try to get in here and maybe pick the bottom?
Yes, I think that's the whole part of price discovery. Mm-hmm. And for us, it's been two things that we've had to overcome. One are the companies with a lot of losses. But the other thing is companies that are really overvalued. And basically, if you look at Uber and Lyft, you have to say the valuations are way too high when they went public. Why would they be trading over 30% below their IPO prices now? So it's that combination. So at least if you present yourself to the market and you have the opportunity to have earnings, or at least near-term earnings, you've overcome that one. Then the other thing is valuation. And the IPO, all markets, if it doesn't work for the buyers go on strike. And so it has to work for buyers to make money.
It seems that what you're describing is actually a fairly healthy market. What does that tell us about the broader market? Is that maybe this narrative is very different from the narrative we're at all-time highs and growth is weak. This is the next bubble to pop. This has always been a very important market to look at for signs of exuberance. What is your take on that, given how you compare this market to the history of this market?
It's definitely not the irrational exuberance of 99, 2000. Things are flip-flopped. We actually think the irrationality may be happening in the private market, where valuations are just so high, and the public market saying, wait a minute, this doesn't make sense. So in my career, I've never seen this kind of dynamic happening. It used to be, of course, the company would go public at 3 times its private valuation. We have companies now going public well below their private valuations. That is something that is rarely seen, and we think that if you're worried about the markets, you need to look at the private markets. If there's a liquidity crisis, it's going to be in the private market that can't get out of its investments there. It's not, so we're worried about that part of it, and we think that the public markets are doing a pretty good job of being rational right now.
All right, so that private market liquidity is something else to watch out for in 2020. Kathleen, thanks for being here. It's always great to see you. Kathleen Smith of Renaissance Capital. Thank you.
Coming up, why Brian Sozzi says this holiday season could end badly for retail investors. Plus, before we go to break, take a look at some of the biggest winners on the Dow today.
Let's take a look at some big movers in midday's trading in our stock spotlight. We've got a big deal. It's affecting one of the stocks involved a lot more than the other. DuPont there, not moving much in today's session. It is combining its food and nutrition business with international flavors and fragrances. It values the DuPont unit at about $26.2 billion for a combined company of $45.4 billion. Now we've got IFF shares falling pretty sharply today, and analysts are saying perhaps this was an overvaluation of that DuPont unit, especially since IFF is still digesting an acquisition it made of an Israeli company for about $7 billion that it made in the past year. So those shares getting punished in today's session on the back of that big deal. We'll be right back. The UK economy continues to struggle, according to a closely watched private sector survey of business activity. That data pointing to a nearly 3.5-year low for growth as manufacturing in the country sees its lowest output since 2012. Joining us now, Yahoo Finance's Tom Belger in London. London, that's what I call you as your nickname, Tom. What's sparking this downturn? I have a feeling it starts with B and ends with T.
Well, that's right. You won't be surprised to hear. I think it's worth noting first the pretty big contrast between these figures and the mood on the markets right now. If you look at the FTSE 100, FTSE 250, they are soaring on the back of the Conservatives' election victory last week, seemingly brushing off these figures. The figures are partly about the global economic slowdown, not just Brexit. That's clearly hit demand, manufacturing particularly struggling around the world. But as you say, heightened anxieties over Brexit continuing to dent the UK economy. Business investment and consumer confidence in particular have been held back by a lack of clarity about where Britain is going. Manufacturers, they've also been still unwinding the stockpiling they did in the lead up to Britain's previous Brexit deadline in October. So some analysts are saying these figures point to growth flatlining in Q4 and saying it slightly ups the chances of a rate cut if these things don't improve in the near future. Other analysts, though, slightly more wary, pointing out the PMI figures before have tended to be more pessimistic than the official GDP figures. And crucially, this survey was done before the UK election when there was less clarity. Now, we're potentially far more likely to see the UK leave the EU on the 31st of January.
We want to dive into the UK just a bit more and the disappointing economic data, which may reflect some nervousness in the run-up to last week's election. Even though Prime Minister Boris Johnson delivered that decisive victory, there are a myriad of questions that remain over the country's future relationship with the EU. Let me start with you, and let's talk about the EU in general. The IMF said that growth next year could go back to 1.8%. Do they get this right? What might we be missing?
I think that the balance of risk is tilted now towards growth surprising to the upside. We've been on the cautious side for the bulk of 2019, to be honest, but the evidence is really shifting. In the last couple of months, we're seeing a very clear rebound in the economic data, not only in Europe, but also actually led by emerging markets. And it seems to, as per the typical relationships of the past decade, it seems to start showing up in the large open manufacturing economies, Germany, Netherlands, and so on and so forth. So the the evidence is that we could have a surprise upswing and front-loaded returns maybe for risky assets in 2020, because that's the theme that you're going to trade until maybe June or July, when the election in the US will take front and center. So I think that's the outlook also for the UK potentially.
Are you surprised to see European stocks trading at record levels? To me, I'm surprised I haven't heard more concern about the EU just being completely blown up.
So, again, similar to what we discussed earlier, the performance of EU stocks makes a lot more sense if we start spreading it to what has happened in the US or globally. European stocks have underperformed the US for a decade. So if the US and global markets represent a little bit of that beta that lifts everything, just like the S&P 500 provides a beta to any single stock, European stocks, I think, have the potential to outperform, to begin the next decade of basically non-US assets outperformance. So I'm less convinced about the outright performance of US stocks, but if one has to think about a relative valuation, European stocks provide a little bit more cushion in case we're wrong.
When you talk about the EU and you talk about the UK, once they are formally gone, will we see a scramble from each individual country to negotiate the new deals with the UK?
Unlikely. I think the EU will, if you're referring to other to countries within the EU, that's said and done. It's going to be a relationship that the EU will face altogether. Will there be some interesting developments, maybe in the bilateral trade developments between the UK and the US and Canada and other parts of the world, and how those may affect the relationships that then the EU may need to restrike with the UK. By and large, I think it will be a relatively fluid situation, but the EU has no option than to face this as one block, one political block.
All right. Well, coming up, the severe winter storm that's bashing the Midwest is moving east with the potential to threaten 40 million people. Plus, looking for a job, this one pays $67,000 a year, includes free lunch, and gives you first row seats to the drama of the royal family. Protests over a new citizenship law in India are becoming more violent. The law permits expedited citizenship for migrants who are Hindu, Christian, Buddhist, or Sikh, but it does not include people who fall under Islam. India is home to 200 million Muslims, 14% of the population, and critics call that law a threat to India's secular democracy. A strong winter storm bashing the west and center part of the country is moving east. 13 million people from Colorado to Connecticut right now are under winter storm warnings, but that could increase to almost 40 million by day's end. The storm has caused several accidents and the deaths of at least 6 people. California Governor Gavin Newsom says bankrupt Pacific Gas and Electric's plan to emerge from bankruptcy falls woefully short of safety standards and, quote, do not result in a reorganized company positioned to provide safe, reliable, and affordable service to its customers. The utility has until the end of Tuesday to amend its reorganization plan. A job posting on LinkedIn says England's Queen Elizabeth is looking for a social media director. That job pays £50,000, roughly $67,000 a year, and includes free lunch. The job listing says, quote, it's about never standing still and finding new ways to maintain the Queen's presence in the public eye and on the world stage. This is what working for the royal household is exceptional. Cheerio. We'll be right back.
It's time for Word on the Street, where we check in with our panelists and find out what stories they're watching. Brian, you're saying retail investors could be disappointed this holiday season.
Yeah, if you pull up the stocks and a lot of retailers, they have started to underperform a market by most accounts that is melting up. So the likes of Macy's, Kohl's, underperforming here. And a lot of the sources that I've talked to so far, promotions year over year in the malls, specifically the apparel retailers, are higher year over year and very significantly.
But these are the ones that were already doing poorly. I mean, aren't we still seeing this sort of bifurcation within retail?
Well, I think if you're a Target, you're a Walmart, you're still having a somewhat decent holiday season. I think a lot of the promotions in the malls, it's in the malls that is, especially in the apparel, winter apparel, they're higher year over year. And I look at JCPenney, go on their website right now, they're offering up to 83% off select jewelry. So I think a lot of retailers came into the season, the weather hasn't necessarily been cooperative. Also, like we've been talking about all season, 6 fewer days this holiday season. A lot of retailers have pushed up their promotions. They want to clear the goods and they want to clear them out right now.
Let's say, what are you watching as we head toward 2020?
The two fundamental propositions going into 2020, if these two assumptions hold, that we're seeing a global cyclical rebound in the data, and the Fed, and if we believe Powell that rates are not going to go up for the next 2 years at a minimum, these two combined, I think the themes that result from that are potentially a much stronger year for stocks than we expect, given the mentality of we're still at the end of the cycle, I think it could be a front-loaded return year in 2020 before the elections takes a hold. Where should that manifest itself? Potentially the two biggest rotations that we've been waiting for over a decade, from growth into value and out of U.S. assets. In other words, beginning to see the outperformance of emerging markets and developed markets outside of the U.S., as we discussed earlier. Those would be the two major forces that we're looking for a confirmation in the first few months of 2020.
All right, interesting stuff. We'll be watching all that, and we'll talk to you, of course, in 2020. If we don't see you, have a great holiday season.
And to you guys as
Alessio,
well.
thanks for being
Thanks,
here.
Alessio.
Coming up, trouble in the skies, why Boeing could halt production of its 737 MAX airliner. Plus, we have a deal inside President Trump's Phase 1 trade deal with China. It is noon here in New York City, about 2.5 hours into the trading day. Stocks are rising today. We're seeing some record levels, are we not, for the major averages? Is it really a done deal, though? Questions still swirl around the U.S.'s Phase 1 trade agreement with China. Boeing fallout. The company considers suspending production of its 737 MAX jet amid uncertainties about its future. And taxing questions. A new report claims Fortune 500 companies avoided paying over $70 billion in taxes during the first year of President Trump's new tax law. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We're going to talk about Boeing. It's troubled for that company. The company is considering suspending or cutting back production of the 737 MAX as uncertainty grows over the plane's return to service. Let's introduce this hour's panel. Technalysis Research President and Chief Analyst Bob O'Donnell is with us, and Yahoo Finance's Brian Sawsey is still with us. And Bob, you were pointing out that there's something that folks might miss in the Boeing story. We focus on the planes, but it's something...
Well, if you look at the fundamental issues that were the cause, unfortunately, of these crashes, it's software. Right? This is essentially autonomous plane software. We always talk about autonomous cars, but a lot of the factors here are around the software and the issues and challenges of dealing with that software. And so in the same ways that there's been concerns on the autonomous car side, this is an autonomous plane software problem. And it's interesting because as someone who's, for example, tracked the autonomous car developments, there have been discussions about how, look, we've had autonomous software in planes for a long time. The difference, of course, is that planes were relatively isolated from each other, generally speaking. But it does just speak to the fact that as we move, forward on these devices, everything is now tech-driven, everything is now software-driven, and the impacts that stuff can have, and the way that side of it needs to be thought about and regulated is going to be a lot different than I think what we've seen in the past.
And do you think if you are looking at in parallel with the auto industry, it seems like the auto industry has had a challenging time getting it right.
Absolutely. I mean, look, remember, just 2 or 3 years back, we were all going to have autonomous cars by now, right? Yeah. And there are going to be less cars on the streets and blah, 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 right? None of that is happening, right? And fundamentally, even if we look at Uber and Lyft, the whole long-term profitability of those was the fact that they were going to get rid of the drivers. Well, that's not happening for a while. So that raises those. I mean, there's so many questions that could raise because these problems are really hard. They're extraordinarily hard to solve, and it's going to take people a while.
Brian, though, as we go, into Boeing, if they don't get that plane, if they have to stop production or even cut back more production, that trickles through. I think I've read 600 different suppliers. That would include perhaps some of these software. I don't know if they write their own code, but
I mean, you're looking at a real economic effect here. And look at GE. GE has direct impact by this Boeing situation. If you're GE, this is the last thing you need is a Boeing production shutdown.
Yeah, the engines, right?
Engines, yeah.
All right, well, let's turn to what's going on with the trade deal. After over a year of negotiations, the United States and China reached a Phase 1 trade deal on Friday. Trade Representative Robert Lighthizer touted the deal yesterday and said it's totally done. Let's go to Washington. Yahoo Finance's Jessica Smith has the latest. They just need, translation and legal work to be done on the details. Right. Lighthizer says that they need to go through a translation process, and then the lawyers need to scrub the deal to make sure everything is set. But he says all of the obligations are done. He says it's 86 pages long and completely finished. He does expect a signing sometime in early January. Now, he says that China has committed to buying $32 billion more in agricultural purchases over the next 2 years as part of this deal. They will also try to buy an extra $5 to $10 billion each year. He also says in total that China is going to buy $200 billion more in U.S. exports in manufacturing, ag, services, and energy. He also says that there are provisions on IP protections, forced technology transfer, and currency, but some are arguing that there's not enough in this Phase 1 deal. Lighthizer defended the deal over the weekend and said he's right where he wants to be.
Take their system and our system that have worked in a very unbalanced way for the United States. And in one stroke of the pen, change all of that is foolish. The president is not foolish. He's very smart. The question was, how big was the first phase going to be? This is going to take years.
President Trump says that he wants to start phase 2 negotiations immediately. Lighthizer says he wants to get phase 1 implemented and see how that goes first before moving on to phase 2. He didn't have a date for when that might start, and he didn't know how many phases that could entail. Again, he's focused on getting phase 1 implemented first. It would go into effect 30 days after it's signed. Adam and Julie.
All right, thanks, Jess. Joining us now is Ohio soybean farmer Christopher Gibbs and Yahoo Finance's Adriana Belmonte, who follows trade headlines for us. And let's start with you, and welcome. It's good to have you here in studio.
Thank you.
What do you think of the deal and the promise to buy agricultural goods? Because they haven't delivered in the previous 5 promises to buy agricultural goods.
I think that's the point. It's simply a promise, and we don't know what we have here. And I think for your viewers, they need to use a benchmark of about $23 billion that we were doing in agricultural trade with China prior to the war on trade that we're in the middle of. So anything that comes out on an annual basis, benchmark it against the $23 billion that we were doing in the agricultural industry with China. So is it 50 billion? Okay, that's fine. But is that over 2 years? Well, if it's over 2 years, then that's hardly any increase at all. It doesn't account for anything that we've lost over the last 2.
And have we seen more structural changes that aren't going to reverse themselves? I've seen some analysis to that effect that because of the way supply chains have shifted, even if China's making these promises, I mean, I don't know what the enforcement mechanisms are, for example. So are they still going to be buying soybeans from Brazil, for example?
No, supply chains is the real change here that that agriculture worries about. Supply chains have changed. China's buying more from Brazil. My goodness, they're buying some from Russia, for heaven's sakes. Not a lot, but that's more of probably a political antagonistic move. But these supply chains, in our view, or excuse me, in my view, I should say, I will just represent myself, probably have shifted and changed for the next generation. Now, it's going to be a long time before we get these back.
So farm bankruptcies, they've spiked over the last year and a half since the trade war began. And these people who have gone bankrupt, they're not going to be able to see any of this money essentially to help them. So what have you seen in your own state of Ohio among the farmers?
Well, there's certainly a lot of tension, and you've hit on exactly where I really wanted to start with this conversation, is that this war on trade affects real people. It affects real farmers and communities with bankruptcies, increases in nationwide in suicides. And one thing that the Ohio State University has done that I've never seen, I'm a graduate of OSU, that I've never seen is focusing on stress management right now, just new programming out, stress management for farmers. Now, it isn't all trade related. We've been through a terrible crop year. I mean, with the rains and et cetera, couldn't get our crop planted. We were late on down the road. But to add to that, the trade tension, this affects real people, and that's what your viewers need to understand.
Have you made a decision, because we were talking to you last time you joined us about whether or not you would run for Congress. Have you decided yet?
Certainly we're still in the exploratory phase, and I don't mean to be coy with that. The intention here is not to make a political statement. The intention would be to move forward. But I want to be data driven, and to do that we need to continue to do polling and to make sure that that if I'm going to make this run for Congress, that I do it, because the margin for victory certainly is very, very narrow in the 4th District. But agriculture is something that has been overlooked for the whole term of our current congressman. And so I'm going to change that.
So I know that you're still in the exploratory committee phase, but if you were to run and you were to get elected, now that we have a phase 1 trade deal, what would you make your next priority in terms of U.S.-China trade relations?
There's no doubt that China's been a bad actor, okay? My proposal is this, that number one, and we talked before, agriculture is a national security interest, plain and simple. It needs to be treated that way, and never should we be put on the front lines like we have now. So I would think that we need to gather our allies that, by the way, we have tariffed them to death also. it's like this. The beatings will continue until morale improves. Well, that's where we're at. We have to knock that off, because to take on China, it's never going to be just a singular U.S. taking it on alone. It's going to have to be a set of allies. And you know, we had that framework in the Trans-Pacific Partnership. We had them surrounded. It wasn't going to be the end all, but we had that framework of partnering allies that we could have gone after China then and got those real structural reforms that not only agriculture needs, but also business needs as well to move forward.
Chris, I want to ask you about something that a turn of phrase you used that I haven't quite heard before. Instead of calling it the trade war, you called it the war on trade. And I don't know if that was just a slip of the tongue, but it was interesting to hear it framed in that way, in that sort of adversarial way. When you talk to your potential constituents, your peers in Ohio, do you think sentiment has shifted against the president as a result of this war on trade, as you call it?
I think there's some real fissures there. Now, they're very minute, okay, but those always crack before the whole thing crumbles. Farmers historically I should say over the past 2 years, have been supportive of the president. I feel like I'm on an island a lot of times, that I'm the only one that's been outspoken. But I'll tell you what my anecdotal evidence is that it's not necessarily the farmers that the president needs to worry about. The farmers who are normally the man, the operator is normally a man. That's changing rapidly, but as a rule it is. I think it's farm wives. And what I've talked to farm wives, and what they're looking for their farms, when they look out over the horizon, they want some predictability, and they don't want to see storm clouds. For their farms, for their families, and moving those farms on down through the generations. And the administration has failed on both of those for family farms. So my prediction is this, is that farm wives are a place where the president has some real vulnerability, because those farm wives, when they go into the ballot box, they're going to use this pen like a samurai sword. Just like that. That's my prediction.
All right. Ohio soybean farmer Christopher Gibbs, good to have you here on The Move. Come back anytime.
Thank you.
Yeah, great to see you in person. Thank you. Well, Micron's one of the best performing stocks in the S&P 500 right now. Scott Gamm's on the floor of the New York Stock Exchange with some details for us. Scott?
Hey there, Julie. Well, the stock right now is up about 5% on the heels of an upgrade from Susquehanna Research, basically saying that industry dynamics are improving for Micron. Now, even with today's gain, the stock is still up more than 60% so far this year, and you're even seeing a boost in other semiconductor names. We talk about this a lot, how when one stock in a sector goes up, you tend to see most of the stocks in a sector go up, largely amid investors buying groups of stocks at the same time. Also keeping an eye on shares of PG&E. They're down about 9% right now. Earlier this morning, they were down almost double that amount. The stock right now is a hair above $10 a share, but regardless, the declines coming amid California's governor basically saying that the restructuring plan that has been proposed for PG&E does not meet the standards for regulators, so some uncertainty there with the stock today. And then finally, Urban Outfitters. The stock was down more than 1% this morning, but it's since turned positive, even as the company gets downgraded by Loop Capital, which is now worried about promotional activity with its products, and that's just code for lower prices, guys.
Scott, thank you. 91 companies didn't pay a dime in federal income tax in 2018, according to that new report from the Institute of Taxation and Economic Policies. Fortune 500 companies avoided $73.9 billion in tax under the first year of the Trump Tax Cuts and Jobs Act. Joining us now is one of the authors behind that report, Matthew Gardner, and Yahoo Finance's Kristen Myers is with us as well. And Matthew, let's start with this report. The headline makes us all gasp, but then the counter sometimes is that, well, these companies do pay taxes. It's just not the federal income tax, but they pay a Social Security tax and they pay into Medicare. What do you say to the critics who say that perhaps when we talk about your report in the headline, we're missing something? Or are those critics missing something?
Well, we all pay many different kinds of taxes. The difficulty with that argument in this case is that there is one principal tax that profitable U.S. corporations are supposed to pay that represents the lion's share of their contributions to help pay for public investments. It's the corporate income tax. And so when you see a small number of the very most profitable companies avoiding all involvement with this principal tax, that's a real problem for the U.S. budget.
Matthew, talk to me about how this has changed over time, because I know your analysis in this report focuses specifically on the latest tax changes to tax law enacted by President Trump. But I mean, it seems like it's a pretty old problem that corporations have been taking advantage of loopholes.
It's a very old problem. What has not changed is that companies now, as was true 2 years ago, 10 years ago, appear to be avoiding any tax on about half of their income overall. Whatever the legal tax rate is, the effective tax rate, that is their overall tax as a share of their profits, pretty much half of that. That was true then, it's true now. What's new now is that we have a statutory tax rate, a legal tax rate, that is way below what it's ever been in modern U.S. history at 21%. This is the result of the 2017 tax cuts engineered by Congress and President Trump. And the hope a lot of people had, those who want a sustainable corporate income tax, was that this reform, as it was called in 2017, would do two things. One was to lower the rate, but the other was to broaden the tax base, getting rid of loopholes so that whatever the sticker price was on the corporate tax rate, whether it was 21%, the 15% that President Trump wanted, or the 35% that it was before, companies would actually pay it. And so pretty clearly that has not changed. Companies are still finding ways to avoid much, if not all, of the tax they ought to be paying.
So, Matthew, how exactly are companies able to avoid paying taxes on their income?
The first thing to say about this is that it appears to be entirely legal. It appears to be the product of tax breaks that Congress has enacted over time at the request of these same corporations. There's no indication of legal wrongdoing. Tax breaks for capital investment appear to be a big part of it. Accelerated depreciation, which got expanded to something called full expensing in 2017, letting companies immediately write off the cost of their capital investments, appears to be a major driver in these results. There's a tax break that allows companies to write off the cost of executive stock options, which for many companies is big. R&D tax credits. Tax breaks for producing alternative fuels, tax breaks for producing conventional fuels. You know, there's a whole host of tax breaks in the code that collectively have this pernicious effect of substantially reducing the taxes paid by the most profitable corporations. I think it's important to add that this doesn't exonerate these companies from wrongdoing, the fact that they're using legal tax breaks. First, many of the same companies, Amazon, Facebook, Microsoft, Apple, have been accused and are currently embroiled in legal suits over what appears to be illegal tax actions offshore, shifting their profits to other countries. This is not that, but those allegations are still out there and are still being investigated.
All right, Matthew Gardner, Senior Fellow at the Institute of Taxation and Economic Policies. This is going to get a lot of discussion, especially with us heading towards an election. We appreciate your being here and hope you can come back.
Thank you.
Coming up, Prime Produce. Amazon gears up for new grocery stores next year. We're checking in on where the progress lies. Plus, take a look at some of today's trending tickers on Yahoo Finance. We've got Amarin on the decline, that biotech down by about 4%.
Welcome back to On the Move. I am Jared Blickery, and we got stocks still at record highs. The Dow is up 183 points, about 2/3%. S&P 500 up now 0.9%. NASDAQ up even more, over 1%. And the Russell 2000 really just outperforming here, up 1.2%. This is the S&P 500 price action for today. You can see we just hit new nominal highs, kind of leveling off here, but just shy of that 3,200 number, which the futures for March settlement actually hit a little while ago. Here's the Russell 2000, another breakout day for this index. Let's take a look at it year to date. And we can see it's really snapped up recently here, and it's only about 5% off of its record highs, definitely outperforming this quarter. Let's take a look at the 10-year T-note yield, because that is up substantially, 6 basis points. Now, if we look at the year-to-date action, looks like it's kind of consolidating in here. If this factor rotation is going to continue into value and cyclicals, probably need this to rise. A lot of people have 2 to 2.5% as their price targets. So we're going to take a look at the NASDAQ 100 here. Apple at a record high, up 2%. Alphabet, same deal, up 0.7%. Microsoft off a little bit less. Only Amazon in the red here. Facebook up 1.7% after being down substantially over the last 2 days, but still pretty close to its 2019 high, up 50% for the year. And let's take a look at Baidu. These internet names have gotten a jolt recently, and they had been underperforming for most of the year, just starting to come back right now. We're going to be back in 1 minute.
It was always going to be in phases. The question was, how big was the first phase? Anyone who thinks you're going to take their system and our system that have worked in a very unbalanced way for the United States, and in one stroke of the pen change all of that is foolish. The president is not foolish. He's very smart. The question was, how big was the first phase going to be? This is going to take years. We're not going to resolve these differences very quickly.
That was U.S. Trade Representative Robert Lighthizer appearing on CBS's Face the Nation Sunday. Lighthizer praised the Phase 1 trade agreement with China, reiterating that despite the criticism, it is a done deal. Regardless of where things stand, our next guest says you should avoid trading on the headlines, calling it a fool's game. That's a quote. Joining us on the phone is SMH Group CEO George Ball. George, thank you for being here. Robert Lighthizer is no lightweight, so why are you saying don't trade on the headlines when he's saying done deal Phase 1?
Well, I think that there are two reasons for it. One is there have been deals that have been done, undone, redone, and then cantilevered from that. And that's part of any trade negotiation. The problem from the standpoint of the investor or the trader is that it's a flip of a coin as to what's coming out next. You don't know if there's going to be a Trump tweet tantrum, whether there's going to be something from the Chinese side. So you're trying to guess what the flip of the coin may develop. That's just foolish. You've got the friction costs of trading, and you've got no better than an even chance of being right. Don't try to trade the tariff momentum of the moment. It doesn't work.
Well, George, what you do say is trade the momentum full stop that we're seeing in the market. In other words, follow the trend. And the trend does seem to be, at least for the moment, and from a layperson's perspective, pretty firmly upward.
I absolutely agree that you should not, on the one hand, try to trade the tariff mood or the next tariff statement, you should trade the trend. Now, between now and the end of the year, the trend is sharply upwardly biased. There's a reason for that that's a little bit hidden from the normal view. Traders on Wall Street get paid bonuses based on their profits, generally computed at the end of the year. When you've had 3 quarters of strong markets, S&P up about 26%, a little bit more now, traders have large bonuses that are accrued, but they're not payable until the end of the year. Therefore, traders have a strong tendency to buy the stocks or the bonds that they've liked that are profitable to make sure that their bonuses don't wither between now and Christmas and New Year's. If you look back as far as 1970, there have been only 3 times over all those years when the market's been up at the end of 3 quarters and has not ended up even higher at the end of the 4th quarter. I'm not saying there's anything wrong with the traders protecting their bonuses. They're buying things they like, but that's human nature.
So, but as we move into 2020, how do we start to think about some of these tariff issues? I'm particularly looking at the tech market because there's a lot of fear and uncertainty around what could happen with the tech industry overall, not just from the tariffs, but from the political repercussions that they're creating in separating U.S. tech versus Chinese tech.
There's an interesting dichotomy. One is if you look at the color-coded charts of what sectors of the market do best from one year to the next, there's no continuity. The favored sector of last year is the least favored sector, or one of the least favored sectors of the next, and that's happened time after time. Clearly, technology is a driver of not all, but many of the good things that are going on in the world today. Technology is creating positive change, but the Nasdaq is up 32% when the S&P is up 26%, and the Dow is up 20%. I think that the cautious investor may want to look for a sector and industry, an area that's been out of favor, and to put a greater proportion of their money into that, and perhaps pull back on technology stocks for the very reasons, the political risks, the other risks, the relatively high multiples that exist in that sector. Reweighting is often a good idea. Yesterday's favorite is not tomorrow's.
All right, SMH Group CEO George Ball, good to have you here on The Move.
Well, move over Whole Foods. Amazon is set to open another chain of grocery stores next year, the first location under construction in the San Fernando Valley region of Los Angeles. Yahoo Finance's Melody Hom is based out there, and she got a look at the progress. So, Melody, what does it look like, say, compared to a Whole Foods?
Yeah, Julie, it's too early to tell the exact details of what we may expect, but I did do some shoe leather reporting in the Woodland Hills region, and it was really interesting to just get more context on the city itself. So the median household income is about $85,000. Right across the street is a very bougie sort of plaza, outdoor shopping mall, and then right next to it is a Westfield Plaza mall with the likes of Gucci, Louis Vuitton, high designer stores. The few folks that I was speaking to in the parking lot were saying they were very excited about this new grocery store, and I asked them, did you know that it wouldn't be a Whole Foods? And they said, we don't like Whole Foods anyway. So if you think about abuse that Whole Foods has had, and Amazon has been trying to shake off, right, the Whole Foods whole paycheck mantra, overall, we have seen prices come down, but that's actually been hurting Amazon's business because unfortunately, a lot of those products, they're losing margin there. But I do anticipate that this will be complete with alcohol, which ends up being the biggest reason why they're actually seeing a delay in the opening. Originally, it was supposed to open before Thanksgiving of this year, and according to several sources that I've spoken with, in addition to the security guards manning the building, they anticipate that it would be about February 2020 at the earliest.
Well, booze makes a difference, Melody, but you hit on something that we talked about when they first, bought Whole Foods, which is the supermarket, sector. That's tough. The margins are really tight. Amazon certainly knows tight margins, but don't they threaten, cannibalizing from Whole Foods with this store concept?
Yeah, Adam, my speculation actually, so the nearest Whole Foods from this location is about 1.7 miles, about a 7-minute drive. I did check out that Whole Foods. I don't know. I have a suspicion that perhaps if this sort of a concept does well, perhaps they might fold more Whole Foods stores. Perhaps that might not be an investment that they continue to make. As we know, even the Whole Foods locations that they have chosen are in more affluent neighborhoods where rent is higher, where it is higher to do business. It's a higher cost of doing business. So I anticipate that perhaps this would be a great beta test for Amazon as a company to figure out, okay, maybe we just do our internal brands, kind of mirroring what they're trying to do online with all of their private labels. I do have to say I spoke with some of the folks at See's Candies, which is right next door, of course, owned by Berkshire Hathaway, and a small nail salon. And I asked them, okay, what has it been like? Because Amazon has kind of wreaked havoc along that plaza because they're forcing construction, there were closed sidewalks, and they said initially it did serve as an eyesore. People weren't sure if they were open, but ultimately they anticipate that it will be a boon for their business. That sort of is a parallel to what we hear from small business owners, right? When they think about, okay, should we or shouldn't we actually list on Amazon, that kind of reach and scale, I think ends up being a better business decision for these small companies.
Hey, what could be wrong with going shopping, getting boozed up, and then going getting a mani-pedi? I mean, a lot of people are going to be doing that.
It sounds like a perfect Saturday afternoon.
Melody, thank you very much. Coming up, from Beyond Meat to Lyft, why top names picked the NASDAQ over the NYSE to make their highly anticipated public debuts this year. Plus, take a look at some of today's winners on Wall Street. .1233 in New York City, 3 hours into the trading day. The rally continues. The Dow, S&P 500, and NASDAQ all in the green. IPO battle. The NASDAQ is on track to beat the New York Stock Exchange in public debuts this year. We're going to hear from the exchange just ahead. A massive buy. The details behind IFF's $26 billion deal for DuPont's nutrition business. And vegan kicks. Find out how the plant-based movement is making its mark on the sneaker world. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for sticking with us. Well, the NASDAQ could steal the NYSE's IPO crown for the first time in years. NASDAQ-listed IPOs raised about $32 billion year to date, edging out the NYSE's $26 billion sum. Joining us now is NASDAQ Senior Vice President and Head of Western U.S. Listings, Jeff Thomas. He's joining us from San Francisco. Jeff, thanks for being here. You guys have been locked in a pretty heated battle over the years here, and I know you guys have been trying to, for many years, put the Facebook listing in the rearview mirror. What do you think kind of flipped the switch this year?
I think it's our holistic offering to our issuers. We start working with these companies very early in their life cycle through NASDAQ Private Market. We've got a great suite of services for the investor relations as well as governance functions for these companies, and a fantastic branding and visibility platform for when companies do decide to go public. So I think it's the combination of being in there early and then having a great support model once they go public.
Jeff, what's your sense of how the market will come out of the gate in 2020?
I think it's going to be a fast start to the year. We've been having a lot of conversations with companies out here on the West Coast that want to get out ahead of the presidential election. So we think the first half of the year will be incredibly busy.
We just had a guest on, Kathleen, who was telling us that Airbnb is going to be coming to the public markets, Spotify. I mean, this is going to be big, but why do you think there's going to be the rush to do it, say, before June?
I just think, anytime you have a presidential election, it creates some uncertainty in the market. As the field gets clear in terms of who the Democrats will nominate and run, I think that'll give a little more certainty. But anytime you have that uncertainty in the markets, that can raise the volatility index, which makes it just harder to price an IPO. And you really want that day to be all about your story as a company and not having the news dominated by something else.
You know, one of the interesting things that you guys have done has been in the biotech sector, and obviously a lot of happening there. How do you expect biotech to move in 2020 as well?
So the second week of January out here in San Francisco is the JP Morgan Healthcare Conference. It's one of the largest industry conferences where companies come out and present an update to investors. We expect to have a strong number of biotechs file for their public offering following the JPM Healthcare Conference, and that should start off a busy beginning of the year. I think as you move towards the latter half of the year, again, one of those areas of uncertainty will be things like drug pricing. So depending who's running for the Democrats, that could be an area that could create some overhang and, really push biotechs to get out early in the year rather than later.
I'm also curious, Jeff, even though it has been a very interesting year for IPOs in many ways, there have also been some pretty significant underperformers. There, of course, was also WeWork, which didn't make it to the public market at all. What effect do you think that is going to have on sentiment going forward? Do you think we are going to see more and more lower valuations, especially discounted valuations to the private market? And how is that going to affect your business?
If you look at the IPOs that really outperformed this year, it was a lot of the enterprise software companies. Zoom, Datadog, CrowdStrike, they're all up significantly over their IPO price and are performing very, very well. So we expect a really strong year next year around enterprise software companies that have a predictable revenue stream and have a good handle on what their cost of acquisition is versus the lifetime value, because that leads investors to be able to draw a much cleaner line towards when those companies will hit profitability, which has a renewed focus.
Jeff, I also wanted to ask you in regards to the sort of race between you, or the competitive nature of between you and the New York Stock Exchange. For both of you, it's my understanding that listing revenue is not the biggest part of your business, right? So is it a matter of reputation that you want to sort of take that crown of higher IPO valuation overall? What's the motivation?
Well, NASDAQ Incorporated is a scaled fintech provider around the world. We actually sell our technology to 100 other exchanges around the world, and we have a vibrant business around market data and analytics. So there are definitely a lot of other legs to the NASDAQ growth platform. But listings is really the core of who we are. It's what generates a lot of the revenue and profits we get from things like the NASDAQ 100 index, which is one of the most widely followed in the world. And is really kind of core to our brand as being an innovative technology provider.
Thanks for being here. NASDAQ Senior Vice President and Head of Western U.S. Listings, Jeff Thomas. Appreciate it.
The faux meat craze shook up the food industry in 2019, and experts say next year's sustainable trend may be plant-based or vegan. Athletic shoes. Yahoo Finance's resident shoe expert Reggie Wade joins us now with more. And these are pretty good looking. Do they hold up?
Yes, they do hold up. Now, these aren't exactly in my size, but based on the specs, they should. Reebok announced today that they're coming out in 2020 with an all-vegan shoe, and that's an athletic shoe. But these are actually more character. These are two shoes right here. This is one from a group called Le Mondaire. All vegan, and these are 100% vegan shoe from a Brazilian brand called Cariúma. And these are more lifestyle shoes, so these are different than the athletic type that we're going to see out of Reebok. But smaller brands have been in the vegan shoe game for a while, so it's just not that these bigger companies are discovering this. This is something that's been out for some time.
And it's not just vegan that we've been seeing, right? Because I've been seeing shoes branded as sort of using more recycled materials, for example, or using less water in the manufacturing process, because you use a lot of stuff and a lot of energy, I guess, when you're making shoes.
Yes, and that's something that these companies, especially Adidas, has been very conscious of. They know that people want to wear something that's more sustainable, or at least just a bit more sustainable. People are very conscious about what footprint they put on, and not to make a joke, but their literal footprint, whether they're being sustainable. So this is something that you're going to see more of from the sneaker market going forward.
Well, and and material science is really interesting because we're seeing so many different types of compounds and things being created. Do you see other interesting materials being used for shoes and in other types of clothing and what have you?
Yes, I do. These in particular are made out of bamboo leaves. These. So this is it's very durable. I don't know if you want to check it out. Sure. Very durable, very lightweight. Whoa. So I think that's what you're going to see more of these natural materials, things that are found in nature.
But, okay, so the bad for you shoes take 80 years to decompose with petrochemicals. How long does it take for this to decompose? Does it really decompose? I mean, it's still rubber.
Yeah, those are still rubber. I'm not sure how long it takes to decompose, but that group, Cariuma, says that you're going to be able to wear these for years and years and years. So it isn't like you're buying a pair of these and then you're going to toss them after 3 or 4 years.
You know what we haven't mentioned? Allbirds, right?
Yes,
I mean,
Allbirds.
even though they're made of wool, I don't think they kill the sheep for the wool, right?
No.
So that was really sort of the vanguard in these things, and everybody in Silicon Valley was wearing them.
Yes, and you see these trends. Once a CEO wears them during a presentation, everybody wants them. Remember when Steve Jobs came out in Nikes at first, and people were like, oh, all right, you can wear Nikes in Silicon Valley. So they're kind of like the trend setters and the tastemakers out there.
All right, well, these are pretty cool. Thanks, Reggie. Thank you. Coming up, Feel the Need for Speed one more time. Tom Cruise lights up the internet with a trailer for the highly anticipated Top Gun sequel. Plus, let's take a look at how cryptocurrencies are faring today as we see stocks rally. We've got crypto pulling back. We've got some trending tickers from Yahoo Finance for you. Let's take a look at Tesla. Those shares are up by 6% today. There was a report that lawmakers could revive expired tax breaks in some last-minute negotiations over the government spending bill. This could potentially be good news for Tesla, among other companies that could take advantage of these. We're also looking at a company called Axsome Therapeutics. Take a look at this one-day gain here. It's a 74% gain for this stock in one day alone. Let's put that in perspective by looking at the year-to-date chart, and you see the big spike. It's up 2,700% year to date. This company said its experimental treatment for depression met the primary endpoint in a phase 3 clinical trial. It is going to file a new drug application, it says, in the second half of 2020. And then as we look at other movers here, we're seeing Uber to the upside as well. Despite its dismal year here, the shares are up about 5% in today's session. According to TechCrunch, Uber's going to sell its Uber Eats business in India to a company called Zomato for $400 million. Again, TechCrunch reporting that, and so that is what's behind the bump in those shares. If you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
So we should all have so much fun at work. Discovery's hit reality show Diesel Brothers features a group of friends from Utah who own and operate Diesel Cellars. It's a business that specializes in rebuilding diesel trucks and other diesel vehicles. The series' latest season just launched and stars Heavy D, who's sitting to my right, and Diesel Dave, who's sitting right over there. It's good to have both of you here. I'll start with you, Dave.
All right, start with me.
My dad had a diesel way back in the 1980s, and I always thought diesel engines, really? Why? But that was a car. I get it with the trucks. I mean, huge power, but really, why?
Because you just get in, you crank over a diesel motor, and it's got a sound and a vibration, just a feeling that really I feel like, it hits a guy right in the heart, right in the feel goods. It's like, this is a manly truck. This is what I was born to do. This is what I need to do. And I feel like that's what our fans really have come to love about diesel, right?
Do you feel like in this age of the rising electric vehicles that diesel has been even more appealing, sort of as a backlash against that?
I mean, you could view it like that, but it shouldn't be viewed like that, simply because diesel power is the most efficient form of combustible power. It's way more efficient than gasoline, way more efficient than anything else, and diesel engines can run on just about anything.
Okay, but strong power or fast? Because my recollection, again, we called it the pickle mobile.
Right.
But I mean, we all remember the GM diesels, in the 1980s. Well, you may not, but
we remember.
They were terrible. And these things, there was no fast.
Right. They've come a long way. So diesel engines got turbochargers in the early 90s, late 80s. And once you put a turbocharger on a diesel engine, it wakes it up. So you got power, you got speed, but most importantly, you got efficiency. You can burn way less fuel and create way more power with a diesel engine. And they'll last 3, 4, 5 times longer.
Isn't diesel dirtier though? If you're, listen, I drive a V8, so, but for the environment, isn't diesel worse?
No. Sorry, this is something that we're obviously very passionate about because gasoline engines create more NOx. NOx is what's bad. That's what you don't want in the air. Diesel engines, even though you can see the exhaust sometimes, like the black smoke, it doesn't necessarily mean that that's more toxic than the other types of emissions. And diesel engines can run way cleaner. It's just a matter of how you're tuning them.
Well, what do you make of the whole diesel emissions scandal, right, from
VW?
VW, thank you. Where basically they were spitting out a lot, but then they were juicing the numbers and hiding that.
I don't even know what to say about that.
They screwed up. It was a stupid mistake.
VW is atoning for it to the billions and billions of dollars and people going to jail. But let's talk about what we're all living through. We're going from combustible engines to electric. Do you see a day? I mean, we saw Mr. Musk's truck. I don't know if you like it. What do you think of it? And then, are we going to see Cummins build an electric vehicle for their huge trucks one day?
I like it a lot. I think every form of fuel and power creates kind of a desire in different people to push the limits farther and better. Like each motor system, each fuel system is only going to get bigger and better, which creates a whole world of awesome working vehicles. So electric vehicles, gas vehicles, diesel vehicles, doesn't matter. There's something for everyone, and it's just getting better and better.
Oh, we love electric vehicles. We just built an electric powered vehicle on our show last week.
Yeah.
So we've embraced it. We're all about it. Electric power is amazing because it's instant, it's efficient, but at the same time, electric power has to come from somewhere. You have to generate that power somewhere down the line.
Clear power, a coal power planter. Just out of curiosity, just for fun, have you ever thought about putting one of those Cummins truck engines like on an old VW?
We put those Cummins trucks, we actually put a Cummins engine in a Prius.
Did you really?
We did, yeah.
Is that in the show? Can you see
It was going to be season 1, and then we ended up not taking it all the way to the finish line because we got distracted by other projects, but we've put Cummins engines in just about anything.
It's like putting a rocket engine
It's pretty much what it was.
Yugo in the
Very similar, yeah.
All right. Heavy D and Diesel Dave, all the best to you. Thank you very much.
Thank you very much.
Well, coming up, hackers hit home. Another viral video shows a Ring camera being taken over by hackers. The scary reality for users ahead. Let's take a look at some of today's losers on Wall Street. We've got PG&E trading lower after California Governor Gavin Newsom vetoed the bailout plan.
Let's take a look at the top trending stories on Yahoo Finance right now. Vaping or using e-cigarettes for a long period actually increases the risk of respiratory disease, according to a new study by the American Journal of Preventive Medicine. That study included 32,000 adults in the U.S. and found people who use e-cigarettes were 30% more likely to have developed a chronic lung disease, including asthma and emphysema. Shares of international flavors, fragrances, and DuPont are in the spotlight today. This is after the IFF announced it agreed to merge with DuPont's nutrition business to create a $45 billion consumer goods company. That new company will supply a range of products, including soy proteins, probiotics, and flavors for scents for consumer products. Tom Cruise is heading back into the cockpit. The actor will be returning to the silver screen as Pete Maverick Mitchell in the new film Top Gun. Maverick the movie takes off in theaters next summer, just over 34 years after the original Top Gun premiered. We'll be right back. Buzz a beat around, 3 stories, 1 minute each, starting with this. China's state-run broadcaster CCTV pulled an English Premier League match between Arsenal and Manchester City Sunday. This comes after Arsenal, a player on Arsenal, criticized China's treatment of Muslims. Any thoughts on this one?
I'm not surprised at all. Look what they did with the NBA. This should be expected.
It should, and yet, what does this say about the state of where things are, right? And this is why you have to worry about what China is doing and the China influence in a lot of places. That's why this stuff is leaking over. We can't ignore the fact that that's a deal.
Right. I mean, this is a player of Turkish descent who is himself Muslim. And it makes sense that he would stand up and speak out about this. I mean, the question is, as you say, what effect is this going to have? Is China ever going to ease up on its treatment of its Muslim minority? It doesn't seem like there's anything in that direction.
Right. And look, and you can criticize the U.S. and a lot of things that we do, but there are certain things that we always have to remember that we kind of do okay. And, I think it's important to remember that. And when you see this kind of stuff, all right, I got buzzed.
Upsetting, yeah. The Hallmark Channel, I don't know about this one, though. The Hallmark Channel reversing what it called a wrong decision. The company announcing it will reinstate a Zola commercial featuring same-sex couples that it had pulled following a complaint from a conservative group. Now, it said it was reinstating it, but it's I think it's sort of fudging its apology on it. It's trying to play it, right, it's trying to play it both ways.
Well, but look, and again, it's sort of an interesting, exactly to what you were hinting at. I mean, it's a state of, unfortunately, where we are as a country from a political perspective, because this becomes essentially a political issue, and people are so, bipolar on these issues, and it becomes very difficult.
10 years, this will be a non-issue.
Well, of course.
If you look at the ads that are running now, I mean, this is maybe in 5 years. It's not.
I think it's only because it's the Hallmark Channel, which is considered a little bit more on the conservative side, that you've got this issue coming up.
Why are the shows on there so addicting?
You
just can't stop watching this stuff.
It's the same formula over and over
wow,
again.
Brian Sazzi,
I like the Hallmark Channel. Put it on Twitter. I'm all for it.
Really?
I like the Marquee Post guy. What was the channel with the Marquee Post? It's all the
feel good stuff.
Home security company Ring is facing another round of criticism as a new incident of hacking occurred this past week, and this time by a teenage boy spying on his neighbors. It's just the latest hacking scandal and what has become an ongoing problem for the company. But in some of these cases, they had Ring cameras in their bedrooms. Why?
Very good question.
This was the doorbell people.
I think the end of the day is stop buying these, go to Home Depot and buy an old school doorbell.
Well, there's that. And look, here's 3 words: dual factor authentication. I know nobody wants to deal with that. Basically, it means instead of just having a password, you have 2 means of making sure that this is your account and you don't get hacked in. Because there are some benefits to it. Now, why they'd be in the bedroom is a separate question, obviously. But look, there are security benefits for people who are watching parents, or if they have a place somewhere else and they want to check in on where it is. There are actual benefits to these things, but you got to be careful.
Well, remember who owns Ring, by the way?
Yes,
it's
of course.
Amazon, and Amazon does not have a very good record on this stuff when it comes to Alexa listening in on people, and that's the company itself, let alone preventing external people. So, Amazon kind of turned this around and said, well, you guys need to change your passwords.
I know.
Look,
And this is the whole problem is around these listening devices is not going to go away anytime soon.
Well, definitely not.
As we take one last look at the markets for this hour, one person is very happy about the record highs today. President Trump just tweeted moments ago, "New stock market high. I will never get bored of telling you that, and we will never get tired of winning." Julie?
I don't even know what to say about that, so I'm not going to say anything. Instead, I'm going to thank our lovely guests for being here today. Brian Sazzi, thank you as always. Bob, great to have you here.
Yes, thanks for having me.
Appreciate it. And Wi-Fi PM's coming your way next, as indeed there are new stock market highs, as the president is accurate in that. I will say that.
I'm not mad at that.
All right, stick around. Wi-Fi PM is next.
It is 1 p.m. in New York City, and all 3 major indices are in the green, with the Dow on track for a 4-day winning streak, notching new record highs. On tap for today, a surprise reason for optimism with stronger than expected economic data out of China. Why that, coupled with the trade deal, could limit downside risk moving forward. Plus, Boeing getting hit hard after it weighs suspending the production of its troubled 737 MAX plane model. We'll have the latest update and bring that to you. And more companies getting away paying a 0% effective tax rate, the shocking amount of American companies following Amazon's lead to pay nothing in federal income tax. All that and more. This is Wi-Fi PM. Good afternoon. Happy Monday. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Heidi Chung, along with Ruby Media Group President Chris Ruby in studio with us. Chris, good to see you.
Good to see you.
Thank you for being here. It's actually a very exciting Monday for you to be on because we were checking the market action. We saw the Dow hit record highs today. We've been saying that a lot lately. You can see the other major indices in the green as well. And the big reason why we're seeing the big pop higher today is better than expected Chinese economic data helping to boost the overall market. The country's November industrial output rising 6.2% from a year earlier, while retail sales climbed 8% according to the National Bureau of Statistics. The Phase 1 trade deal also added to increased optimism, but guys, plenty of downside risk remains as we head into 2020, mainly that, this deal itself, Heidi.
Right.
We've heard about it.
Yes.
Haven't seen it necessarily.
We haven't seen anything signed yet, and I think until that point, we can't get too comfortable, right? Because words mean nothing. Actions speak louder than words. It's a common phrase we use all the time. But so once something gets signed, I think a lot of investors out there and global markets will feel better. But I do have to mention that global economic data that we have seen recently has actually shown a lot of improvement. And I think that is important. People are starting to feel better about what's going on between the US and China, and therefore the global economy is going to start seeing a meaningful boost if we do in fact get that Phase 1 trade deal. But one commodity specifically that's really highly tethered to the way investors view the global economy is copper. And we've seen copper perform really, really well. Last week, it hit its highest level in 7 months. And that's just saying that investors around the world are starting to feel better about the global economy overall, and therefore starting to put money into riskier assets.
Yeah.
Now, yes?
No, go on. No, and you're really hitting your stride here.
And China actually accounts for half of that consumption. So that's the reason why we're seeing that surge in that commodity right now.
I think part of it too, whenever we talk about data out of China, some of these things are looked at with a hint of skepticism because of course they always try and show a lot of growth in their data. But when you look at kind of the tit for tat tariffs going back and forth, and we've talked about this for the whole year in looking at who is actually impacted more by these tariffs being in place, overwhelmingly, when we talk to people, the answer is China. And yet, these numbers that we're talking about now reflecting before we even got to the Phase 1 trade deal that we're talking about. So you would think, clearly, not necessarily impacted that much.
Right. I mean, that's the main question. A lot of people are saying that China has more to lose, but then other folks out there are also saying that U.S. has more to lose. So at the end of the day, I think it's mutually beneficial if we do indeed get a deal. At the end of the day, both economies will be hurt if there's this continued trade war. I mean, we're hitting 2 years come March, right?
Yeah.
So obviously a lot of businesses holding back on their investments because they don't exactly know what's going to happen in the future, all this uncertainty. So yeah, the sooner we get something signed, the sooner we start working on Phase 2, and then Phase 3, I think the better it will be for all economies around the world.
And really, I mean, when we talk about it here in the U.S., overall, the consumer and everything else maintains some pretty strong strength when we talk about people not really feeling the impact of these tariffs, holiday shopping season coming up, overall things still looking pretty good.
I agree with that. Holiday shopping season is coming up, and we've seen in terms of spending and growth that has been pretty consistent, right? In terms of when we looked at the stats for, what was it, Cyber Monday and
everything, Black Friday,
they were pretty impressive, right?
Yeah, everything's been looking good, and you think about the consumer constituting 70% of the overall economy, as long as that keeps chugging along. Now these tariffs off the table as we approach the holiday season. Generally, optimism is going to be the theme of the show, and we are not going to stop talking about the trade deal when we talk about that optimism, because there is more that we are learning as this goes on, particularly about the Phase 1 China trade deal that we got at the end of last week. And today, White House economic advisor Larry Kudlow spoke on Fox News in more detail about what the deal means. Take a listen.
These deals are both pro-growth, and yeah, they do remove some uncertainty, and they also increase incentives to invest. And they're also going to double our exports to China, just to name a few things. I think it's important that people understand just how important these economic growth measures are going to be.
So there you go, doubling exports to China, a very lofty goal when we're talking about what the impact might be. I want to get your take on that in a little bit, Heidi, but it also comes after U.S. Trade Representative Robert Lighthizer told CBS that the Phase 1 deal is for the benefit of both nations, framing it basically as a win-win here. But when we talk about it, again, it goes back to the question of walking into this Phase 1 discussion, President Trump was saying that it can't just be a win-win. It's got to be a U.S. wins more here because they've been so far behind in what China's been getting away with.
Well, I feel like if no trade war happened, it would have been to the benefit of both countries. Now, the reason why this trade war has really shook things up the way that it has is because it's sort of threw a wrench in the trust that a lot of these countries had with one another when it came to the trade relations that they had previously had. So yes, this is good news because after this year-long trade war, things had been not so great when it came to exporting and importing. We saw the trade deficit as well. So great that this is happening. I'm happy that the White House thinks that it's going to be such a great win. So in terms of what happens next, of course, we need to get something signed. And then phase 2. But they say that intellectual property, all of that is all included in this phase 1 as well. So a lot of people had thought that it was just going to be about agricultural purchases. It wasn't necessarily going to include a lot of those big ticket issues, but okay, we'll see.
Yeah, and we'll see what happens, what the actual deal comes to when we think about this actually getting signed and being stamped as approved. Though it does sound like it's trending in that direction. I want to talk about another story that we're watching today because it would be perhaps the first time that we've actually seen Boeing take a hit when we're talking about news pertaining to that company. Take a look at that chart. Stock off by about 4% after a Wall Street Journal report said the airplane manufacturer is debating cutting production of its 737 MAX jets. Boeing responding in a statement to Yahoo Finance, writing, quote, "We will continue to assess production decisions based on the timing and conditions of return to service, which will be based on regulatory approvals and may vary by jurisdiction." Boeing suppliers like Spirit Aerosystems and Safran also down on the heels of that report. And guys, obviously, when we talk about Boeing, Chris, I'd be interested to hear your take on it. I know you've worked with companies in crisis over the PR spin here, but Boeing has seemingly been able to navigate this and not necessarily seen reaction like we're seeing today, because I think finally it's getting into the truth of, all right, maybe we're not going to be able to produce the way that we thought we would.
Yeah, I mean, I don't think they've navigated this well at all. I mean, I think this is really, in terms of public relations and crisis management, going to be one for the books.
Yeah.
Like, PR students are going to be reading about this for years to come.
Oh, no, for sure. I think it's been a bad job, but the stock hasn't necessarily reflected.
Yes, that's correct. But now, I mean, if you have people who are really afraid to fly these airlines because of a PR crisis, that is not well handled, right? Yeah. And so I think the real takeaway here is that from the very first moment that there was an issue that happened here, the CEO could have really acknowledged it or done more than they did with the actual airline. And so that kept happening and that sort of wasn't really addressed, head on. Now we're starting to see the trickle-down effect of that.
And it hasn't, I mean...
That's such a great point that Chris brings up, and that's the reason why I think we saw that CEO and chairman role split, and that's why Dennis Muilenburg was sort of criticized for his inability to communicate with shareholders, and thus we should just have him be the CEO, focus on getting the planes back into the air, and David Calhoun, who took over as chairman, he is the one who's communicating with the shareholders.
Correct. I agree with that, and I also think, we're in such a social media-driven world right now, and so when you just continue to let this chatter and this noise go on for, months on end or however long it is, you just perpetuate the problem, right? And so I think there's a new way and an old way of doing PR. And I think the old way is to say, we're just going to ignore what people are saying online and we're going to put out this corporate statement. Right? And I don't think that's effective anymore.
Well, let's not forget, too, that the president chimed in when all of this was going on, saying that they would need to rebrand the 737 MAX plane as well and completely change it. And I think that...
Correct.
Yeah, but I'm sure that a piece of this, too, and they're moving forward and looking at the consumer reaction to the model itself, maybe they know something that we don't when it comes to people who would never want to fly on a 737 again.
Right, and PR nightmare aside, though, I mean, this is a big, big deal, right? So if they completely halt production, obviously that would be much more detrimental than just pausing it for now. But that was one of the reports that internally there was a lot of debate between David Calhoun, who is the chairman right now, and Dennis Muilenburg on whether or not they should reduce production even further. Right now they're at 42 Boeing 737 MAXs per month. Now that's already reduced. That was reduced in April. But if we take a look at how this will impact the actual business, so making and servicing commercial aircraft accounts for 80% of Boeing's operating income, and the 737 series accounts for 70% of commercial aircraft deliveries. So when we think about that, that's obviously going to have an impact on Boeing's financials, right? And if they actually stop making the 737s, that's essentially shutting down almost half of its business. So that's why we're seeing the shares react as sharply as they are. They're down almost 4% right now. But this is something that will seriously impact the people that are currently working in the factories, right?
And I say that the stock hasn't been impacted that much overall because on the day-to-day news when we get this coming out, we don't necessarily see a 4% move like we're seeing today. But year to date, the stock pretty much flat, only up by about 1%, which is still kind of incredible when you think about everything that has come out and the way that we've seen this story not go away in 2019, and now, as it sounds, not going to be going away in 2020 either. But coming up, Goldman Sachs is sounding the alarm over a decline in share buybacks. Why the firm says a drop in CEO confidence could lead to increased volatility in 2020 when Wi-Fi PM returns. Welcome back to Wi-Fi PM. Goldman Sachs is sounding the alarm over fewer companies buying back shares. Today, the firm highlighted the trend in a new note saying slow earnings growth, increased leverage, and the lowest CEO business confidence since the global financial crisis contributed to a 9% year-over-year decline in the S&P 500 share repurchases during the first 3 quarters of 2019. By year's end, that decline is pacing to become about 15% and is estimated to fall another 5% in 2020. So companies aren't buying back shares, but despite the decline, Goldman notes buybacks this year are on pace to be the second highest on record in nominal terms, saying, quote, buybacks have been the single largest source of U.S. equity demand each year since 2011, averaging $450 billion annually. Now, in comparison, average annual equity demand from households, mutual funds, pension funds, and foreign investors was less than $10 billion each during this period. As a result, a significant decline in buybacks would dramatically shift the supply-demand structure for U.S. equities. Guys, they go on to say that stock performance has sagged over the last 25 years when you look at the average, particularly the 20th percentile here, in blackout periods when companies aren't allowed to buy back shares versus when they are. You see that on average they do particularly worse during those blackout periods, negative 27% versus 16% there. But it is interesting because, you look at kind of the reception to share buybacks, right? That was a story of 2019 as well, when we heard politicians on both sides of the aisle kind of attacking the idea of companies freely being able to do this.
Right, and why are share buybacks important, Zach? Because when companies buy back their own shares, right, that means fewer of those shares are available to purchase, and therefore that buoys the share price, right? So that's better for investors overall. Sorry, I got so tongue-tied there. But yeah, that's why buybacks are overall important here. But yes, if we do see a decline, Goldman specifically notes that would lead to slower EPS growth and wider trading ranges with higher volatility overall. So that's part of their outlook. That's actually point number 4 on what they're expecting for 2020. But do you think that's going to be the case? They're saying that we've seen a decline, but do you think that's going to continue?
Well, what's interesting is that they've noted that we've seen the decline in 2019. Yeah. And look at how good of a year it's been for stocks overall.
Exactly, record highs.
So there is a case to be made that, sure, it hasn't just hit yet, right? When you think about volatility, it takes a while for some of these things to manifest themselves. We saw the same thing. People make the same point when we talk about the yield curve inversion, that it doesn't happen instantaneously. It takes some time here. Yeah. So maybe if the trend does continue into 2020, there would be some truth over that. Because the trend isn't going away. And I brought up the politicians kind of harping on this because we're going into an election year. You wonder if it would come up, especially when we're talking about Elizabeth Warren and how she likes to harp, along with Bernie Sanders, likes to harp on Wall Street and corporations potentially doing some behind-the-scenes maneuvering to boost overall things. I mean, it plays right into the wheelhouse.
But share buybacks are good for the shareholders, right?
Sure.
So do you think Bernie Sanders and Elizabeth Warren would actually take issue with that?
I think, again, it comes down to, and you've written about this, you know this, you've written about how many households actually hold stock, and it is not a lot of the households. I mean, when you look into the numbers, there is a large amount of people who don't hold
Institutional
any stocks.
investments more so than
Retail investors.
Right.
So, I mean, when you look at it, you can make the argument that, yes, it's good overall. If you got a 401k, congrats, it's great for you. But there is a large segment of the population that both Senator Elizabeth Warren, Bernie Sanders will talk about, but then even President Trump as well, when you think about his base. Just very interesting when you look at it. But yes, I do think, a very interesting note from Goldman Sachs when you dig into volatility in 2020.
But bottom line, Goldman Sachs still believes that U.S. equities is where where you should be invested. It's going to continue to outperform other markets as well. So still relatively bullish given that one concern that they do have.
Yes, not a huge don't buy U.S. equities call here, but just a warning to say that this trend is continuing in 2020, and it may weigh when we look at EPS expectations moving forward. But just after the break, the shocking amount of companies getting away with paying a 0% effective tax rate, plus key swing states showing troubling economic signs for Trump's re-election chances. Wi-Fi PM is back in 2. Welcome back to Wi-Fi PM. We are checking the market action right now. You can see green across the board. The Dow up 164 points after hitting record highs today as optimism continues in the wake of getting that phase 1 trade deal all but signed, if you believe what we've been hearing so far. Well, today we're talking an interesting finding from a new report that shows 91 companies didn't pay a dime in federal income taxes in 2018. According to a new report by the Institute of Taxation and Economic Policies. And Yahoo Finance's Kristen Myers now joins us with the details on this. And Kristen, you've highlighted before, Amazon is one of these companies, but now we're learning.
Still on this list,
now
by
we're
the
learning.
way. They haven't squirreled their way off of this list.
Now we're learning there's a lot of companies alongside them.
There's 90 other companies alongside Amazon. So you've got companies like Netflix, Starbucks, JetBlue, General Motors, Delta Airlines.
So a lot of people on this list.
A lot of big names. NVIDIA is one of them.
And it all totals up to $73.9 billion in tax that was under the first year of President Trump's tax plan.
Okay, so after this new Tax Cuts and Jobs Act, they like to call it the Trump tax law, essentially what you have is corporate tax avoidance increasing. So I want to be clear here. Some of these companies have avoided paying tax previously. This is not the first time that Amazon avoided paying federal tax on income. It's now the second year. It's just that the number of companies that are avoiding paying corporate tax is just growing. And essentially, they had the corporate tax rate under the new TCJA lowered to 21%, but the effective tax rate for these companies is 11.3%. So they actually only paid, they were supposed to pay about $161 billion. They only paid in total about $84 billion. So just a little over half of what they owed. So about $74 billion, they were given a lovely big fat tax break.
So on the surface, this sounds pretty suspect, right? Like, oh, they're getting out of paying taxes. But what's the reality here? Is this just something that a lot of corporations just have been doing and will continue to keep doing?
Take advantage of the system and the way the law is written.
All of these companies take advantage of the system. We've seen people, if they can, take advantage of the system. If there is a loophole, people are going to find it and they are going to take it. However, the biggest issue here is that the point of the TCJA was it was supposed to squash that tax rate a little bit, but broaden out the base, right? It was supposed to plug up some of those loopholes that companies had previously been taking advantage of. But that's not the case. According to the Treasury Department, last year in 2018, companies, and this is beyond just the Fortune 500 companies that we're talking about in this report, paid $91 billion less last year than they did in 2017. So what we're finding is that even though this Trump tax law, if you want to call it that, was supposed to be creating more revenue, it's not actually doing that.
Well, let me just play devil's advocate here when we talk about the corporate tax rate, because obviously that's something a lot of people like talking about. But when we're talking about the problem that existed before President Trump brought these rates down, is a lot of companies were just holding profits overseas and choosing not to bring that money back. And that's what a lot of his advocates would point to, is saying, look, I mean, what else do you want? Either they're going to bring their money here or they're going to keep it overseas. This is better.
That hasn't changed, though, unfortunately, even with this new law. And again, what we're just seeing is actually previously the effective tax rate. So that's actually the rate at which these companies are actually paying tax. It was 13.6 prior to the passage of this law. It's now 11.3%. And some reports actually say if you broaden it out to all companies, that it lowers even further to 7%. That's incredibly low. And these companies are still hiding profits on some levels overseas.
Yeah, but they're not getting, they're increasingly getting hit harder when we talk about people calling them out for it. I mean, Senator Bernie Sanders even retweeted the article that you wrote about Amazon not paying anything in taxes. So it does seem like the target, at least on their back, is getting a bit bigger.
Yes, I think what you're having is, especially last year, a lot of people were a little bit surprised by how much they owed in tax, even though they actually got more money back. They didn't change their withholdings, so they actually ended up more come tax time. And what you have is taxes. It's like they always say, right? Like you can't avoid taxes like you can't avoid death. Everyone has to end up paying them. So it makes people really angry. I know, Heidi, you're looking at me like, really?
Wow.
No, they do, but they do say that.
In life.
You can't avoid death, you can't avoid taxes. So it makes people angry to know that they have to, every paycheck, pay taxes on their income. Income taxes is supposed to be the lion's share portion of the taxes that every company is supposed to pay. And it makes you angry to see that a company like Amazon made $11.2 billion in profits. Didn't pay tax on that.
Especially if you're hurting, and in your personal finances as well. If you're in pain and you're seeing a company get away not paying anything in taxes, it's more painful when you have to pay. And that is something that we're looking into when we talk about President Trump and how his tax cuts have been perceived, particularly in some swing states, because President Trump is being called out on his pledge to restore jobs to the Midwest. A new report from the New York Times shows that job growth in the Midwest has slowed sharply this year as compared to the rest of the country. And Kristen, I mean, some of those states are some pretty big key swing states for President Trump.
Pennsylvania, Michigan, Minnesota, he kind of just narrowly won. These are states, there's still job growth in these areas, but we've talked often about not just the economy and recovery, but just even a lot of the gains that the economy has made. They have not been made equally across the entire country, and that they have not been made equally for every single person. So you are seeing some people do incredibly well. You are seeing some states do incredibly well with this economic growth. A state like Nevada or California or Arizona doing very, very well. But states like Pennsylvania, states like Michigan, they're struggling. Manufacturing jobs, they're just not coming back to the same speed that they were before. We did see a big manufacturing boost when Trump first took office. As you can see there was a spike right after he took office, but then that slowed. And even that spike that we're seeing in that chart there, that spike also wasn't equal across the whole country.
Yeah.
Those Midwest states still really struggled. And as we think about 2020, those Midwest states are so critical. They don't call them swing states for a reason, for no reason.
Yeah.
They're absolutely critical. You want to, if you're going to be a presidential candidate, you want to have those states in your back pocket.
Especially if you won them because of the way that you were campaigning on what you're going to be bringing back to the manufacturing sector as well. So you got limited time to make it work.
Well, we already know that President Trump is using the economy as the centerpiece of his campaign. But it's an argument that, we'll have to see, but it's an argument that might not work as well or hold as much weight or water in those states because these are people that are still struggling, that aren't seeing as much job growth as some of their peers in other states.
Yeah, but for now, the headline number is still holding up relatively fine. And as we open the show, the state of the overall U.S. consumer generally holding up as well.
The economy is still strong. The consumer is still strong. It's just, again, that's not true for everyone in this country.
Yeah, not entirely true for some manufacturing workers as well. But Kristen Myers, thank you so much for breaking all of that down. We got to take a quick break, but we're back with the market's biggest movers on Wi-Fi PM right after this. Welcome back. It was a tough year for cannabis investors. Looking back on 2019, as measured by the marijuana-focused Alternative Harvest MJ ETF, the sector is down roughly 35% on the year, despite some landmark pushes to legalize marijuana in more states. Remember, back in June, Illinois became the 11th state to legalize recreational marijuana in the country, and the first state to do so via the legislative process. The state is now estimated to become a $2 billion cannabis market, beginning with legal sales this January. So for more on what Illinois could spark and whether 2020 could shape up to be a rebound year for the sector, we're joined by CFRA analyst Garrett Nelson. Garrett, it's good to see you again. What's interesting is that the MJ ETF enjoyed its best day since inception, right after Senator Cory Booker said he thought Joe Biden was high for not supporting legal marijuana at a federal level at the latest Democratic debate. I thought that was interesting. I'm not sure if those are directly connected, but do we think that legalization at a federal level is enough of a catalyst to help boost the sector next year?
Hi, thanks for having me. Absolutely. That's really the big wild card as we head into 2020 is if there will be legalization or just deschedulization. And what you saw last month, a bill that would effectively do that passed the House Judiciary Committee and will go to the full House for a vote at some point, probably in early January. And then at that point, it goes over to the Senate, where it could be dead on arrival, just given the Senate Majority Leader's very outspoken opposition to cannabis. He may not even consider it for a vote in the Senate. But what you saw in November with that House Judiciary bill being passed is you saw a huge rally. The stocks jumped, about 20 to 30% the week that passed. So that's really the big question heading into next year.
Well, the other thing too is, I mean, on the marijuana front, we could understand some skepticism perhaps from Senator Mitch McConnell there, as you're talking about his position on it. But when we look at CBD, that's another thing too. And we talk about the way that hemp has grown across states with his support and backing there. I mean, when we talk about CBD, what are your expectations for some legal groundwork that we haven't gotten yet by the FDA in the way that it could be used in food? Because we know that people have been selling this, and the expectations are very high.
That's right. More problematic is recreational marijuana being legalized. Still to date, it's only legal in about 11 states. So. But medical marijuana is legal in 33 states today, and that number is growing. And you can put CBD in that category where, we think it'll gradually be legalized, in the coming months and quarters. But the big question is surrounding recreational marijuana. We think that's the much larger market in the long term.
Mm-hmm.
Hey Garrett, it's Heidi here. So I want to get your thoughts on what the future is for these marijuana companies, because a lot of the companies were banking on a big boost following Canada's legalization efforts late last year. It didn't really translate into adult use sales booming either. And so they bet in the U.S. That still hasn't really translated either. So is it about moving into consumer packaged goods? Is it about moving into edibles? Is it different variations? What's the future for this market?
Sure. So the problem among cannabis companies is, there's still generating widespread losses from an earnings perspective, yet these companies are flush with cash from all the investment that's been made from beverage companies, from tobacco companies. So the balance sheets are fairly strong, actually. So you're in this period where there's not quite distress across the industry, but the industry is plagued by oversupply, and prices are falling. So overall fundamentals are very weak, and that's exactly what happened in Canada when it became legalized. All of a sudden, there weren't as many barriers to production, and you saw a flood of supply. And we expect more of the same really in 2020. The U.S. is really the big market. It's 10 times the size of the Canadian market, so it's about a $50 billion market per year. And about 3/4 of all cannabis sales right now in the U.S. take place in the illicit market.
Yeah.
Hey, Garrett, it's Chris here. I have a question for you. So I have a different sort of take on all of this outside of just the market and growth. So obviously there's this big cannabis craze, right, in the U.S. And so even PR firms now, I see PR firms specializing just in CBD or just in cannabis. And so that's also exploded in growth. But my question to you is the following. Let's say this trend continues with legalization, across the U.S. How will that impact, criminal justice reform? And again, it's not necessarily a market question, but you have all these people who are, sitting in jail right now for things. So how is that, what are we going to see if this becomes legalized, right? And we keep going in that direction. What's going to happen to all of these people that the state is paying for right now who are in jail for this very same thing that is now going to continue to be legalized in the U.S.?
Sure. So I think that's part of, broader criminal justice reform is, you're going to see a lot of those sentences commuted. Some of these things thrown out. And that's, it actually has some support in Republican circles as well, because they view it as a positive for overall employment. A lot of people who have criminal records because of these, marijuana-related infractions, having their records cleaned and, will create a healthier overall employment pool.
Mm-hmm. Yeah, and we've seen pieces of the legislation proposed thus far, including some criminal justice touch points, at least, especially from Senator Kamala Harris. But now we know that she is no longer in the race. Perhaps her bill, though, may still advance. Garrett Nelson, thank you so much for breaking all that down and what to expect from cannabis in 2020. All right, well, next on Wi-Fi PM, stocks are setting record highs once again. We'll get reaction from the floor of the New York Stock Exchange next. afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Heidi Chung, along with Ruby Media Group President Chris Ruby with us in studio. I want to take a look at the market action we're seeing right now from the floor of the New York Stock Exchange. We're checking in with Scott Gamm. Scott?
Hey there, Zach. Well, lots to like in this market right now. All three major indices at record highs. The Dow is up about 155 points right now, being led by names like UNH, Pfizer, Goldman Sachs, and Apple. On the flip side, the worst performing Dow components right now are names like Boeing, American Express, and Coca-Cola. So once again, you have this tug of war going on within the Dow. Apple up, Boeing down, those kind of moves canceling each other out. And with that, you can still have a positive day for the Dow just because Boeing and Apple are among the two most powerful Dow stocks, Zach.
All right, Scott Gamm from the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But after the break, a segment that Heidi Chung has been very, very excited about. The busiest snacking week of the year is upon us. We're chatting with Frito-Lay on how Americans' tastes are changing when Wi-Fi PM returns. Welcome back. It is called Merger Monday for a reason. Today we're following the story of DuPont selling its food science unit to International Flavors Fragrances in a deal valued at $26.2 billion, according to multiple reports. The deal will create a new consumer giant worth more than $45 billion, in addition to placing more IFF products in a fast-growing segment of the food market, like plant-based meat. We've been talking about that all year, Heidi, and you've been digging into the details behind the deal. Why is this one so big?
Well, it's a big deal in the consumer packaged goods space because they're going to be a behemoth at this point, right, with an enterprise valuation of $45 billion. The company, once it's combined, and they're expecting this to close in early 2021, given that regulators approve it and sign off on it, will be continued to be called IFF, and it will be based in New York. Now, DuPont will also be receiving a one-time $7.3 billion cash payment once the deal is closed. But a lot of analysts are saying this makes strategic sense for these two companies to come together. This will also, though, I need to mention, increase their pro forma debt load to $12.5 billion as well. So more debt to come along with it.
Yeah.
But a lot of other bidders were in this race. They wanted to get in on DuPont. But DuPont is one of those companies that we don't also talk about a lot all the time on the show.
Or
It
IFF.
used to be, exactly. So it used to be Dow DuPont, but DuPont broke off from Dow DuPont. Earlier this year, Dow is now a material sciences business, Corteva is the agricultural business, and then we have DuPont, which focuses on the specialty sciences business. And one of the products that DuPont makes, protein. So pea protein, and pea protein isolate is what's often used in a lot of these alternative meat.
Sure, like Beyond Meat.
Exactly, Beyond. And they also make like soy protein, and they make a lot of these different products that are used by other U.S. food companies to create their products. So it's a supplier of sorts. This is going to create a mega house for them. But the reason why we're seeing IFF shares so low today, and I think they're plunging something like 10%, is because a lot of people are concerned that they are paying too much for DuPont. And so investors might not be too happy about that. But overall, yeah, this will cut a lot of costs for them. They're expecting about $300 million, to be specific, within the first 3 years.
Yeah, I do wonder, I mean, when we talk about the debt load, that is one thing that we've seen a lot of companies, again, when you have interest rates so low, you tend to see an increase in some of these deals getting done here.
Yeah.
But there are some long-term concerns about whether or not those kind of cost-saving endeavors will actually manifest themselves moving forward, especially when we're talking about two big companies, not exactly too dissimilar from what we saw in Xerox and HP.
Right.
And some big companies trying to put themselves together to solve some problems. But this is a hot space. I mean, when we're talking about alternative meat, that has been the biggest story of 2019.
Yeah, I mean, in terms of alternative meat, right, like I'm 100% in favor of that. I will say, just from a consumer perspective, when I see the words flavors and fragrance, I get scared, right? I want to run away from that. That's not where I want to put my dollars, right? Because, you know, fragrance could be any number of 100 different chemicals in something, right? So I want food that is real food, right? I don't want flavors. I don't want scents. I spend more money to get products that don't have those things.
Which is kind of the hit on these plant-based meat makers too, and you've covered this in terms of how healthy they actually are, or unhealthy when you think about what's actually in them. You talk about the sodium count being so high.
Yeah, I know there's a debate about how healthy they are, right? There's also an ethical debate as well, right? So in terms of that debate, I mean, I think that one's clear that it's the right move.
Yeah, it's definitely easier than all of the traditional big farming and big animal herding kind of enterprises out there. But yeah, it's very interesting to see a big deal, Merger Monday, living up to its name. Well, it is beginning to look a lot like Snackmas for all of you out there who are snackers around the holidays. Frito-Lay, owned, of course, by PepsiCo, is dishing on the taste preferences driving American snack consumption in its latest U.S. Holiday Snack Index. And according to the company, Americans will take part in an estimated 327 million gatherings from Thanksgiving through the new year. But Frito-Lay says it's prepared as the company projects it will produce more than 100 pounds of snacks every second. So joining us now is Frito-Lay's Chief Customer Officer, Mike Del Pozo. And Mike, when we look at this, it's interesting because Americans, I didn't know this, but it's actually the busiest snacking week of the year. I would have thought the Super Bowl, but Christmas, the week of Christmas is actually the busiest. So how are you seeing Americans manifest their need for snackums around the holidays?
Yeah, hey, well, happy holidays. Thanks for having me. Glad to be back. It is, you guys stole my opening line. Biggest week of the year. I think it surprises a lot of people. We obviously have a big Super Bowl. We do a lot on the summer, but this week drives more traffic through through registers. So we're gearing up for a big holiday. You showed the number there. We're real proud of 100 pounds a second. And what's, I think, real cool about that is just we continue to drive a big portfolio across the industry. So we're excited for the holiday.
Well, I mean, just before we had you on, we were talking about changing trends in the food space. I'm sure the snack space has seen a lot of the same changes going on. I used to work, full disclosure, I used to work out at Frito-Lay in Plano as well. And when I was there, the trend was healthy eating and healthy snacking, smart food popcorn in the portfolio as well. Some of those growth named brands, the quickest growing ones, used to be the ones in the health space. Are you seeing the same trend and a shift for the U.S. consumer towards healthy foods?
Yeah, I think we are, and I think we're also seeing a lot of our tried and trues that you guys had on the segment last summer. I was here as well. But that's part of why we commissioned the U.S. Snack Index every holiday season. It's not just to have kind of fun and get a pulse on our consumers. It's really to validate a lot of the insights we have on our shoppers. And a couple of mega trends continue to arise. One is just functional snacking. And so this idea of going from 3 meals a day to what is now about 6 to 8 occasions throughout the day. And so with that, that's great for a company like ours, but it also puts a lot of expectations on what those extra occasions need to provide, whether it's protein positive, whether it's fruit and veggie. So you see us continue to do things like building on our brands like Smart Food or Sun Chips, and then even with our recent news on intent to acquire BFI brands as well. We believe that's the beauty of our portfolio. It's extremely balanced.
Hey, Mike, it's Heidi here. So Zach brought up an extremely good point, which is the changing consumer taste. Now, I want to get your thoughts on the idea of proliferation of SKUs, right? Because the chip aisle, even when I go down the chip aisle, there's so many variations of different Lay's chips. Is this just the new norm for a lot of these kinds of companies, kind of like Frito-Lay, or is this just something that's for now? Do you think this trend will change at all?
Yeah, awesome observation. And I read your piece this morning as well, and saw exactly you highlighted exactly what we're seeing. I talked a little bit about functional snacking. I'd say the second biggest insight that's come up is this idea of globalization of flavors, which is just consumers expecting a lot more from intensity of flavors, variety of flavors. And so we bring that to life in our core brands like Lay's. To your point, we probably do have 20 to 30 different flavor varieties out there. We also bring it to life in different forms, and we also bring it to life through different packaging. So I think it's for us, it puts a lot of ownership as category leaders to make sure we reinvent ourselves on that. But for sure, we're seeing that.
Yeah, I mean, when I was there, it was only a couple of flavor varieties of Smart Food popcorn that I actually even knew existed. Now there's plenty more in the snack food aisle. But I mean, when we look at it, is there a stress on some of these companies like PepsiCo to get all of those to the aisle? And at some point, there's only so much shelf space you can actually use in the stores themselves. So I mean, at some point, some of these things have to go, right?
Yeah, for sure. Well, look, we talk about, in fact, that's why we're excited about all of the work going on in our omni-channel business. I mean, we tend to talk about omni-channel in the sense of accessibility and relevance. And so, we want to be wherever our consumers are. In some cases, that means in a store, in traditional retail. In others, they want it brought to their house. In others, they want to pick it up. And so we try and make sure that we've got not only the variety people want, but that we're there to provide the relevancy on the occasion in which they're snacking for.
And it sounds like today, this coming week is the week to deliver on all of the expectations. But Mike Del Pozo, thank you so much for joining us, sir. Happy holidays.
Thank you. Thanks for having me. Happy holidays.
All right, well, coming up, student loan debt reaching record levels. Why one plan to help people use their 401k to help solve it might do more harm than good. The co-founder of a startup pushing for a different solution joins us for more right after this. Welcome back. Student debt, of course, always on this show is in focus, but Republican Senator Rand Paul recently introduced a bill that would allow Americans to dip into their 401k savings to pay down student loans. The Higher Education Loan Payment Enhanced Retirement Bill, or HELPER Act, would allow tax and penalty-free withdrawals up to $5,250 a year. And joining us now to discuss is the CEO of Future Fuel IO, Laurel Taylor, joins us again in studio. And Laurel, when we're breaking down this bill, very interesting, on Twitter, Senator Paul got absolutely slammed. What the kids call getting ratioed. He got ratioed pretty tough. The comments on there are a lot more than the likes when he introduced this. But I mean, it's an idea that doesn't necessarily sound like a good fix to a long-term problem, letting people use money that's supposed to be going towards retirement to pay down student debt.
Indeed. Well, and if we look at the data, and MIT AgeLab just conducted a year-long intensive study sponsored by TIAA, what they found was that 86% of American adults cite student loan debt as the primary driver in their inability to maximize their 401k and retirement savings, while 24% have saved absolutely nothing.
Yeah.
So what's challenging about this, if we look at those who finally do participate in retirement savings, we, those of us with student debt, are twice as likely to have an early withdrawal of funds from our retirement savings plans to pay down student debt. So the challenge is that this behavior already exists in the market today. We already have borrowers who are depleting their retirement funds. They're paying a 10% penalty. They're also paying federal and state, potentially state income tax. And so the challenge that we have is whether we're delighted or totally disgusted with the idea of borrowing from our 401k savings plan.
Yeah.
It's already happening today with great penalty.
And even if you don't want it to happen, it's going to be happening.
Why
so.
is it such a bad idea? Why don't you just want to hurry up and pay off your student loan so you can start really focusing on the future? Why is it such a bad idea to do that?
Well, compound interest, as we know, works its wonders. And the earlier that you start compound interest on wealth, the greater. If you put 10K in today, 10 years you'll be at 20, another 20 years will be at 40,000.
Yeah.
And so missing out on those precious years in your 20s has really a devastating effect long term.
Yeah, especially if you look at the stock return this year, and of course it's not average, but if that's better than some of the interest rates you could be getting on student loans now. Of course, you push for other bills. We're not going to delve into that because we talked about it last time. The ones that might help students actually donate into a company match program like a 401k, but specifically for paying down student debt. I'm still more on that side than what we're seeing from Rand Paul.
I'm right there with you.
But when we look at what people can do outside of just laws that might get enacted, what's some advice for people out there struggling with student debt, setting them up for 2020 to help tackle the problem on their own, maybe not waiting for Congress to help?
Absolutely. Well, we can't wait because compound interest on debt is working against us every day. And so we're very excited to talk about our snackable actions. We debuted in our last discussion the opportunity to reassess if you are on the right repayment plan. And so we have launched, as of last week, we've officially launched Reassess, which enables users in 56 seconds to create an account, in 5 minutes to understand, out of all of the different federal programs that down to the state level, sometimes even down to the county level.
Yeah.
I know you spent time in Plano, so we have a large independent school district, I'm from Texas, launching Reassess. And it enables users to understand, bottom line, if they were to switch the repayment plan they're on, what are the dollars in their pocket that they could put back in their wallet? Or what are the other types of repayment programs that they are eligible for that can save really anywhere from $15,000 to $56,000 over the life of that loan, which is super exciting.
Yeah, for sure. And also, I mean, as we continue to learn more about the student debt problem, it's not just something that impacts the students themselves, but also the adults struggling to pay for this as well. So everyone really could use a little bit more information across the board. But Laurel Taylor, thank you so much for coming back to talk to us about there. And our thanks as well to Chris Ruby for being here for the full hour. And Heidi Chung, as always, thank you. Stay tuned to Yahoo Finance there. We're going to be heading to the New York Stock Exchange in 60 seconds time. Stick with us. All right, let's check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
All right, Zach, thank you. I am joined now by Tim Anderson of TJM Investments. Okay, Tim, so we've got another day of record highs across the board. We've kind of been saying this for 6 weeks now.
It's very constructive that the market is holding the breakout above what were the all-time highs from the summer on the NASDAQ, the Dow, the S&P 500. And really just being fueled by continually improving macro data, and now most recently, of course, some resolution of some of the global trade issues that have been overhanging the market for really almost the better part of 2 years.
And so I wonder how long the trade halo effect lasts in terms of the market.
Well, certainly, I mean, it's going to probably last through the end of the year, which is only a couple of weeks away. And even like as this week grinds on, we'll have some more macro data. We get housing starts and building permits tomorrow. We'll get industrial production tomorrow. And the market will just continue to see if there's additional progress on the macro economy. And, trade headlines will be in play.
Another thing I want to mention, I mean, a lot of time this year you see tax loss selling, right, where people sell the losers in their portfolio. But, I mean, a lot of people don't have losers in their portfolio because we've been up so much. So is that a boost to the market as well?
And also because we had such a sharp sell-off at the end of the year last year. Clearly the results for this year, if people are saying we're up 25%, we're up 28%, just put it in perspective that those results are skewed by the sharp sell-off we had in December of 18, but it does mean that there may not be as many losses for people to take in their portfolio as you might typically have.
All right, Tim, got to leave it there. Thank you so much. As always, Zach, back to you.
All right, coming up, we'll tell you why shares in utility company PG&E are tanking following a bombshell letter from California Governor Gavin Newsom. The ticker all over it starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Shauna Smith. We are breaking down the biggest stocks to watch today as the Dow hits a new intraday high. Right now, the Dow is trading up 171 points at 28,307. S&P and NASDAQ are also moving to the upside, with the NASDAQ up just around 1.1%. Well, let's start with our big 3 tickers of the day. Boeing, it's actually the worst performer in the Dow today. Shares are sliding into the red on reports that it may need to temporarily halt production of its 737 MAX jet. We also have Goldman Sachs winning an upgrade thanks in part to recent decisions by the Fed. And Tesla gets praise from one of its long-running bears. Well, first, let's get to the latest on Boeing. Shares today are falling off almost 4% in intraday trading. Now, the move to the downside comes after the Wall Street Journal reported that the company is considering either cutting back or suspending production of its 737 MAX jet. Now, this coming after Boeing cut production by 20% in April. Jared Blickery is with me at the Wi-Fi Interactive board. And Jared, when you take a look at this report from the Wall Street Journal, put this in perspective for us. What does this mean for Boeing?
Well, it's not just Boeing, there's suppliers as well. If you take that April move when they cut production from 52 to 42, they were still paying their suppliers for parts. You take a company like Spirit Aerosystems, they make the fuselages for Boeing, and if the board comes back with a decision today, and we could get an announcement any minute that curtails production, maybe even to zero, that could all change, and we could see these stocks get hit even more. So if we take a look at Boeing, it's down nearly 4% today. It's not a disaster, but when we look at the year-to-date chart, we're going to find that it is at critical support. That comes in at 320. It's been tested a few times in the past, and my concern is if it breaks, we'll probably see another 5 to 10% move lower. And of course, Boeing being the size that it is, because the Dow is price weighted, that's also going to drag on the Dow.
Yeah, Jared, what's interesting to me, what sticks out from that chart, obviously we've seen the pullback from the initial reports, but year to date, the stock is still up around 2%. So I know that you just said that we could see maybe a 5 to 10% pullback, but there's some people out there in the street that are saying that maybe we could even see a bigger pullback in Boeing if this in fact is the case.
Yeah, I think that's possible too. From the beginning, I thought the stock price would crash a lot more than it already has, and so it's proven to be resilient. If we take a 5-year picture, so here's Boeing. This is obviously a huge move here, and it's still maintaining most of these gains, but it could easily drop to the 300 level, maybe even 280. My concern then would be what happens when they finally ramp up production again. How long does it have to base before it can launch higher? Only time will tell. What I can tell you is their competitor, which is Airbus, their biggest competitor, has really outperformed this year. So let's take a look at year to date. That's 5 years. And we can see Boeing up just barely 2%, Airbus up about 54%.
All right, thanks, Jared. Well, from the worst performer in the Dow to one of the top performers, we have Goldman Sachs today getting an upgrade on the stock. Citigroup raising its rating on the bank to buy from neutral, saying that it sees upside for the stock as the Fed keeps interest rates low. Now, Citi hiked its price target to $255. You can see the stock trading today at $229. Brian Chung is with me. And Brian, when you take a look at this call from Citi on Goldman Sachs, why are they changing their mind?
Well, the analyst, that's Keith Horowitz, just said we were wrong when we said in October that many regional banks and the large banks like Goldman Sachs were vulnerable to really what was the flattening yield curve at the time. Keep in mind that the banks have largely been underperforming the market between April and November of this year. A lot of that because of the flattening yield curve. When the yield curve is flatter, that makes it hard for banks which tend to borrow short and then lend long. So what we saw, though, over that time is that ever since the trade optimism, we've actually seen the yield curve steepen again. So the yield curve since that point in time, around November, has actually peaked at around 26 basis points when you measure the difference between the 10-year and the 2-year. So here's a macro story that Keith Horowitz over at Citigroup is saying, look, I think Goldman Sachs can actually benefit off of a steepening yield curve here. There are a number of other banks that he said would also get an upgrade as a result. He cited Citizens Financial Group based in Boston, Regions Financial down the south, U.S. Bancorp over in Minneapolis. So all of these stocks are really the regional sized banks. These are not banks that you would expect to be the size of a Goldman or a JP Morgan Chase or a Wells Fargo, for example, but still sizable super regional banks above or between $120, $250 billion. So pretty substantial, saying, look, I just think the operating environment for these banks is a little better than maybe we thought earlier in the fall.
And what's interesting to me is the timing of this call, because even though they're saying that the reason that they are doing this now is because the Fed signaled the fact that they're going to keep rates at least steady for the time being through 2020. But when you take a look at some of the big bank stocks, we know that they're bullish on Goldman Sachs, but the XLF, for example, the SPDR ETF is up just around 15% since the start of September. So it almost seems like they might be a little bit late to this call.
Oh, absolutely. But when you look at the overall picture, you mentioned it was in the last 3 months that you've seen that trend. The last 3 months have been the rallying point for the banks so far. Like I said, I think between April and November, the KBW Bank Index that measures a lot of regional banks, they were underperforming largely the S&P 500. I mean, granted, the S&P 500 has had a great year, up about 27% year to date, but the KBW Bank Index and other banks, including Goldman Sachs, took a much longer time to get back to that point in time. Goldman Sachs, I do want to note, they were kind of trading up and down throughout that time period, but now you have Goldman that's trading 33%, positive year to date. That is actually now outperforming the S&P 500. So now you wonder to what degree maybe some of those on the street like Citigroup are maybe getting too bullish, right? I mean, when you say that Goldman Sachs now had a 255 was the price target that Citi now has, that presents a pretty high upside. You might be saying, well, it's already above and outperforming the S&P 500 in a year where everyone thought financials were going to get crushed because of what the Federal Reserve is doing. That has not appeared to be the case. So it'll be interesting to see if maybe there are some other sell-side analysts that say, hey, maybe that's coming in a little bit too hot. We can maybe pare some of those expectations back. But for the time being, it seems like the banks have actually been holding pretty well so far this year.
Certainly has been. All right, Brian, thank you. Well, moving on, we're also looking at shares of Tesla today. They are jumping. Now, Credit Suisse is saying that the automaker has, quote, a clear competitive advantage over the rest of the industry when it comes to battery production. This coming as shares touched a 2-year high on optimism for Tesla's China factory. Dan Halley is here to break all of this down for us. And Dan, I want to start with the call from Credit Suisse because this is a notorious bear on Tesla. He's actually saying that things don't look as bad as maybe they once seemed. Why is that?
Yeah, it really has to come down to the fact that Tesla really is a leader as far as batteries and software go, and that's essentially what our own Rick Newman has been saying for a while. This is more or less a battery company, and that's really where they're going to make a lot of their bread and butter. They are the leader when it comes to getting these vehicles the distance that they need for electrics. That's something that a lot of people have, that kind of range anxiety. They had one of the first to market that was for the mass audience in the Model 3 with a vehicle that could go more than 300 miles on a single charge. It's under 45,000 if you have the right incentives, or under 40,000. So that's really kind of the thrust of it. And then, you look at something like a Ford that's now jumping into the space with its Mustang. You look at what other automakers are doing as far as electrification goes. And it really is Tesla that seems to be driving this conversation and pushing these companies. So they are the leader as far as the technology goes. And it looks like Credit Suisse is finally coming around and saying, yeah, we'll give you that.
Yeah, Dan, what's interesting, though, it seems like the war almost between the bulls and the bears seems to be simmering down just a little bit because we're used to such polarizing takes when it comes to Tesla. And this one almost seems like it's kind of right in the middle.
Yeah, and that's really, I think, the way that this kind of conversation about the company is going. They've gone away from the issues that they had, to a degree when it comes to production. We're still seeing some, pullback as far as when we'll get the new Cybertruck or the Model Y. We're still waiting on those to come to market. Obviously, China and the rollout there is going to be very big, but we're seeing some vehicles come out already from those factories out there. So this is something that I think we're going to just see more of a middle ground for Tesla. It's not going to be, perhaps this high-flying stock for as long as it will be, but it's also not going to crash as far as Credit Suisse may have thought that it would be. I think it's really just coming down to the fact that it's a company that's maturing. They've managed to get their vehicles out on time now. They're not really, you don't hear these stories about everybody from the janitor to the floor worker being forced to try to help with deliveries anymore. So hopefully it's a matter of, Elon Musk and crew kind of getting this company set and act more like a major automaker.
Or Elon Musk, I guess, sleeping on the floor or under his desk, as there was reported a little bit. All right, Dan Halley, thank you. Well, coming up, the bulls are charging on the heels of the U.S.-China Phase 1 trade deal progress. But are they at risk of getting burned? We've got the CEO of China Beige Book joining us with his reaction next. The latest on the Phase 1 deal with China. White House economic advisor Larry Kudlow went on Fox News earlier today with some details on the Phase 1 deal.
These deals are both pro-growth, and yeah, they do remove some uncertainty, and they also increase incentives to invest, and they're also going to double our exports to China, just to name a few things. I think it's important that people understand just how important these economic growth measures are going to be.
Joining us now for more on this is Leland Miller. He's the CEO of China Beige Book. And Leland, when we take into account what Larry Kudlow just said in terms of removing some of the uncertainty, what do you think of the Phase 1 deal with China?
Well, we finally know what's in the deal, but it'll be a long time before we know whether China's going to live up to it. So there are some very big numbers on the purchases side. There's some very optimistic thinking on the IP side. Look, if the Chinese meet all their obligations over the next 2 years and there's so little tariff relief from this, then this will probably be a good deal. The question is will we get anywhere near what has been promised? And that's been the problem with every China deal we've ever had.
Well, what's the best way to address that then? Because that is the big question mark out there, whether or not we can get China to follow through with its commitments.
Well, the reality is that they have to be worried that this will continue to escalate. And that's the reason they came to the table. It's the reason they dealt this time, is because they looked into President Trump's eyes and maybe they didn't believe him at first, but eventually they kept seeing more and more tariffs and they got scared that, hey, this can go really, really bad for us. They came to the table, they made a deal. They have to continue to be fearful that there are consequences for non-adherence. And I think that's the issue. You look at 2020, everybody knows President Trump needs a relatively good economy if he's going to win the election. So do the Chinese have more leverage as we get closer, or do anti-China vibes return to such a degree that maybe the president wants to stir up a little fight in order to gain some traction? So there's a bunch of things that could happen over the next year or so that could disturb the waters.
And I know you watch us very, very closely. From your experience, what you've seen between the U.S. and China, their relations in the past, how, I guess, positive or how confident are you that we will get some sort of Phase 2 deal or whatever they want to call it by that 2020 election that you were talking about?
Yeah, we've said for months there's not going to be a Phase 2 trade deal. Now, we have to put a little asterisk on that now, because originally the Phase 1 deal was going to be a much bigger deal. They're denying it now. There was going to be a bigger deal. And what they released was actually quite small. There were no tariff rollbacks. There were only rate reductions. As we go into next year, we just had Phase 1A. Let's say Phase 1B is still possible. You could still see some rollbacks. If the stock market goes down, you could see the president try to promote some negotiations, some rollbacks in order to get people's blood temperature up. So there's not supposed to be a Phase 2, but there's plenty you can do considering how small Phase 1A is. So you could have some tariff talk in 2020, but the idea that you're going to go to a massive escalation, that has been tamped way down.
Why do you think the rollout that we saw with this deal, why do you think it was so chaotic?
Well, because they started with a bigger deal.
Yeah.
So they started with a bigger deal, and when the president wanted to release it, he said, let's roll back all these tariffs, and he started to socialize the idea with members of Congress and with private associations, and they all balked. There was nobody who was willing to go out publicly and speak on the president's behalf saying this is a good deal. So they pulled this way back. This wasn't a botched rollout. This was a change in tactics midway through the day that sort of rolled out this way. So all things considered, they ended up with a more conservative deal that was going to get a lot fewer people worked up. And that's why this thing has succeeded thus far. Had they rolled with what was originally the rumored deal that the media were covered with all these rollbacks, there would have been enormous pressure on the president to pull this back. And so I think he saw the tea leaves and he moved forward.
So what we have now, whatever you want to call it, Phase 1A or whatever, the dumbed down version, not dumbed down version, but the smaller version of what they were initially going for, how big of a boost or how much significance is this for the U.S. economy?
Look, the tariffs are not much. What's important about this deal for both the Chinese and for the U.S. economies is that it's wiping a little bit of uncertainty out of the way. Now, that doesn't mean that President Trump, as active as he is not going to further cloud the waters with some other move. But firms are not investing. And I think the biggest problem from the tax bill is that it didn't lead to a CapEx revolution the way people were saying. If this can take some uncertainty off the table and you've got USMCA and you've got a Japan trade deal, does this make firms more optimistic about the next year, willing to invest? That's the bonus from this, not the fact that a few tariffs are coming off here or there.
Right, and that was exactly what we heard Larry Kudlow say in that South that we played earlier. Right, Leland Miller, thanks so much for joining me today.
Pleasure.
Well, coming up, can there still be a Santa Claus rally to end the year as the market hits new records? Well, a top expert joins us just ahead. Welcome back to the ticker. Let's check in on the markets. We're still seeing green across the screen with the Dow up 141 points now, so off its highs of the day. In terms of sectors, we're seeing the biggest outperformance in energy. That's leading the way today. Also seeing some strength in technology and healthcare. Let's head to Scott Gamm, who's standing by on the floor of the New York Stock Exchange with more. Scott?
Hey there, Shauna. Well, as you mentioned, the Dow up nicely right now at a record high and well above that 28,000 level. The best performing stocks in the Dow right now are names like Pfizer, UNH, Goldman Sachs, and Apple. Now, this list is very important. It's important to see UNH and Apple in the list of gainers because these are really big weights within the Dow, helping to offset the large decline we're seeing in Boeing today, down about 4%. Boeing is another big weighting in the Dow. Now, let's move away from the Boeing headlines for a moment and just talk about the stock, because right now Boeing shares just below $330 a share, approaching the recent low from mid-August when the stock went as low as $320 a share. That mid-August level was the low for the stock since that most recent March 737 MAX crash. Now, if you remember back in mid-August, we were worried not necessarily about Boeing itself, but more so the inverted yield curve and worries about a recession. That's one reason why Boeing sunk to that level. So just some perspective as we look at how resilient Boeing stock has been so far this year, even with all this headline risk. Shauna.
All right, thanks so much, Scott. Well, straight ahead, why investors may not want to bank on a Santa Claus rally happening for a second straight year. We're going to break all that down with our next expert. Well, Santa Claus rally is at the top of investors' wish list this year, and they just might get it. While markets are climbing after the U.S. and China agreed to a phase one trade deal late last week. And with some geopolitical risks off the table right now, our next guest says that we're getting a running start on that rally. Joining us now is Sam Stovall, Chief Investment Strategist of U.S. Equity at CFRA. And Sam, this is what everyone wants to know. Are you bullish for the end of the year, and are we going to get some sort of Santa Claus rally?
Well, I think so. I mean, offset, Jared just reminding me of the definition of the Santa Claus rally. It's the last 5 trading days of the old year and the first 3 of the new year. And believe it or not, we got it last year. Even though we tanked leading up to Christmas Eve, we did rally off of that point. This year, we're rallying ahead of that point. So some could say you're not going to get coal in your stocking, but the real question is, what do you get between Christmas and New Year's?
What do you expect to outperform at the end of the year and then into 2020?
Well, right now it's really the cyclicals that are leading the way. We're seeing technology do very well. Financials have started to move up, whereas utilities have been beaten up. Real estate is exhibiting the glide path of a crowbar. So basically investors are saying, look, with a lot of uncertainty coming off of this table, the possibility for an improvement in earnings and still easy monetary policy, that would imply a leaning toward the cyclical sectors.
Do you think whatever sort of deal that we got, the phase one trade deal, do you think that was largely baked into the market already, was already priced in?
No, because I think that we had false hopes so many times before, only to be tweeted away. So I think a majority might have been baked in. We did end up with that mid-December low, if you will, where we have a month-to-date decline that typically happens in December. even though December does end up being the strongest month of the year, rising almost 80% of the time. So it seems as if we are getting that bounce off of that mid-December low.
So with the phase one trade deal, some of the uncertainty that we were talking about in the market has been taken off the table. When you take a look at into next year, you're trying to figure out some of the risks, trying to identify those in terms of the market. What do you think the market is most worried about?
Earnings, because right now I think we are directionally challenged, meaning the prices are going up, but earnings estimates continue to come down. So the real question is, will the uncertainty coming off of the table actually then lend toward capital expenditures increasing, as well as consumers continuing to do their part? And will we see the S&P 500 earnings go from the 8.3% current estimate for all of 2020 up to some double-digit estimate?
Do you expect to see businesses start to reinvest and get a little bit more confident in the new year?
I think they will. There's an old adage that prices lead fundamentals. And you question, well, why are prices doing so well if a lot of people are still so cautious? I think it's because the money that is driving this market is assuming that we end up underestimating earnings growth and that we do actually start to see companies invest in themselves once again.
It's interesting. One note that caught my attention this morning was out from Goldman, and they were talking about stock buybacks, the fact that they declined around 15% this year, and they expect another 5% drop into 2020. Do you think that this could spell some trouble for the market?
No, actually, conversely, I think that the lack of relying on stock buybacks to bolster earnings per share is an implication that executives feel comfortable that the top line will end up supporting the bottom line, where they don't have to use artificial measures such as share buybacks in order to do that.
And just your reaction to the Fed's decision last week, just keeping rates steady and forecasting no real change in 2020. Do you think that was the right call in terms of where we stand right now?
Yes, I do, because the Fed was really reluctant to start expending its interest rate ammo, if you will, because right now, with us being at 1.5 to 1 3/4 on the Fed funds rate, that's not a lot to fight the next recession. So I think the Fed wanted to make sure that it had enough ammo with which to do so. So yes, it had to show that it was attempting to be ahead of the curve, not behind it, but at the same time, they didn't want to overspend.
Right, Sam Stovall, thanks so much for joining me today.
My pleasure.
Well, coming up, how will China's apparent commitment to buy more U.S. farm goods impact prices for basic commodities? We've got the details next. Welcome back. Let's get to our next group of tickers. PG&E is nosediving today after an unexpected move by California's governor. Micron Technology is popping after a bullish call from a top research firm. And a crackdown that's reportedly coming against Live Nation by the DOJ is sending shockwaves to the entertainment and sports ticketing industry. Well, first, let's get to PG&E. Shares today are plunging after California governor rejected the power company's bankruptcy restructuring plan. You can see the stock down just around 6% so far today. Last 2-day decline of almost 10%. Well, PG&E has until tomorrow to address the governor's new conditions. Jared Blickery is back with me. And Jared, when you take a look at this, obviously a huge move to the downside here for PG&E. Why was the plan rejected?
Well, the plan has a number of problems. First, PG&E has $23 billion of debt currently. The current restructuring plan would leave them with an additional $10 billion in debt. They're in bankruptcy court, so why not use the functions of bankruptcy court, which is to wipe out debt or to write it down. That's what always made sense to me. You can also wipe out the shareholders. And Newsom's plan would recapitalize the company with $20 billion, with looks like the state being the largest shareholder here. And then it would be poised to be taken over possibly by sometime, either by another entity or by the state itself, and also have a new board of directors. Clearly the leadership has to change at PG&E. It's just riddled with problems, and things are kind of getting worse here.
Jared, do you think that this could put the whole Chapter 11 timeline here in jeopardy, given the fact that the deal was rejected?
I think so. And Gavin Newsom knows this is a huge issue for him. This is a big part of his legacy, because he came into this office about the same time that PG&E was entering bankruptcy. There's all kinds of outrage over this, as there should be. And especially after the rolling blackouts that we had, or that they had in October, this isn't going to go away anytime soon, and it needs to be handled intelligently. I mean, if you take a look at the chart here, we can see, yeah, it's down another 3 or 4% today. But if you look over the last 2 years, which roughly coincides with the last peak that it had, you can see it's down 80% right now.
Jared, what do you think shareholders want to see? Because as you just highlighted in the charts, it has been a serious underperformer so far in 2019.
Well, the shareholders want to keep their money. They want to be made whole in some way. They don't want to be wiped out, I should put it that way. But that's what bankruptcy court is for. And the current plan would keep shareholders solvent. It would also help the bondholders. Now, even in Newsom's new plan, it doesn't look like the bondholders are going to have to take a haircut, but I'd throw that out there as an additional option. Why do they have to be made whole when this company is just hemorrhaging money, and the infrastructure in California is just in such a state of disarray?
All right, Jared, we'll leave it there. Thank you. Let's move on to a bullish call on Micron. Now, Susquehanna is seeing the chip maker making a, quote, meaningful recovery in revenues for the second half of the year. We have Dan Howley here to break this down. And Dan, when you take a look at the stock reaction today, it's moving to the upside, up over 4%. It's been a huge outperformer so far this year, up just around 70%. Why does Susquehanna think that there's still room to run for Micron?
Yeah, it looks like the big issue with the chip market, with the unavailability of chips, kind of the tight production lines, that seems to be going away, and that's going to be across the board. So obviously Micron's going to benefit from there. But we've also seen companies like Broadcom, for instance, come out and say, look, we believe that the tightness is going to ease up, and we're going to be able to see improved revenue going into the next year. So I think that's really part of a larger conversation as far as the chip companies go. It's been pretty tough, especially as far as the memory companies go. Micron obviously does solid state memory, and so they're going to be able to benefit from that. We might also see prices potentially increase as we see the tightness of the market kind of improve over there as well.
Hey, Dan, I know you watch this space pretty closely. How does Micron stack up against some of its competition? Because I'm just taking a look at NVIDIA's chart here, and so far year to date, that stock is up just around 70% as well.
Yeah, I think it's different as far as the different types of, they both make chips, but NVIDIA's chip is different than Micron's chips. Micron's focused on that solid state storage, whereas NVIDIA is focused on, AI and graphics chips. NVIDIA's problem was mostly to do with overhang from its rapid production of graphics cards that were going into those bit mining machines. They finally got rid of that. They also had issues with overseas sales for people purchasing the servers that they're interested in that are powered by NVIDIA's AI capabilities. So NVIDIA's kind of improved there, whereas Micron kind of didn't have those issues as far as an overhang or as far as anything to do with people not purchasing new servers, because they're not going to be in that business. Micron really is part of a business where they're going to put their products into other devices, and that's why you're starting to see them have that kind of recovery, whereas NVIDIA is kind of on a different path of recovery.
All right, thanks so much, Dan. Well, moving on to one stock that we are watching today, and that's Live Nation. Now, the Justice Department is preparing legal action against the owner of Ticketmaster for its ticketing practices. This is according to a report from the Wall Street Journal. Now, Live Nation is accused of strong-arming concert venues into using the Ticketmaster platform. You can see the two-day decline in the share price there at just over 7%. Brian Chung is back with me. And Brian, just break this down for us, what exactly this means and why the DOJ could be looking into Live Nation. production.
Yeah, well, today shares are falling around flat, but it did fall almost as much as 10% on Friday when the news did drop from the Wall Street Journal that Live Nation Entertainment will be facing legal action from the Justice Department. Again, it hasn't happened officially, but the Wall Street Journal reporting that this is something that should be expected to happen soon. The Justice Department is going after Live Nation for antitrust. Effectively, what they're arguing is that because Live Nation is trying to drive, or allegedly trying to drive, concert venues into using Ticketmaster, which is a subsidiary of Live Nation, that they're effectively driving competition out of the space because Ticketmaster is about 80% of the market. So when they did merge, because Live Nation did purchase Ticketmaster in 2010, they made an agreement with the government that basically said, we agree that we will not be driving prices higher. We'll actually give away some of our intellectual property so that there could be other competitors that could use this ticketing software as well. What we've seen since that point in time, even though it's been almost 9 years since that merger, is that hasn't been the case. Access, or rather AXS, is one competitor in the space who has not really been able to monetize this. So a serious issue with Live Nation there. But again, the stock is going down, and it seems like it's settling down at this price. But look, this is a stock that was rising almost as high as 50% year to date, beating the S&P 500, but it has since come down. But for what it's worth, the stock is still up 33% year to date.
And what's also interesting is that members of the House are also probing some complaints over Ticketmaster, too. I mean, it's extending beyond the DOJ. Is there any sort of timeline on this?
Not necessarily. I mean, the Justice Department would need to make this official, but for what it's worth, these types of antitrust litigations tend to be pretty long and drawn out, and you have litigation on both sides. Obviously, Live Nation telling the Wall Street Journal that they are denying these allegations. The CEO was provided a comment to the paper saying that we don't agree that we've been engaging these practices. But I mean, I think you could argue that. I mean, I've used Ticketmaster, so anecdotally, I have noticed that prices have been quite high for a lot of these big events at MSG, or even at smaller events at like a Brooklyn Steel and whatnot. The fees are ridiculous too, right? I mean, you might even see a price that's quoted online, then you have to pay another $15, $20 on fees because of delivery, even though all you're doing is just showing it on your mobile screen. So they're saying that the ticket space, which it is kind of shady for right now, is something that maybe Ticketmaster and Live Nation are responsible for. That those will be topics and issues that are explored.
Well, especially when you, like you said, account for 80% of the market, then it is a little bit hard to argue against that. All right, Brian Cheung, thank you. Well, straight ahead, the outlook for commodity prices in the wake of a Phase 1 trade deal between the U.S. and China. A top expert weighs in next. Welcome back to The Ticker. I'm Shauna Smith. Let's give you a quick recap of what we've covered in the show so far today. Our first ticker was Boeing. It's sinking into the red following multiple reports that the company may temporarily halt production of the 737 MAX jet. Now, Boeing is struggling to obtain regulatory approval to get the plane back in the air, potentially adding billions of dollars in costs for Boeing next year. Our second ticker was Goldman Sachs. Now its stock is scoring an upgrade to buy from neutral by Citi, the bank saying that Goldman's brokerage unit is best positioned to capitalize on interest rates being kept low by the Fed. Citi also hiking its price target on the stock to $255 a share. That's up from $220. Our third ticker was Tesla. It's winning some positive comments from Credit Suisse, which has long been a bear on the stock. The bank saying that it was impressed by a recent tour of Tesla's Nevada Gigafactory and that the company has a significant advantage over its competition in its development of electric vehicle batteries. Let's check in on the closing price of oil today. Crude is currently trading, let's put it up there, up slightly, up around 0.2% at $60.18 a barrel. This coming as President Trump insisting that China will buy $50 billion worth of agriculture goods, quote, pretty soon as part of the Phase 1 trade deal agreement. But analysts are skeptical, saying that even though China promises this, the market may not be able to support purchases at that level. Joining us now for more, we have Scott Bauer. He's the CEO of Prosper Trading Academy. And Scott, when you break all this down, the $50 billion worth of goods, what do you think? Is that possible?
Well, it's certainly possible, but it's a matter of over what time frame. And pretty soon, what do you put around pretty soon? China bought just under $9 trillion last year. So, or excuse me, $9 billion last year. So looking for that 50 number from the U.S., I don't know what time frame they could possibly do that in without completely oversaturating the marketplace. Now, the fact that we do have these talks and maybe there is a Phase 1, it's not signed yet, maybe there is a Phase 1 deal, that's great. The market is reacting positively to that. However, there are still so many questions here. And, you know, the biggest one to me is the question of, can China even fulfill this and over what time frame? So I think that the rallies that we're seeing in soy, in corn, and even quite frankly in oil, all should be sold.
Scott, I mean, Goldman Sachs out today raising its 12-month commodity returns forecast to 6.4%. That's a 3% increase. This is all based on what seems to be the subsiding geopolitical tensions. When you take a look at this, do you expect almost a rebound in the commodity forecast going into 2020?
I mean, on this entire news here, I think it's really a buy the rumors, sell the news. And we're getting this little bit of euphoria. I'm looking at this as a trade. I'm not necessarily looking at it as a investment for all of 2020. I think over the next 3 months here, as we get a little bit more indecisiveness of this Phase 1 deal and then what may happen afterwards, I think this is all a fade, meaning sell these commodities. However, if we can, get through the season, get through the year, get through the first half of the year and closer to the elections, and where I do think that not only Phase 1, but maybe the next 2 or 3 phases of a deal could come together, that's where I think we see a big boost up across the commodity space. In the near future, though, I'm a seller.
Well, Scott, let's talk a little bit about crude specifically. Today, we have oil closing just above $60 a barrel. Do you think crude will be able to withhold that $60 threshold?
I really don't. And we've had some positive news, especially overnight, come out of China with some economic numbers there, so better than expected. However, you still have to look at the fundamentals here and the oversupply. Just look at last week's EIA and API numbers and the humongous build, the humongous glut that we have. Shale production is not slowing down at all. So I think when you look at the fundamental base of the oil space here, we do have an oversaturation. We don't have that global demand yet really ramping up. So I think that, again, this $60-ish range, which is the absolute top end of the range that oil is traded in over the last 6 to 9 months, I think it has to be faded.
And also, just Scott, so then it seems like you think that oil, the story here, it's more of a supply problem rather than the demand story.
No question about it. I mean, shale production at record. Yeah, shale production at record levels. I know OPEC is extending their cutbacks, whether it's to June or for the entire year, but it certainly seems like the supply is just plentiful, far, far exceeding any sort of global demand. Now, let's see, in the next couple months or so, if we do progress nicely with the tariff trade talk, and if we do continue to get decent numbers out of China, but more importantly, if we start to see Europe start to pick up a little bit, that may change my stance. But right now, it's all about oversupply and just the demand not being there.
All right, Scott Bauer, we'll leave it there. Thank you.
All right.
Well, straight ahead, a number of major economies across the world are showing new signs of momentum. Details on how investors can potentially cash in next year. That's next. Markets touching record highs today as global growth worries ease. We got two economic reports out of China today. Factory production and consumer spending, both of those topping expectations. So joining us now is Lisa Erickson, head of traditional investments at U.S. Bank Wealth Management. We also have Michael Purvis, founder and CEO of Talbacan Capital Advisors. Thank you both for being here. Michael, let me start with you. In terms of the economic data that we got out of China today, U.S.-China reaching a phase one trade deal. Does that take some of the uncertainty, at least for now, off the table?
Yeah, and I think it kind of sort of affirms that this bottoming narrative that goes along with things outside of the United States, has some real merit to it. How much, upside we really get from here, I think it's a much harder question to answer. But this bottoming, these bottoming patterns, the lack of downward momentum in a lot of the economic data, we're continuing to see that. We're not necessarily seeing it in emerging market equities reflected today on a day when there's a lot of green on the screen. But give that some time. I think that will certainly help, the broader EM and China asset classes there. But again, there's a big distinction I would like to make between bottoming and stability versus upside acceleration.
And Lisa, what is your take in terms of how you're looking at it from a market perspective? Do you consider the fact that we did get some sort of deal with China, the phase one deal, Lisa, do you consider that a win?
We do consider it a positive, and it is certainly encouraging. That being said, there's still the beginning of the road and more to be negotiated. So as you well know, we got the start in terms of delaying some tariffs and some ag purchases, but really the details as far as some of the sticky issues still have to be worked out. So overall, our outlook is more balanced in terms of where investors should be allocated. We're seeing, again, the resolution of the policy uncertainty as a positive, in addition to some of the economic momentum that you mentioned. On the flip side, again, there are some uncertainties that remain. So right now, we wouldn't go full on bullish into the market.
Michael, I was reading the notes that you sent over. You were closely watching volatility last week. Should we prepare for more volatility ahead, not only through the end of the year, but going into 2020?
I think right now, between here and December 31st, I think the table's probably set for continued melt up here, and that can easily carry through into January. Once you get out into later January and February, that's when I start getting a little bit concerned. If you look at a monthly chart of the S&P 500, you can see, just now we're popping above the upper band of that channel. This rally has been largely driven by valuation expansion over, almost 90-something% of it has been PE expansion over, from 12 months ago when things were really dire just ahead of the holidays. So a little bit of earnings concerns or weaknesses that start manifesting themselves into, in Q1 will be felt here, right? And then, of course, we have the Democratic primaries coming into clearer focus as well in February and March. Look, the markets have had a really strong run here. If you look at the year-over-year change in the S&P 500 right now, it is as strong as it's ever been during the 8 years of this rally. And typically, risk-adjusted returns after those are a lot lower. It doesn't mean they're negative. It just means that they're a lot lower. So to reset lower probably means some volatility in Q1.
Lisa, you mentioned before that you're striking a more of a balanced portfolio. How are you advising your clients into the new year?
So we see modest gains for next year. Our target right now for the S&P 500 is about 33.25, and that's with the expectation that we do get some continued growth in earnings, as well as multiples holding where they are. And really the basis for that is the fact that if you look at the fundamental side, both in terms of the macro economy or corporate earnings expectations, they look decent. And in addition to that, you've got a benign environment. Both the Fed and the ECB both announced last week that they're standing pat in terms of their policy and are willing to, particularly in the U.S., let inflation run hot. And the fact that you've got decent valuations. So we believe that's really a nice setup for some continued modest rise in the equity market.
All right, Lisa and Michael, we'll leave it there. Thanks so much for joining me. Well, we have some developing news on Amazon and FedEx that is hitting the wires. Jared Blickery has the latest. Jared.
Yeah, it looks like Amazon now has blocked third-party sellers from using FedEx Home and FedEx Ground services. And we can see the chart here. This is the price action for today. The stock was in the green, but then took a leg lower on that news, and it is slightly in the red, down about 1/3 of a percentage point. That might have been somewhat inevitable because Amazon itself stopped using FedEx for its own shipments, or at least the FedEx Ground service. But now third-party sellers will have to use somebody else as well. We can see the year-to-date performance of FedEx. It's been a troubled stock. It's only up 2%, and they do have earnings that they're releasing this week. The last two earnings statements have been disappointments, citing mainly international troubles. So investors are going to key into this and figure out just exactly what the game plan with FedEx is, especially for this critical holiday season.
And we can see FedEx moving lower here. Jared, thank you. Well, coming up, new moves by Uber's co-founder and former CEO Travis Kalanick are helping send the stocks to new, or really send the stock leaping. Details on all of that next. Welcome back. Let's give you a quick recap of the tickers that we've covered in the show today. Our first was Boeing. Now it's sinking after multiple reports that the company may temporarily halt production of its 737 MAX jet. Now Boeing is struggling to win over federal regulators on a plan to get the plane back into the air, potentially costing Boeing billions of dollars next year. You can see the stock off just over 3.5%. Our second ticker was Goldman, Citi upgrading the stock to a buy from neutral, saying that Goldman's brokerage unit is the best positioned among its rivals to take advantage of the current low interest rate environment. Our third ticker, Tesla. Now Credit Suisse, which remains a bear on Tesla stock, is giving some praise to the automaker after touring its Nevada Gigafactory. The bank saying that Tesla is well positioned ahead of its rivals in the development of electric vehicle batteries and is leading in areas that will likely define the future of car making. You can see that, I guess, semi-bullish comments, sending the stock up almost 6% so far today. Well, it's time for the last tick of the day, and it's Uber. Now, Uber co-founder Travis Kalanick has unloaded $350 million more in stock this month, bringing his total proceeds to more than $2.1 billion. This follows the share lockup that ended on November 6th. We have Jared Blickery, Brian Chung, and Dan Howley all back with me. And Jared, I think the biggest question that stands out to me is why is he selling so much, and why is he selling it now?
Well, just take a look at the stock. It's been underperforming since it IPO'd, and what is he going to do now? He doesn't even have control over the company. So I think it makes sense that he's reducing his exposure here. If he doesn't believe in the direction of the company, there's just really nothing he can do about it.
Brian, there was another report today that caught our attention. The Wall Street Journal reporting that Uber is in talks to sell its Uber Eats business just in India, though. I know it's probably a relatively small market share of their whole Uber Eats business, but what do you think the implications are?
Yeah, well, you don't want to extrapolate too much from what they're doing in India with what they're doing elsewhere around the world. In the United States, the Uber Eats business, however, is such a huge part of their growth strategy. So you do wonder to what degree maybe them pulling out of India shows that they could have concerns about the Uber Eats profitability here in the United States as well. But for the time being, it looks like this is just part of their strategy globally to try to rejigger, kind of recalibrate what the proper amount of services that they provide in each country looks like.
Dan Halley, I know you track Uber. I mean, the stock is up over 5% so far today, but since it's been public, it clearly has not been a standout, obviously a huge underperformer. What do you make of Uber's outlook really heading into 2020?
Yeah, it's really just going to be kind of a long-term stock that everybody's going to have to watch until it eventually reaches profitability. There are some people, analysts out there, who expect 2024 to be the year when it actually hits profitability on a GAAP basis. And as far as selling the India service, that's really the CEO, Dara Khosrowshahi, saying, look, we want to be either number one or number two in a market as far as Uber Eats goes, and if we're not, we're just going to bail out. And considering how much smaller they are than the local product, which is Zomato, they just decided that they have no chance there, so they're going to bail.
And Jared, real quick, do you think the street, since I know you watch the stock very closely, do you think the street has been satisfied with some of the changes that Uber has made over the past year?
No, the stock is net down from its IPO. It has underperformed by many different metrics. It's also been a bad time for IPOs over the last few months, although it's ticked up. Look, going forward, they have a lot to prove. They have huge, sprawling businesses. They're not a pure ride play like Lyft, so they need to hit and fire on all cylinders here.
All right, guys, we're going to leave it there. It's time to go beyond the ticker, and we're watching Visa. It's warning that cybercrime groups are targeting weaknesses in gas station networks to steal credit card data. So hackers are reportedly gaining access to those networks via email. They then scrape data from cards that have a magnetic strip and lack a PIN code. Dan, how big of an issue do you think this is? Because this could really affect a whole lot of people.
Yeah, I mean, this is basically just the world we live in. When anything is connected to the internet, someone is going to try to hack it, and that's exactly what's going on here. You know, before this, our own Michael Kelly had said that he had spoken with someone at an FBI conference who had explained that some people were actually sitting near gas station pumps in their cars and trying to remotely hack the PIN as it goes through the terminal. So this is something that people have been trying to get for a long time. It's easy access to credit cards. I think we just have to be more and more careful as we continue to use these items online.
Brian, do you think Visa and companies like that need to do more in order to protect their customers?
Yeah, well, I think for what it's worth, there are multiple types of authenticity that you can use. Credit cards aren't even just things that you enter into a swipe machine anymore with the scalping, right? In theory, the chip reader or also other types of maybe even the ones where you could just take your phone and just tap it to the terminal. Those things might present an opportunity to prevent types of scalping like this, although hackers may at some point maybe be able to figure out a way to get around that as well. But for what it's worth, Shauna, you, me, and Dan, we're all from New Jersey, so I don't even know how to pump my own gas.
Yeah, I know. Although I don't even like to admit that I live in New Jersey now.
Sorry.
Jared, what do you think of all this?
I can't believe that the gas stations were sending these numbers over the network unencrypted. All they got to do is encrypt the stuff. But eventually they have to replace the pumps that have the readers in them, so they modernize their systems. That'll happen with time, but these are always going to find a different way.
And Dan Halley, just when you take a look at this, I know that you track the tech sector obviously very closely. In terms of the best ways to protect, we heard what Brian Chung was saying, how they could best protect their customers. Are some of the other groups out there, because we just heard that Facebook news last week, are they trying to get in the forefront of this?
Yeah, I think, when it comes to just protecting yourself for something like this, there's really nothing you can do outside of having alerts on your credit card. If a gas station or something along these lines, a third party that you're using your credit card with is insecure, then that's not on you, that's on them. So just ensure that you have alerts on your phone, so anytime anything is purchased on your card, you'll get an update right away, and then you can contact your credit card provider or debit card provider and start to refute those charges and go through the process. Usually it's pretty simple, especially with all the leaks nowadays, so it shouldn't really hurt you too bad, but it can be a pretty annoying process.
And certainly are things that you can do to protect yourself. Dan, Brian, and Jared, thanks so much for joining me today. Let's take one more look at the markets before we let you go. The Dow up 128 points, so off its highs of the day. The biggest outperformer in the Dow is United Health. That stock up just over 2%, as well as Pfizer. That stock up just over 2% as well. We'll keep it right here on Yahoo Finance. We have the final round next.
Hello, everyone. I'm Jen Rogers in New York, and this is the final round. Stocks pushing to new highs here with a 4-day winning streak in sight.
Now, Miles, other than this, as factory data improves in China and home builder sentiment hits a 20-year high here in the U.S., we'll have more on that and all the market action coming up in just a bit.
Plus, Boeing, a big Dow laggard on reports it may cut or even halt 737 MAX production. We're going to have the very latest on that story. And Tesla shares are on fire here, on pace for the automaker's highest close in 2 years. We discuss what's behind the charged up performance. Plus, Goldman getting bullish on 2 big healthcare names. It is the final round call of the day. So Santa Claus coming to town, rally in full swing as stocks are trading at record highs. You're looking at new numbers you've never seen before. Right now, all 3 major indices are on track for their 4th straight session of gains. Look, a slew of stocks in the Dow hitting record highs, including Apple, Nike, JP Morgan, Microsoft, and Procter & Gamble. Sector-wise in the S&P 500, we have record highs for healthcare, technology, communication services, consumer staples.
Jen.
And I'm so excited for this one, Miles.
Yeah.
I feel like this means a lot to you. The financial sector.
As all viewers know, near and dear to my heart.
12 years, though.
Yeah.
I don't even want to know what you were doing 12 years ago the last time the financial sector was here.
That was Christmas 07?
Yeah. You couldn't even name, you didn't even know Berkshire was the biggest weighting in the XLF then.
I didn't know what the stock market opened 12 years ago.
So this is pretty crazy. This is, and to do it on a phase 1 deal truce, what is it?
So that's the thing, is last week a lot of people, I thought, more analysts than you would think, more people in the inbox, were puzzled by not fully puzzled, but definitely a sense of why aren't we up more on the news we got Thursday and Friday. But I think that the economic data we got this morning, the home builder sentiment, U.S. manufacturing data that's better than expected. We've got New York Fed manufacturing that's essentially saying 6-month optimism is back at its highest level in 2 months. And again, this isn't like amazing stuff, but what the stock market has been telling you over the last few months is a combination of we think a trade deal is going to get done. Yep. I didn't believe that was true, but here it is, right? And also that the economic outlook is better than we think, essentially, right? And so now, to some extent, the data are catching up with what the market has been telling you. But, today, Capital Economics hits the inbox with a view of re-accelerating growth in the second half of next year. And if that is going to come to fruition, we're going to start seeing it in stock prices like now, right? Or early next year, because again, I think we sometimes get a little bit nearsighted on the stock market, frankly, like what's the market doing today and why, but what's the stock market ultimately doing, right, over the long term?
Going up.
Well, discounting future growth, right?
So it's also going up.
Like it's saying, here's what's going to happen in 6 months. So, right, it would make sense if we think the outlook for next year is better than expected for markets to go up today.
I think, and not only, there's a lot of notes out on that this is a global story. Also, global markets are at an all-time high.
Everyone and their mother loves, international equities next year, right?
And so they've all been calling for that. Who did we have in? Mike Pyle last week. Yeah. He's now, turning pretty bullish on EM and Japan. And again, global markets right now have not been this high since January of 2018. And I think that whole re-accelerating story, it's like what's going to derail that right now? At least until the end of the year.
Right.
People seem
even
to be
Mike
thinking,
Wilson is bullish in the next 2 weeks.
So if Mike Wilson is telling you that if the water is okay, it's not terrible, a lot of people are going to be jumping in.
Right. And again, I think that there's a lot of, what's going to be really interesting next year is if the 1920 analog ends up being similar to 1718, right? Doesn't it feel in so many ways like December 2017? Like the Trump presidency might just be 2 versions of the same mini cycle. I'll be very interested to see if that comes through. But what the stock market is telling you today is that that's not likely to be the case. But, I guess we'll see what the mood is like at Davos. That'll be the tell. For more on today's market action, let's go to Scott Gamm, who's live on the floor of the New York Stock Exchange. Scott, it is a Monday, so there were some mergers. What's the story there?
That's right. We've got two to tell you about: International Flavors and Fragrances, ticker IFF, merging with DuPont's Biosciences and Nutrition unit. The combined operation will be worth over $45 billion. Now, IFF shares are tanking right now, down over 10%. It's actually the worst performing component in the S&P 500. I bet you didn't know that IFF was even a member of the S&P 500, but it is. Of course, DuPont shares are up slightly right now, but we tend to say that these merger announcements tend to lift the broader market. But today, I'm not so sure you can attribute the broader gains we're seeing to this deal and the deal I'm about to tell you about, just because we've got so many other powerful headlines powering the market. Of course, some of the trade headlines we got on Friday. Now, the second deal to tell you about involves Intel. They're acquiring a $2 billion Israel-based AI company called Habana Labs. So Intel shares are up slightly right now. Intel is a Dow component, guys.
All right, Scott Gamm, live on the floor of the New York Stock Exchange.
So after months of uncertainty and delays, Boeing is considering cutting back or altogether suspending production of its 737 MAX jet. This, according to the Wall Street Journal. Yahoo Finance's Alexis Keenan joins us now with more details. And Alexis, it's a big down day for Boeing on a day where the Dow is at a record here. How is Boeing responding right now to these reports?
So Boeing has issued a statement to Yahoo Finance, and they say this, not exactly admitting that this discussion is going on, but telling us we will continue to assess production decisions based on the timing and conditions of return to service, which will be based on regulatory approvals and may vary by jurisdiction. Now, the first time we heard about the possibility that there could be a production suspension of the line or a halt altogether was during that second quarter earnings call with Boeing, and they said this could be the result. Now, this report comes after yesterday, or rather last week on Wednesday, congressional hearings, of course, with the FAA testifying that Boeing might have gotten a little bit ahead of its skis in terms of publicly stating timeline estimates. Also on Thursday, the FAA saying that the Boeing's estimates were a bit unrealistic. And it looks now like, according to the Seattle Times, that February, March is more of a realistic timeline, although I would caution anybody to project any kind of timeline for this scenario. Also, Seattle Times saying that it's very likely that this production halt will actually happen rather than just another slowdown, which Boeing already did back in April. They moved from a 52 per month production down to 42. That's what they've been doing ever since. Seattle Times saying that the likelihood is this halt will happen either this week or next. But Bloomberg reporting that there will not be an immediate layoffs because of the holiday season coming upon us here, that it would push it then into the next year, into January.
How does Dennis Muhlenberg still have his job?
You always ask me this. You and many others.
But the thing is, it's been like there have been so many times since March when I think we could all agree it would have been reasonable for the CEO of the company at the center of this to take the fall. And yet we've seen the comms officer go. We've seen the executive and head of the commercial jet division.
Everyone
right?
but.
Right.
Yes.
And so I'm just curious, like, at what's the calculus, at least as far as you see the situation on the board, allowing the one figurehead to still remain. But clearly the situation has not been handled well, and it's still not handled well, right? As you just outlined it, all the reports are kind of consistent, but there's still some conflicting elements because Boeing is still trying to have it every which way, right?
Yeah, and also compensation for Muhlenberg has been a big issue too. A lot of argument from folks saying, hey, while this is ongoing, that would be appropriate perhaps to reduce or not take compensation, even has been floated. But take a look at the numbers, what Boeing has already charged off so far. They've already accounted for $3.6 billion in increased production costs. That's just based on the slowing of the production of the 737 MAX. And then in addition, they've set aside $6.1 billion in customer concessions. That's for not fulfilling those contracts that they have with their customers. Also, if we look at deliveries, we don't know the real number. I have asked Boeing, I've asked them again today to provide me with these numbers, but it looks like it's approximately 700 plus grounded 737 MAX right now. And of those, you have 370. Those are the ones that were already delivered to airline customers that they just can't fly. The rest are those that have been coming off that 42 a month production line. And that totals about 380 aircraft, and they're piling up.
I know it's not like making a pair of jeans or something, but they're putting out an airplane that nobody wants to fly or can fly right now.
Cannot fly, arguably,
I mean,
yeah.
I would say nobody in the flying public wants to get on a 737 MAX. I mean, that's at the heart of the issue. And they continue to put these out. The pile up, I mean, that seems like those numbers there, I would imagine the street thinks they have to get much bigger probably. I mean, that it's kind of shocking.
Yeah, I mean, this is in the, if you just look at the numbers there, if you had 380 aircraft sitting there, it could be more. You're up into the 38 billions of dollars there, just piling up in inventory. And also, there are considerations that go way beyond just Boeing itself. There are the suppliers who are involved here.
That is
700 plus independent suppliers that are impacted by very, very close, tightly managed timelines for getting these parts where they need to be at the right time. You have Boeing employees. Seattle Times is saying that there are 12,000 of them in the Renton facility where the 737 MAX is put together, that Boeing could absorb some of those employees at other facilities, but not all of them.
The supplier thing, and it was sort of a passing mention in the Journal story, but they're extending some terms on financing. I mean, Boeing is essentially on the hook for all of these companies' revenue and profits and their employees. And so I think that feels like the next shoe to drop if we get one or two more quarters down the line here.
Yeah, so I have talked to one supplier so far, and they did say that if Boeing does decide to do a slowdown or a halt, that they will continue to work with Boeing to try to make this work. And so far, Boeing has not cut into their suppliers. They maintain the 52 per month aircraft for their suppliers, even though Boeing was only producing 42. So it really hasn't hit the suppliers yet. And so this could be really troublesome news for them today.
Alexis Keenan, have a nice evening.
You too. Thank you.
All right, coming up here on the final round, we'll have today's stock movers, but first take a look at where European markets closed to start the week.
Now, here are some stocks that we're watching today. PG&E, after the utilities bankruptcy reorganization plan was rejected by California Governor Gavin Newsom, who argues the proposal does not comply with newly enacted state wildfire legislation. Walt Disney, the company announced that Disney Plus will debut in France in late March following a deal with Vivendi's Canal Plus platform. That's how you say it.
I was also offered a 14-day free trial for Disney Plus because I'm a Sky Miles member.
Oh,
so
really?
everybody
Now you'll get
everybody gets a Disney Plus membership now.
Do you think in France it'll be Disney Plus? Like Canal Plus?
Sure,
That's
yeah,
what I think.
absolutely.
We need to ask
that was
Ethan.
great.
We need to ask Ethan.
Yeah.
Live Nation Entertainment, according to the Wall Street Journal, the concert promoter will face legal action from the Justice Department over claims that it forced venues into using Live Nation's Ticketmaster subsidiary for ticket sales.
It's just a small Dan Roberts impression
Yes.
here. I had a very unpleasant experience with a ticketing service, I won't name them, a week ago, and then you just sort of realize, like, there are no rules. Like, of course the Justice Department is investigating them over this. I assume this is how it already worked, because it seems there's no rules for this stuff.
They really have us over a barrel.
Everyone here who's gone to a concert and the crew is nodding vigorously, because they all know that ticketing is a nightmare.
It's so annoying.
But you got into Jingle Ball.
I did get into Jingle Ball.
Did you get there in time for Taylor?
Of course I got there in time.
Interesting.
I dragged everybody. Not everybody, just me and my daughter.
There you go.
It was good.
We'll talk about it more during the break. Coming up here after that break, Goldman getting bullish on two big healthcare names. It's our final round call of the day. But first, let's take a look at the trending tickers here on Yahoo Finance.
Let's go to our call of the day. It's Goldman Sachs on healthcare, which as a sector has underperformed the S&P 500. But guess what? That's part of the reason why Goldman thinks it'll have room to grow in 2020 and beyond. Digging a little deeper into the note, the firm added 3 names to America's conviction list: Amgen, United Health Group, and Dentsply Sirona, for which Goldman sees a positive earnings revision cycle driving the upside here. So these are 2 pretty dense notes, a macro call, and then they've got the conviction list as well in here. But I mean, what's to knock healthcare? It's, as Andy Serwer would say, it's the trade of our life, right?
I'm just surprised that there hasn't been more enthusiasm for Dentsply Sirona, because apparently, isn't every investor a dentist? Isn't every individual investor a dentist, I think, ultimately?
They should all be into it, but that is also hurt Smile Direct Club.
Yeah, but well, dentists don't like Smile Direct
Maybe they
Club.
know something.
Smile Direct cuts out the dentist.
Dentsply Sirona, by the way, the ticker.
X-ray.
X-ray.
So
You wouldn't have gotten that.
They're the reason that every 6 months I have to go in there and you put that thing all the way in the back.
On your own.
end.
Ugh.
So
they're all. It's a varied list.
What I'm surprised by is, and I think we can kind of see it over the last year, is the aggressiveness, I guess you could say, with which investors priced in like the max fears about Medicare for all. And I think that the recovery in healthcare has been interesting. I mean, certainly Joe Biden has reasserted himself. Elizabeth Warren has fallen off, but Bernie Sanders is now in second place. It's not exactly like the Medicare for all candidates, because there wasn't just one. I mean, Warren fell out of bed, but Bernie's still hanging in there. But the conviction with the market has said there are no real policy risks, I guess you could say. I mean, that chart just shows an essentially parabolic move in XLV since October, and I think that speaks to a quite aggressive view the market now has in terms of what they feel policy risk is like in the new year, because that's sort of all that weighed on XLV for a long time.
I was in the macro part of their note, not the conviction list part. I thought it was staggering. I guess I didn't really realize how big an overperformance healthcare can have in a year. They did that a Republican wins the White House. So in those years, 2000, 2004, and 2016, the sector had gains averaging 49%. 49%, outperforming the S&P 500 in those years by 46% on average. So this can really start to become a barometer of what you think. I mean, if we're discounting what's happening in the future,
right.
If they are, look, that's a huge year that you can have. And on the downside, it's actually not as bad as you think. Managed care has historically underperformed in election years in which a Democrat won the White House, with the group down just 2% on average.
Well, that's what I don't.
That's not that big.
Well, it's not that. I mean, I understand why they're responding to that cliche, but last time I checked, I didn't think the Obama administration was particularly bad for healthcare. Unless I was sleeping under a rock, the 2010s were an incredible decade for healthcare, and that the whole problem with Obamacare, the upshot of Obamacare, it was actually a boon to private insurance. And so maybe in some ways where, we get these notes in and it's like, oh, if a Democrat wins, we're going to really blow out the deficit. It's like, has anyone looked at what happened the last 2 years? Because that was a much, Democrats were over here doing fiscal cliff.
Yes, and it's only in the
sequester, and then we had $1 trillion deficit last year, which is fine, right? Yes. We should be borrowing more.
They
I agree.
They are only comparing election years, not what follows once somebody's in the White House. But that is next year. Yes, to your point, though.
Yes.
You can certainly, once somebody's in office and then maybe you have an idea of what's happening, it could go the other way. But I just had no idea that the outperformance was that big. And then, they just make the call, especially on Amgen and United Health. They just think there's a real reasonable valuation right now.
You know, which is a theme away from healthcare, just kind of coming up in general, that'll be very interesting to track next year, is it seems like every sector that has a policy upshot to it, if you will, just for all of them, whether it's materials on infrastructure, industrials, all that kind of stuff, the upshot is like, well, nothing will happen, so it's good for stocks. It's good. Everything is good for stocks.
It's going to be divided, so it's fine.
So it's good.
So it's fine.
Buy everything. All right, coming up here on the final round with the Fed keeping rates steady and the dollar feeling pressure, is now the time to bet on some of those beaten down commodity names. Our next guest will make the case, but first let's take a look at where the energy names are trading right now with 38 minutes to go in the session.
The Federal Reserve held interest rates steady on Wednesday, and our next guest says we should expect to see continued pressure on the U.S. dollar because of it. Joining us now to discuss is Anne-Marie Band, CEO of TradingDesk.com. So, Anne-Marie, let's just talk a little bit about the action we are seeing today here with records across the board. I'm looking at XLE right now. It is up 1.5%, the best performing sector we have. You think we're going to probably grind higher here in energy. So what are you particularly optimistic about in other sectors that you're looking at?
Well, the pressure from the dollar with the Fed really sort of being at the repurchasing window is going to put that pressure on the dollar. And so really, there's an old relationship that we look at, and that's when commodities are looked at with respect to the dollar. It's easier for commodities to rise when the dollar isn't very highly priced against other currencies. And so it's going to have this bit of pressure. You can see it breaking down. If you look at the run that it's had up into the space, and now all of a sudden it's sitting at this critical area, and it really does have some room to come down. And so in that space, it's going to allow these beaten down commodity sectors to move up. And I really like the grains because I'm here in the grain belt up in Chicago. And what we are seeing is a lot of these grains still in the ground. And now with the trade deal coming, if this actually comes together, we're going to see a place where there's going to be more demand than there is supply, and that's going to push things forward. So a nice, easy one to look at for that is DBA. It's been running really well. We started looking at it really, to be truthful, this move that I've been looking at in DBA, I've been really looking at it since August, waiting for it to move because we had some terrible rains, and I really thought that it would start catching its stride. And it continued to fall in August, but about September, just like we're looking at in that great chart, we can see that it's continuing to rise. And so if you're a trader or an investor and you're saying, hey, listen, I would like to get involved here, then, look to those November levels that are flattening around just over that 16 area, maybe 1635, 1640. That's a great entry point with a move back up into the 1770. And moving forward, if markets decide to hold stronger as we get through this little bump in the road that we've had from global slowdown perspective.
So just quickly on the grains, because you mentioned the weather, and I remember this summer it was kind of a combination story. There was the trade concerns of pressuring grains in general, but also you had the weather. As you look forward to next year, do you expect that the trade deal is really opening up those lines between the U.S. and China again, or is it just that we probably aren't going to have historic rains once again, and you're not going to have so much of that crop washed out that really is kind of the tailwind you like in that space?
That's a great point. Whether or not this trade deal gets done, ever since everybody's been sort of looking around at everything, China has signed deals with Brazil, Chile, Australia, all over the place to get themselves commodities because they're very commodities poor country. They just don't have the kind of arable land that other places do. So they've already made deals. Now, whether or not that happens, that's what the great thing is about taking a look at this grain sector right now, is whether or not that happens. We had significant trouble getting the plants in the ground, and then once they were in the ground, we are going to have trouble getting them out of the ground because now things are really frozen, and it's just going to end up being a little bit tough. On top of that, the Ring of Fire comes up every September. Not sure if I love things like volcanoes and earthquakes, stuff like that. And the Ring of Fire brings us these earthquake events that lead to volcanoes in the South Seas and around those areas that really come up all those spaces. And if they have some significant explosions, those go into the troposphere. We're going to have ourselves another wet and gloomy summer. Could be another problem. So there's sort of a perfect storm. along with the fact that these guys have been very depressed. They have been totally out of favor for quite some time. So in the area where we're looking at everything so highly priced, the next thing is, well, where can we find something on the cheap that risk doesn't really come in and bite us if we have ourselves some jolts in the market? And these areas in commodities, and particularly all commodities, the hard commodities as well, like metals, lithium, for instance, which I love, is another place. And you can look at the ETF LIT. That's sort of been lifting for the last couple of months. It's now stabilizing a bit. Again, they're at levels now where people that were caught long, that went under, said, oh my goodness, now I'm going to take some profit. That's what we're looking at right now, right up around those edges where we've had prior resistance. But as it pulls back and stabilizes again, you can look to those areas near 25 or so that look really strong. See if you can get yourself involved in there. And they're so low and so close to their bottoms. They're great spaces to look for as battery power improves over the next year, and big infrastructure things are going to take place, particularly in Europe, who has the, England has the oldest grid.
Yes, I know.
Planet Earth. So lithium's great.
So from the dollar to grains and lithium, even a little weather report in there. Anne-Marie Ban, the tradingbook.com CEO. Thanks a lot.
And coming up here, we'll have more on the final round. Plus, Tesla shares having a huge year. We're on pace for the automaker's highest close since 2017. So what's behind the juiced up performance? We'll discuss after the break. Welcome back to the final round here in Yahoo Finance. Miles Levin with you in New York. I'm joined as always by my co-host Jen Rogers. Let's take a quick look at where the markets stand right now. We've got 27 minutes to go in the session. We are looking at a record close for the S&P, the NASDAQ, as well as the Dow. For more on today's market action, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott.
Well, Miles, we're seeing a sudden decline in shares of FedEx, although the stock has recently pared some of its earlier losses. It seems to coincide with a Wall Street Journal article that just came out saying that FedEx will be prevented from being the delivery service on some of Amazon's Prime delivery orders amid performance issues. Obviously, as we've got about a week left in the holiday shopping season, getting packages to their destination on time is of the utmost importance. Now, FedEx reports earnings tomorrow. It'll be interesting to see if this issue comes up on the conference call. Amazon shares, by the way, are up slightly. Now, another stock we've been watching all day, of course, is Boeing. The stock is still down over 3%, and it's below that $330 a share level. Now, that's important because it's approaching its August low when the stock went as low as $320 a share. Now, that was the low for the stock since the most recent 737 MAX crash back in March. Now, if you remember back in mid-August, we were worried not necessarily about Boeing itself, but about the inverted yield curve and worries about a recession. So that's why the stock took such a hit in mid-August. The point is that the low for Boeing stock this entire year was driven by something other than the 737 MAX jet, another sign that all of these headlines have really caused Boeing stock to be quite resilient over the past couple months, guys.
All right, Scott Gam, we'll talk to you after the closing bell.
Tesla shares are on fire here, up 5% and on pace for the highest close in 2 years. This coming as analysts at Oppenheimer highlighted photos of Tesla vehicles produced in the under construction China factory and said expectations for the Shanghai facility were increasing. Dan Howley is here to discuss this rally that we're seeing here. I mean, so is China the key for Tesla and Elon Musk right now?
I mean, yeah, it's kind of been that way, right? Whether or not the Tesla will take off there, the market is ready for Tesla, whether or not there's enough consumer demand for these kinds of vehicles. You know, there was obviously issues that Elon Musk had highlighted that the entire auto industry in the U.S. has to deal with as far as tariffs going with vehicles going into China, but being able to build the plant out there and then have the vehicles ready to go and having them come out now on a factory that's being built, that really says that they're going to be in the country and they could potentially do well. Now, again, whether or not the middle class is going to be there, whether or not these will fit middle class consumers as far as the price range goes, that kind of remains to be seen. But they do sell decently well in China already. They've had to be shipping them around the world. So now just to be able to have them on hand is going to be very helpful for them. And obviously, Dan Levy at Credit Suisse also kind of giving Elon Musk and Tesla a little pat on the back, considering that they're usually bearish on the company, basically saying, credit where credit's due. You guys got some good batteries and software. That's essentially what his note said. Didn't change the guidance at all for it, but basically said, look, you know, you guys are the best as far as vehicle batteries go, the best as software for this goes, and that's really Tesla's bread and butter is the batteries. They are, you know, yes, they make great vehicles, you know, cool looking cars, although I think they're getting a little long in the tooth as far as design goes, and that Cybertruck is absolutely ridiculous. Still.
It's not a real car, though.
It's not. It's fake. It looks like something that came out of like a 1993 video game because it's just polygons for some reason. Yeah. But they do well as far as the batteries go, and that's going to be a huge part of their business, and it will continue to be going forward. And I think that's really what helps them stand out. And you have them kind of pushing other automakers into the electrification of vehicles, specifically Ford with their Mustang that they have now. It's not a Mustang.
I think in some ways Tesla seems to be setting up for a good old-fashioned American business story. Go to China.
Yeah, right? Exactly. Yeah,
in some ways that's the story of the 80s and 90s, and it worked out really well for the companies that made that happen.
Yeah, and I think, you know, if they can pull this off, I think it would be, you know, I mean, just mind-blowing to go from a company that just this past year, you know, was going through incredibly tough issues to come out on top at the end of 2019 and going into 2020. Getting this factory going, obviously they learned a lot from their Gigafactory out in Nevada for how they can spool it up and get it going and start getting vehicles out the door. They obviously want to work out in Germany, a factory of their own. So, you know, this is, it's impressive to say the least. You know, we talked about Elon Musk as kind of being, you know, a joke almost for a while, and now he's kind of proving, look, this company does have the legs that we said it would be.
I mean, I think even if the company does well, he's still going to like do Elon stuff, right?
Oh yeah, I mean, like,
but it is the time.
say weird things to divers.
He just had that unveiling where it didn't go well.
Yeah. But look at how.
Are we paying attention to the wrong things? I mean, the Tesla bulls would say that's like a sideshow. It's the batteries.
It really is.
The
International.
Tesla bears would say this is just a metaphor for their accounting.
Exactly. That's what I say. It's just like this was like 2 weeks ago.
Right.
But I think, he's able to let this. See, this was, I feel like, a joke more than anything because of the way he played it off. This didn't really damage anything for the company. And then that video that they sent out of them dragging the F-150 behind them, which wasn't really a fair video, that really kind of stole the show. It was, here's this insane-looking Cybertruck. Its windows shattered when they threw a steel ball at it. I don't think people were really thinking of that as something that they would need for a normal vehicle, though. So, yeah, he'll continue probably with the sideshow stuff that he does, but the company seems to be doing surprisingly well.
Getting close to 420. Dan Howley, we will talk with you tomorrow.
Coming up, we'll have your winners and losers on Wall Street today, but first let's take a look at where big retail is trading with 20 minutes to go in the session. Baxter. All right, let's take a look at some of today's winners and losers. Stock in the red. This is a Jen Rogers trade right here. International Flavors and Fragrances. So news the company will be combined with DuPont's nutrition business in a deal struck over the weekend. It gives DuPont shareholders a 55.4% ownership of the combined company. I think, Jen, another reminder that all of the Beyond Impossible stuff, it's heavily processed. DuPont is basically now in this space.
Did you know that DuPont was making your plant-based meat?
Right.
Beyond, by the way, is down 2% today. And I have to think these are connected.
It seems like the only interview we did that mattered all year was when Michael Pollan sat here and said, the Beyond stuff is crap because it's processed.
So processed.
Sodium bomb. Food for thought over the holidays. Another stock lower today. PG&E shares the utility getting slammed after its bankruptcy reorg plan was rejected by California Governor Gavin Newsom, who says the proposal does not comply with newly enacted state wildfire legislation.
Now for some stocks in the green, Uber on news that the ride-hailing giant is in talks to sell its food delivery business in India to a local rival. And British American Tobacco shares pop after the tobacco producer received a double upgrade to buy from Underperform at Bank of America Securities.
All right, and coming up here on the final round, Bank of America's private bank top strategist gives us the firm's 2020 outlook, why they're bullish heading into the new year. But first, let's take a look at where the financials are trading right now, 18 minutes to go in the session. stellar year for investors is wrapping up. So what does 2020 have in store? Niladri Mukherjee is the head of CIO Portfolio Strategy at Bank of America Private Bank, and he joins us now to discuss. We're also joined by Yahoo Finance Editor-in-Chief, Andy Serwer. So Niladri, today we got some decent news on U.S. manufacturing. Europe is kind of still hanging around there. But as you look to 2020, is the rebound in economic growth that I think the market has been sort of front-running here really at the core of your base case for what you expect in 2020?
It really is. Our broad message is that we are beginning to see a cyclical uptrend in the global economy. And you mentioned manufacturing, which could be a really big swing factor for the global economy in 2020. When I look at manufacturing all over the world, we were in a recession for a few months, but now we're beginning to see signs of stabilization, even improvement. I look at factory PMIs in Europe and Japan, that's doing better off the low basis. I look at the market PMI here in the US, which is above the level of 50. Chinese manufacturing PMI is above 50 as well, or nearly in that range. So manufacturing could be doing well, but the core of the global economy still remains the US consumer, which thankfully is in very solid shape.
Can I ask you, Niladri, about this whole idea that we almost went to a recession in the summer and then we're clearly past that? What the heck was that?
Yeah.
I mean, like, why were we almost in a recession in the summer and we're clearly not in one now and everything's fine?
You know, the big factor behind that is what the Fed did and what global central banks did. So you had the yield curves, which were inverted. Some of them were inverted. Some of them are really, really flat. That led to that whole recessionary fear. And obviously, manufacturing was in a recession. This is the third time in this long cycle that manufacturing has fallen into a recession. This time around, if the Fed hadn't engineered 3 interest rate cuts, 75 basis points in total, they fixed the yield curve, they supported cyclical sectors like consumer as well as housing, and that set up the stage for a global reflation that we're beginning to enjoy now.
See, I was wrong. We did need the rate cuts.
Oh.
The whole thing. Remember that?
Yeah, what if we'd listened to you?
I know, right. Good thing all around.
We are at records here in U.S. equities, but also globally. We haven't been this high since January of 2018. A lot of notes have been coming out recently looking to 2020, and we're starting to get this narrative of this, everything's rising together again. So when people are looking in terms of their asset allocation, is it still, the U.S. is going to be the best place to go, or you're going to get outsized gains if you can go outside the U.S.? What are you thinking between those two choices?
It's a great question. For the last couple of years, and nearly for the entire cycle so far, we have been more optimistic on the U.S. on a relative basis compared to international. U.S., I think, is still going to be the highest quality equity market in the world, bar none. But when I look at opportunities outside the U.S., the valuations are much more attractive. And this is one of the reasons we have told our clients to stay in international equities as a part of their strategic long-term plan. So when you look at valuations, look at the MSCI ACWI ex-US, it's trading at about 14 times. You look at US, it's 18 times. So there's a bit of a gap which can close, but valuations are rarely just by themselves enough to drive near-term performance. There are catalysts that are available that can lead international equities higher. Number one, if manufacturing improves, that will help international equities more. Number two, if the dollar stabilizes and actually declines from these levels, that leads to more risk-taking in higher beta international equities. And finally, positioning is still light in international equities, so there's scope for some of that to close as well. So keep the focus on the US, but have international equities in the portfolios.
And this makes me think not just to 2020, but the next decade. We saw a number of outlooks for the whole decade, and I don't know if you guys have one for the 10 years, but it seems that everyone is assuming it will just be lower returns, right? Oh, it just can't be this good again. And I'm not exactly sure if that conventional wisdom is necessarily bolstered by a view that's anything other than, well, we just had a good 10 years.
Revert to the mean.
Right. Are stocks mean reverting? And should we just be assuming that we're going to get sub-traditional returns over the next decade?
I think there's some truth to that. If you look at a typical portfolio, right? If you take it a 60-40 diversified portfolio, 2018 was the terrible year for that kind of a portfolio. Stocks were down, bonds were down, mostly because of what happened in Q4. When you look at 2019, stocks are higher, bonds are higher as well. If you look at over the next 10 years, there's a lot of forces at play. One thing we know for sure is that demographics aging, the effect of technology and the Amazon effect, all of that is going to create growth headwinds. So you're looking at a long-term environment where growth is going to be remaining at trend, maybe slightly above, but at trend, inflation remaining at low levels, that sets you up for a portfolio where bonds have subpar returns, perhaps even negative returns over the very long term, but equities also provide you not the similar kind of returns that they have over the last 100 years. If you look at since 1926, equities on average have returned you about 9.5%. Since the financial crisis, we've had double-digit returns on an annualized basis. So some amount of reversion to the mean, and the starting valuations for both equities and bonds are not that cheap as it was in 2010. So frankly speaking, you're looking at a diversified portfolio over the next 10 years, perhaps providing, I would say, moderate returns, but not mediocre returns.
So maybe the 2030s, Miles, will be a bad decade.
Well, sure. Exactly.
Right?
Well, they were the last time, right?
Yeah, I guess. Yes, they were.
1930s?
Oh, I see. Yeah, 100 years. Every 30s of a century is bad.
The 20s always roar.
We'd have to look at that. 1830s, terrible.
There we go.
Right?
Sounds like a homework project for someone.
Right.
Niladri Mukherjee is the head of CIO Portfolio Strategy at Bank of America Private Bank. Thanks so much for stopping by.
Coming up, the closing bell on Wall Street, less than 10 minutes away. First, though, we're going to get technical. Jared Blickery will be at the Wi-Fi interactive touchscreen. What the charts say as stocks head for a 4-day winning streak. We're back in 2 minutes.
We got 6 minutes to go in the session. The S&P and the NASDAQ looking for their third straight record close. The Dow trying to join the party. Jared Blickery is with me here. So Jared, when we look at the chart today, actually not a great day if we look at the intraday range because we've given up about half of our day's gains, at least in the Dow.
Yeah, it's time to sell, right? Obviously.
That's it, right? It's over. Party is over.
The S&P here just kind of knocking on 3,200. The Dow it has some Boeing problems. That's really the problem with the Dow right now. NASDAQ doing very well, up nearly 1%. Tech stocks outperforming yet again. And then the Russell 2000 losing a little bit of steam here, but it had been up the most, 1.2%. And of course, that's as we see bond yields up today. So, it's up the 10-year is up 7 basis points again. And when we've seen these moves, it propels a certain group of stocks higher, and then the next day it falls and another group of stocks go higher. But the net result is stocks keep going higher.
Continuing to see that rotation within the market, a reflation trade underway. I just want to quickly touch on the VIX. Volatility continues to get just absolutely crushed in this market, perking its head up just a little bit there. But overall, we've kind of seen, there were signs of life in the vol trade earlier this month. But really, if you kind of back out a few events in the last few years, and we're not even talking about the vol explosion in 2018, it's kind of really been just, shorting vol has remained kind of a fine trade.
Yeah, it's kind of incredible too. And we have options expiration this week, so I'm glad you brought that up so we can talk about dealer gamma hedging once again.
Great, that's
maybe some CTA talk.
Who wouldn't want to talk about that?
Well, they're very thank you, Andy. They're very long gamma. If they don't roll their positions over, could be some de-risking, maybe have another 2.7% sell-off in the S&P. Not
That's
the end
great.
of the world.
I'll pretend I know what all those words mean. Of course, there's a lot of action going on in a part of the market we haven't discussed all that much recently. That is the coins.
Okay.
We continue to see Bitcoin just kind of like do some Bitcoin stuff, and it's like, well, that's good for those guys.
Yeah, we had
fallen out of bed because why not?
Yeah, we had a pretty big drop here. I didn't see any news in particular. There's this ongoing scam that the Chinese are investigating. They got something like 20,000 more Bitcoins. You can't make this stuff up.
You literally cannot. You literally cannot.
From a technical perspective, it is trading below the 200-day moving average. It's still kind of up a little bit. It's slanting upwards, but until it gets above this trend line right here and above the 200-day, which would be about the same time, if that happens, I'm not real excited about the technical picture. This could drop even farther. We haven't seen it close. It looks like it's going to close the lowest since May. So again, just weak technicals here that we've been talking.
Double for the year, though, Jared.
Yeah, it's still up 112% if you bought at the beginning of the year, which is outpacing the S&P 500 by about 4 times.
Well, actually, a serious question for you, and we touched on it a little bit last week. What did you make of Bank of America coming out and saying, like, oh, the best performing asset of the decade was Bitcoin? I was like, oh, okay.
Yeah, because
does that even count?
Who bought in 2009, 2010 at the very beginning?
Right.
There's a famous pizza trade where somebody bought pizza with Bitcoins, and it took so many that these Bitcoins are worth something like $100 million now. But aside from that person who got the pizza money, really, who bought at the beginning?
Right.
I didn't.
Right. You bought when Jen Rogers bought.
Yep.
And then you lost a little bit of money. Yeah. But then you made some.
Yeah, there you go.
Yeah, where's the next low here?
I'm not going to say.
You're right at key support here, right in that 5,000 range or so. All right,
Miles.
Jared Blicker at the Wi-Fi Interactive Touchscreen. Coming up here in the final round, we got the closing bell on Wall Street, plus Goldman Sachs getting bullish on some big healthcare names ahead of the election. It's our final round call of the day. We're back after this.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udlin and Yahoo Finance editor-in-chief Andy Serwer. We are just moments away from the closing bell. Looking For records here for the Dow, the S&P, and the NASDAQ, we're on track. We're off the highs right now, so we're going to have to figure some of this out in the end. But 4-day winning streak here to the upside. Looks like we just had, as I said, off the highs. Industrials looking like it's rolled over just a little bit.
Andy, you ever been to Dover?
Dover, Delaware?
Yeah.
Oh, of course.
They were ringing the bell. Yeah.
Dover, Delaware. Dover Corp.
Dover Motorsports. Yeah.
Oh, okay.
The
Oh,
casino
Dover,
and the
yeah.
racetrack, the whole thing.
Right.
That's who it is.
Yeah. Yeah.
Only been
There
to
they are.
It's not really NASCAR time of year in this part of the
Right.
country, but just in case.
DVD. We'll have to check them out. So looks like real photo finish on the industrials. They might pull it out and give us all 11 sectors to the upside. Nope, doesn't look like it's going to happen.
If it's
Boeing, it's
right because we come in this morning and the Boeing story's out, and I think all of our reaction was obviously this is terrible news, and then the stock was down 1.5%, I think, when we were meeting this morning. And we're like, maybe it'll just end up coming back. But, the stock was sold relentlessly all day because it would seem to me, Andy, that this is the real thing for Boeing.
There was capitulation today with this stock to a degree, and I think you're spot on. People have been saying, it'll blow over, basically. And today was sort of the first day you got the feeling that people were saying, this is systemic.
Mm-hmm.
And, we've talked about prior, maybe it's existential. I think that's too strong. But systemic, impeding this company for the foreseeable future. Full stop, 2020, gone, right? Write it off. And you may get a bounce because there may be, I want to be careful here because, you may get relief pointing to 2021 in the second half of 2020, which will make the stock go up big time there.
There's the defense part of the business, which has done quite well, and that bolsters the stock.
But Miles, they're putting these airplanes in hangars. They can't deliver
42 a month.
Right.
That just roll off.
Can you imagine?
And go someplace
That would be
else.
a photograph to see, wouldn't it?
Yeah. Just
hundreds of these planes.
What the dollar amount that is going
Billions.
out the door and sitting there, and then what are they going to have to do with these planes to get them flight-worthy? Retrofit, get approved, have an FAA person there.
And they're highly skilled employees too, Jen. So in other words, they're sitting there. If these people aren't treated right, they're going to walk, particularly in this labor market. There are other places to go besides Boeing.
The 52-week low on the stock is 292, so it's still above that. The 52-week high, 446 today. It lost another % since we sat down here.
It's underperforming the Dow by 22 percentage points, something like that.
Yeah.
So it's quite a market underperformance.
Right.
So outside of Boeing,
everything's awesome. Let me tell you,
it's looking pretty good. Today, it was definitely a risk-on day here, leading the Dow higher. And we're going to be talking a little bit about the healthcare trade coming up, but United Healthcare, Pfizer, both up more than 2%. All-time high for Apple here, continuing to chug along, 1.7%. A little bit more of a mixed bag in some of our momentum names. We noted that Beyond was down, but there were some of our other IPO names as well that weren't completely off to the races here today. Your Real off 1.6%. Your Fiverr, smaller names. Still got Uber up over 5%, Pinterest up over 4%. Lyft making a move up 2.5% as well.
That's a big, sort of pivot into the risk, right? That is not small stuff.
And it's been interesting to see over the last month or so, let's call it maybe 2 months, where you have the actual just S&P regular stocks getting to new highs, and some of these momentum names, some of these riskier parts of the market have actually taken it on the chin a little bit, because if investors don't have to camp out there and say, let me pay 20 times revenue for some software name I only kind of understand, then they can just move on to buying like Procter & Gamble.
Yeah.
Well, with these elevated levels, with the big names all up this much, you got to ask yourself where you're going to go.
Yeah.
Right? And so risk on is an obvious one. And then, you were asking about EM with our guests earlier. So, that's going to be a big question in 2020. So we're at this very lofty plateau. And if you believe Miles Udland, there's nowhere to go but up.
Right.
No, I'm being facetious, but
I wouldn't disagree with that. I wouldn't disagree with that characterization. Yeah.
Well, you know what she's going to do the whole decade.
No. Oh, there have been a bunch of stories about that this weekend.
I saw a mushroom story over the weekend, right?
Everyone has seen this mushroom story.
Yeah, right.
All right, for more on today's market action, let's go to Scott Gamm on the floor of the New York Stock Exchange. Scott.
Hey there, Jen. Well, another day of a trifecta of record closes for the three major indices. Let's start off with the best performing stocks in the Dow today. Quite a list. United Health, Pfizer, Apple, Dow Inc. By the way, Apple earlier today hitting and crossing $280 a share. It closed just below that threshold. That is a record high for Apple today. You know, it seems like stocks have almost been rising too fast. It kind of reminds you of January of 2018 when you had the first 3 weeks of that month when stocks just surged every day. But at least this time, stocks are surging for a reason, right? We got a resolution on trade back in January of 2018. Stocks were rising just because, really without a reason. Now, the worst performing stocks in the Dow today were, of course, Boeing, American Express, IBM, and Caterpillar. But Boeing, by far, was the biggest laggard, down almost 4%. That's one reason why the Dow, even though it was up 100 points, was held back, right? The Dow could have risen a lot more had Boeing not been down so much. But of course, Boeing down on some stock-specific news. And then outside of stocks, we should point out the surge in oil prices today, at least for West Texas Intermediate, crossing $60 a barrel today, really for the first time since September, when oil had a short-term boost when we saw those airstrikes in Saudi Arabia. But even with today's gain, you know, oil is still below its 2019 high, which is at about $66 a barrel. That was a level reached in late April. But we know that oil tends to rise when you do have fading trade headwinds, and we certainly have those today, guys.
Indeed, and also XLE, energy ETF, up 1.5%. A lot of energy moves today. Scott Gann, we'll talk with you tomorrow.
All right, time now for our final round call of the day. Today we've got Goldman Sachs out on healthcare, which is a sector has underperformed the S&P, but that's part of the reason Goldman thinks it'll have room to grow in 2020 and beyond. Digging deeper into note, the firm added 3 names to its America's Conviction list: Amgen, United Health Group, and Dentsply Sirona, for which Goldman sees a positive earnings revision cycle driving upside. Andy, we were just discussing during the last break about the healthcare trade really being, you go back in time, in many ways, the trade that defined the 2010s, right? The biggest policy event of the Obama administration that I think had a lot of investors anxious, a lot of the public anxious. How would this all play out? And the real beneficiary in many ways were the traditional health insurance companies.
Right, but while we were talking, I was checking out some of those stocks, and you know, you'd think that Amgen would just have been a great trade. It wasn't. It was sort of dead money, and it matched the market for the past 5 years. I mean, that's not dead, but not anything to write home about. And in fact, it only caught up recently over the past 2 years, Miles. And surprising to me was UNH, the University of New Hampshire, was the big stock here. And, you know, that's what my bigger point, though, is that, you know, if you got a healthcare ETF, you know, buy and hold it. But playing the sectors within the sector is extremely difficult. I can never figure out which one. I mean, you'd think biotech would beat, you know, managed care.
But that, I thought in this note, that was one of the things. A couple times I said, really? Is that right? I didn't know that. That managed care in the last decade outperformed FANG.
Right.
Managed care. People ain't getting any younger.
653% over the last 10 years.
UNH up 184% over 5 years.
But this is just the decade of managed care. Looking at this, it's I had no idea at all.
If you went back to the dumb thing, which was the demographic thing, you would have been like, older people, buy the older people stock.
Buy the olds,
right? And that's what that is. Boy, that's great, right? And it's probably going to be true in the 2020s.
Well, I think what's been interesting, you know, kind of looking at this note and the case Goldman is making for healthcare in the new year is the severity to which, I guess you could say, the market was punishing these names for the early indications on what the Democratic primary might look like, right? I mean, 3 months ago, Elizabeth Warren was leading in most polls, and I think there was a lot of anxiety that things would be bad. There would be a Medicare for All trade fully on in this market, and that has not really come to pass in recent polls, and I think Goldman is essentially saying, fade the policy risk. Don't worry that the policy is going to derail your thesis here, because there's still a very profitable trade to be had in the current U.S. healthcare system, which, regardless really of who the next president is, probably isn't going to be overhauled.
It's like we've gotten used to it. You're looking at this chart, the Hillary tweet and triggering all these moves.
August
and
2015.
Then we had President Trump getting elected. We've had a lot of trading based on some of his tweets and headlines as well. And they try to make the case in here, and I kind of think it's the same thing on trade, that we've gotten used to this policy risk, this tail risk a little bit. And we are understanding how it works and how difficult the bar is to actually make any changes.
Right. One more note about United. Can I just tell you, it did much better than Apple over the past 5 years.
Yeah.
I mean, it's just surprising.
Yep.
And one thing I like about these names is actually, a lot of times you'll see in these notes, it'll be like all dogs or all winners. This is actually, Amgen matched, UNA way outpaced, X-Ray, pretty serious underperformance over the past 5 years. So, you can take your pick that way too.
Well, I made the joke, isn't every individual investor a dentist? Yeah.
Well, that was the old.
What's the issue here?
With the Jaguar.
What are they not seeing in this?
Yeah.
On the UNH front, just because you like that one, they really
no brokers anymore.
They do really make the case on UNH in here. What they think that there's a whole positive earnings revision cycle coming. They're a little bit higher than the street is here on UNH, so that's one of the reasons that they added it to the conviction list in here. And then on other names, there's just this whole. There's a lot of M&A opportunities out there as well, stuff that capital that needs to be deployed in the next year.
UNH has a PE of 21, trailing. So, for a stock that's done that well.
I can get into EM for 14.
Rates are low, though.
Right, true. That's a very high multiple there.
Wouldn't you rather buy UNH's earnings stream than an emerging market earnings stream?
Yes.
There you go.
Yes, because it's the American consumer.
See, there you go.
And there's a lot of old people.
We figured it out. We should keep track of all of our positive and negative comments. Exactly. See who's actually right.
Coming up, from tackling to tech, former NFL player Mike T. Brown on his transition to tech investor and founder and what he's learned along the way. Right now, let's take a look at where FANG names are trading. Michael T. Brown is a former NFL linebacker that is now tackling tech with his company Win-Win. The company combines the fantasy football format with philanthropy to create social games for social good. And joining us now to discuss is founder and CEO of Win-Win, Michael T. Brown. So, Mike, what inspired you to create Win-Win?
Hey, thanks for having me. So, the idea for Win-Win really came about, as a former athlete, playing in the NFL, having a foundation and wanting to use my platform for good. I really recognized that there was some inefficiencies in that possibility. So I wanted to kind of leverage the fanfare of gaming, right, that we typically see, and leverage the giving element, because really outside of the introduction of the internet, giving has kind of been done the same way for quite some time. And so we wanted to go beyond the raffles and auctions and galas and 5Ks and create a more innovative way and more engaging way. So that's where the combination of gaming and giving come together to make it more fun for the fan and even more efficient for the athlete and the influencer to do good.
Mike, I just want to ask kind of maybe the simplest question here. We're showing kind of the side scroll of what the app looks like, but if I go on to Win-Win, what am I going to be getting myself into, and what exactly am I doing here to get myself involved in some of your philanthropic efforts?
Yeah, definitely. So what we do is we work directly with the athletes. We have about 170 NFL and NBA players that we partner with, and so they're hosting a tournament. And so they promote it out to fans, and then those fans click on the link in the bio, for example, they land on our platform, which you were just showing. And what you're getting yourself into is into a tournament. It's a pick'em challenge usually. So you're predicting who's going to win upcoming matchups for, week 17, for example. You're just predicting the winners. And then from that point, once you've done that, you're given an opportunity. You're in the tournament, but now you're given an opportunity to donate. It's voluntary, 100% tax deductible, and you earn other perks and incentives every time you donate. And then when you're in the tournament, once those games actually kick off in real life, you're competing, right, based on the accuracy of your predictions. And what you're competing to win is not money, but instead experiences money can't buy. As you see here, being on the sidelines of a huge college football game, having dinner with your favorite player after the game, all types of stuff. So that's where the gamified giving technology comes in.
So we're doing a lot of stories about the next decade and sort of what's next. You are now a full-fledged card-carrying member, I guess, of the tech scene. You've moved from sports now to tech. You're in a program, being seated here, working with people like Tim Draper. What trends are you seeing emerge right now? What do you have on your forefront for 2020 besides Win-Win?
Yeah. I think what I realized is that for startups and companies, right, I think especially as you look at millennials now being, the largest consumer group in the history of the world, one of the things I look at it, and even as I look on the side of me to other startups and other problems that are being solved, is that there's really kind of a, no pun intended, like a win-win kind of business model, right, where not only can you make a lot of money, but you can also be doing a lot of good in the world by solving problems that have a bigger impact, right? And obviously there's things that are being created every day that kind of, for some people may seem a little mindless or not as value add to the world. But I see business models where, very true to kind of the win-win model where we're going to help change the world for good, but we're also going to make money in the process. I think for a long time, especially in startups, this double bottom line, like these other business models that kind of included doing good, were kind of frowned upon, quite honestly. And I think as I've looked at other companies that are solving big problems, there's a way that we can now solve big problems, have great impact, and do quite well monetization-wise. So that's kind of the overarching theme that I see, when it comes to building and creating, and now as we see diversity starting to increase, there's a lot broader set of ideas and problems that are being solved.
Win-Win founder and CEO Mike Brown, thank you so much.
Thank you.
All right, coming up here on the final round, we'll have the sector watch, but first let's take a look at the most active stocks on Yahoo Finance today. All right, let's take a look at the sector winners and losers in the market. Sectors in the red, only one today. Industrials, XLI, down just over the flat line, down 0.05% today. Boeing, of course, weighing on the industrials there. GE and FedEx also lower on today's session. Sectors in the green, we had 10 of them. XLF hitting a new high today for the first time in 12 years, led by shares of Goldman Sachs, Wells Fargo, and Bank of America. Congrats to everybody who hung in with financials from the crisis until now. Also higher today, tech sector, XLK up 0.8%. Western Digital higher there. That stock up after the company the stock got an upgrade by Susquehanna to positive from neutral, citing increased demand for 5G capable devices.
Coming up, what we're watching tomorrow in the look ahead. Plus, Maverick is back in the saddle. The new Top Gun trailer is here. If you have a pulse, you're going to be excited. We have it for you right after this. And now here's Miles with a look ahead at what will be making headlines on Tuesday.
Well, the economy is starting to catch up to the stock market. On Monday, all three major indexes hit record highs, a rally that comes after three pieces of positive economic news and follows Friday's very muted reaction to the U.S.-China trade deal. But this market action is a reminder to investors that almost by rule, the economy will always be catching up to the market. The market is always pricing in some future event, whether it's good or bad, and often doing so way before any proof is in any pudding. Throughout the fall, financial markets were pricing in that trade deal, then we got it, and so the market didn't move a whole lot. But the market also tepidly priced in better economic data, and that data is now starting to roll in, and it's giving investors a final incremental reason to be bullish into the end of this year. Economists over at Capital Economics, for instance, now expect GDP growth to reaccelerate in the second half of 2020, even with political risk overhangs from the trade war and the election. And if this view gains more credence among investors in the year ahead, expect markets to start pricing in a stronger economy sooner rather than later, as the market always does. Now turning to the calendar for Tuesday, on the data side, we'll get the latest readings on housing starts, industrial production, and the latest JOLTS report on job openings. And on the earnings side, FedEx results out after the close will be the day's biggest highlight.
I almost forgot we had a trade deal. Totally forgot.
It was so long ago.
It was so long ago, right? And it barely...
Yeah, impeachment, trade deals.
This is the thing.
Come on.
So much.
Get with it.
I mean,
so much is happening.
Yes,
I mean, on
very
the nightly news, they're leading with the weather.
Yeah.
Like everyone's over impeachment,
right?
Not just us. That's kind of been the amazing thing about that whole.
Mitch McConnell's got some work to do still.
Yeah.
And Chuck Schumer.
Yeah.
They got to do that whole thing, the song and dance up there in the Senate.
Yeah.
Well, we still have the House. We haven't even done that part yet. It's amazing. Amazing.
And now,
what you've all been waiting for. The
Engage.
new trailer.
Engage, Jen.
Engage. Top Gun Maverick. The trailer is officially here. Tom Cruise, fresh off Mission Impossible Fallout, his highest grossing film ever, is finally returning to the screen as Pete Maverick Mitchell.
He looks younger now.
35 years after the original Top Gun premiered in 1986. Incredible. Miles, have you seen the movie?
I've seen
Okay.
Top Gun.
That's good.
Kind of.
There's a lot of people that haven't seen it.
There's an important point to make here for our audience. Though,
Yes.
That this is like one of the few great franchises that Paramount Studios has. Okay, which is
CBS,
Viacom. I mean, this is one of their golden gooses, pun intended, goose.
That they took forever to get out.
Nice. Yeah. I mean, but Tom Cruise has had a long-standing relationship with Paramount.
Yep.
So and people love this movie. I mean, this is like even beyond iconic. I mean, it basically defined an entire era, in a way, a little bit of American films. That's for sure.
Is Tom Cruise underrated?
They don't really like him in Hollywood.
Yeah, like for reasons I.
Well, he started off being kind of a punk, and then the Scientology thing.
Yeah,
didn't help.
and look,
there was all that stuff. He's never won big awards.
Yep.
Right. Rain Man, maybe the closest. Born on the 4th of July.
Born on the
got
4th of July,
nominated,
nominated, and it
there.
seemed like things were.
But he hasn't done the thing that a lot of actors will do where they get late in their career. I mean, he could obviously do any movie he wants.
Right.
Pretty much.
Yeah.
And if no one will do it, he'll just make it himself. He has enough money. Right. But he hasn't tried to do the prestige thing.
He did some.
He just kind of does the Tom
Magnolia.
Cruise, I make a lot of money thing.
Magnolia, he did a little prestige there.
Yeah.
I don't know. I think that he's very kind of locked down in the press part of it. After the whole
I think,
Oprah.
let's be honest, like a lot of it has to do with Scientology.
What you can get asked, I do
It's
think.
a Scientology thing.
Well, that whole
is a
thing
big
seems
part.
not great.
Right.
Based on the reporting that's happened around the whole thing.
And there's been so much reporting. And now, the Fallout did do very well at the box office.
Yeah.
But the reporting continues to come out on Scientology.
Right.
We'll be curious to see if that makes any impact on this movie, as even more things have come out since Fallout.
Right.
That said, it's a pretty good trailer.
A lot of people don't care about that, but
but a lot of people do.
But Hollywood does. I think most people watch movies don't care, but Hollywood does, and I think that affects the roles he gets. I think but it also speaks to his sensibility and his mindset, and I think definitely the awards. No question about that.
Yeah.
Or maybe he's not such a great actor. I don't know. What do you think?
I mean, his movies have made $8 billion, so
something's got to work.
I think
I think he's pretty cool.
I don't want to be all like cynical consumerist about it though, and just say his movies made a lot of money, so he's a good actor.
I think he's good at what he does.
That's what I'm saying.
He's very good at
he's
Tom Cruise.
He's
playing
basically
the roles that have made him a household name.
I don't want to he's kind of The Rock before The Rock. He does he's got the thing he does.
Yeah.
And he does that thing well.
But The Rock is more likable.
Funny.
Right, but they do different things.
right,
But
yeah.
so we could list The Rock's things, but that's what he does in
Funny,
movies.
likable.
Tom Cruise does those things in movies. They both connect with audiences.
Yeah.
Not the same audience always, but there's an audience.
I just wanted to show the trailer, talk about how this movie's coming
talk
out,
about
how
religion or anything.
exciting
We had like 90
it is.
seconds. We never have. We had 90 bonus seconds, and I know you guys both like movies.
Yes,
Sounds
good.
great.
Thank you.
We're going to do that more often.
And we talked about a ticker, which
Yes,
is to
we
say
got it in
CBS
there.
and Viacom. We'll
There we
see
go.
what this does.
New
for that
ticker.
company, right? See what it does.
Yeah.
All right, coming up here in the final round, he was an ex-NFL player who wanted to be a private client at JP Morgan Chase. Jimmy Kennedy gives us his story from that blockbuster New York Times report last week alleging racism at JP Morgan branches in the Phoenix area. We're back with that conversation right after this. Welcome back to the final round here on Yahoo Finance. Miles Zeldin with you in New York. I'm joined as always by my co-host Jen Rogers. Also stopping by on this Monday is Yahoo Finance Editor-in-Chief Andy Serwer. Let's take a look where we finished on this Monday. All three major indices finished in the green at record highs. The Dow, 28,235, a new record close for the blue chips. The Dow finished about 80 or so, 90 or so points off its highs of the session. Shares of Boeing really weighing on the index there. Boeing shares finished Monday's session off more than 4%. Of course, continued concerns over the future of the 737 MAX plane, what exactly the company is going to do with that. We don't know yet, but of course, Boeing has changed its story on that several times over the last 9 months or so. The NASDAQ and S&P hitting record closes for the third straight session. You know, something, Andy, we mentioned just in passing during the sector watch was financials.
Right.
Back at highs. XLF back at a high for the first time in 12 years. And I know we're all, decade is on our mind because we are wrapping up the 2010s. But boy, if that isn't a story to kind of tell us where we were and where we've come to, I think, during the 2010s. Financials finally getting back to where they were in December 2007, right
It's pretty amazing. I mean, and there's some exceptions. I mean, I'm sure Citi is not one of
I don't think
it's absolutely not.
I don't think Bank of America shareholders who are at 70 are excited about owning stock at 34, but some
But
people own it
obviously,
at 3.
there are hundreds of financial institutions in this country that are publicly traded, and that index you're talking about reflects that.
More on the Boeing story seems like coming out right now. Some Dow Jones headlines on Boeing that they are going to halt production temporarily. This is just Dow Jones right now. They're going to halt the 737 MAX production. Of course, the sell-off today, and it accelerated in the last hour following these reports that they were going to be figuring out suspending, halting. Again, this is Dow Jones reporting that Boeing will be halting production in January.
There was a board meeting, Jen, as you, I think, suggested over the weekend, a Boeing board meeting in Chicago, and that extended to today. And so presumably that's news coming out of that meeting. There were at least two options being discussed, which I think you said, which is either ratcheting it down or halting. And there was a lot of discussion that actually ratcheting it down is better because it's better not to have a binary thing, particularly when it comes to the workforce. That if you ratchet down, it's easier to ramp up. That's what some analysts were talking about. So obviously the board is well aware of that sort of distinction between those two options. So I'd be interested to see why they decided to stop instead of ratchet down.
Because they have so many, I mean, I'm just surmising, they have 42 planes that have been coming off every month, right?
Right.
And what can they do with all of these planes?
They literally run out of space. I mean, those things take up a lot of room,
And I mean, to Miles, you asked Alexis this question earlier, and I think it's fair to ask it again. It's like Dennis Muhlenberg. What's going to happen to him in all of this?
That would seem to be the next shoe to drop.
I think he will be a casualty here. I mean, certainly, if not now, soon. I mean, there's just no way. They're going to need a clean house.
And another part of the story we discussed with Alexis, an hour and a half ago now, the world was totally different before Boeing made this announcement, is the suppliers, right? They have hundreds of
200
suppliers. And, Alexis made the point that they've been paying out their suppliers as if production of the 737 MAX is 52. But they've only been making 42. So the reason that Boeing is taking these charges is because they're paying for stuff they're not using. Because they're behind on their schedule, but it's not yet their supplier's problem. But now you sort of think it's about to be, right? I mean, the financial, like Boeing is part of financing arm as much as it is making planes. And so they're financing this whole ecosystem.
You know, it's just amazing that it's not quite too big to fail. But in other words, when you get to be this huge a company,
Andy,
the assumption is so much that we have this impregnable, way of doing business, and we are so reliant on this one system that is so incredible. And what if there's just a break in the whole thing?
Yeah.
I mean, your risk management people have to ask that. Like, what if this plane, and I don't think it's a crazy thing for the risk management people to do. Like, what happens if this plane, we can't sell it anymore for some reason? That's what they're looking at right now, right?
It's
I think we're at the
problem.
Yeah, I think we're at that point of like, maybe we need to really be talking about something bigger here than just when's the plane going to get back in the air.
It's a national security company. This is a defense company. It's a job story. It's like there's so much wrapped up in this. The idea of it being too big to fail, I think, is a worth positing.
Yes, I mean it's adjacent to that, man, it's just, and they're really, again, I mean, everyone knows this. There's only one other company in commercial air.
That's right. It's an Airbus.
I mean, and the demand for this is just, the demand for these planes is huge, and it could really, you talk about having an effect on global GDP, 100%.
I know.
Right?
Yep. So we've seen the stock sell off a little bit here on the news from Dow Jones. Boeing to temporarily halt 737 MAX production in January. We will keep monitoring for news. Last week, the New York Times published an article detailing allegations of racism at Phoenix area branches of J.P. Morgan. While not addressing the report directly, Jamie Dimon, J.P. Morgan's CEO, emailed employees late Friday saying that we have done some great work on diversity and inclusion, but it's not enough. Joining us now is Jimmy Kennedy. He's a former NFL football player whose story and recorded conversations are the basis for the New York Times report. So, Jimmy, since the article came out, what has the response been? Have you heard from other people that have had similar experiences?
Yes, actually. I receive a lot of support. A lot of people email me, send me DMs. I have no clue how people's finding out my cell phone number, but I get a lot of voicemails and stuff as well. But a lot of people already said that they experienced racism and they're taking their money from Chase, but they experienced this with different banks.
And Jimmy, the article is it's summing up your experience, and essentially you were trying to become a private client at the bank, and you were essentially told, no, you could not because of the way that you look. And now the defense is that this is just a few branches, but in your interactions with the J.P. Morgan system as you experienced them, does it seem to you like it was just a few bad apples, or was this about something that it seemed like the bank was keeping from you because of who you are and what you represented?
Well, it wasn't just about the private client thing, because what happens is you guys only heard one of about 15 tapes. I have about 15 recordings. I was being lied to. My money was being, held up. I was being told I couldn't have an annuity because of my age. I was also told that how is it that I was investing $90,000 in Bright House annuity, and I was told I couldn't do it. They held my money up for 3 months, and I was told athletes always blow their money and buy big cars and big jewelry and stuff like that. It's impossible for me not to need this $90,000 here in the near future. I guess a bunch of stuff that I was told. It wasn't strictly just about the private client thing. The thing about the private client thing was before I moved over close to $800,000 over, I was told that I was going to be a private client before I even made the move. So when I made the move to not have the benefits, the perks, and so on of the private client thing was kind of bothering me. It was like, well, you know what? Like, what's going on? I wouldn't have moved my money here if you guys wouldn't fulfill, your obligations on what you said.
Right. Hey, Jimmy, what are you looking for now from J.P. Morgan? Do you not ever want to do business with them, or do you want to do business with other brokerage firms? How does it make you feel about looking for another relationship like that?
You know what? In terms of being a retired athlete, everyone knows, football players usually, our athletes in general, usually don't manage their money well. So if we can't trust into a financial institute, I could see if I went and I picked the wrong financial advisor, but how do we feel safe if we actually walk into a branch and say, hey, you know what? Even if I was to do the lowest thing or put my money in a savings or something like that, so I don't lose money, how does an athlete feel comfortable doing that thing if we can't even go to a branch, if they're, discriminating against us? Whether it's race, whether it's size, whether it's, literally on a recording, I was told that they say what you want to hear just to get you out of the office, So going forward, it's not as if Chase was the only bank that I dealt with. It's not like if Ricardo Peters was my only financial advisor. Obviously, I turned pro when I was 22 years old. I just recently turned 40 here this last month. So I've been investing with people and so on, but what's happening in this situation is actually it's a gift and it's a curse. I decided to go back to school, so I'm actually enrolled at Grand Canyon University, and I want to work towards my doctorate in finance, just so I can learn.
All right.
to not put my funds in other people's hands.
That's definitely one way to do it. We reached out to JP Morgan, and Jamie Dimon, the CEO, had sent a letter to employees on Friday, and I'm just going to read part of that. He said, "I am disgusted by racism and hate in any form. Any such behavior, explicit or veiled, deliberate or unconscious, is unacceptable and does not reflect who we are as a company and how we serve our clients and communities every day." Have you heard from JP Morgan?
I'll let my lawyer handle all those things. I mean, obviously they're talking and stuff, but JP Morgan 5 months ago told us that they listened to the tapes and it wasn't racism at all. They told us that they let a black man listen to the tapes and they said that none of this stuff was racism. And I said, well, let the public decide.
And Jimmy, before I let you go, you mentioned that you're working towards your doctorate at this point. When you just think generally about the advice that athletes get and the way that athletes are viewed, you mentioned it earlier in terms of how they treat their finances and what the modern athlete really means, I think, culturally. Do you feel like that situation has improved since you were a young player trying to figure out what to do with all this money? Or are we still not helping young athletes figure out what to do with an earning stream that's probably going to be the most money they ever make and probably is going to last less time than they think when they're in their prime?
Well, you know what? When I retired, a lot of things before retirement, I was actually, blessed to go to attend Penn State University, where Coach Paterno and those guys focused on, or helped us focus on education as well as finance. So I was prepared for, the NFL and the money that was coming my way. The thing that, that they don't prepare you for is you don't know when the game is going to be done. So what happens is you don't know when your body is going to take a toll. You don't know when you're not playing no more. I wish I could have played 12 to 15 years instead of the 9 years that I got. So when you stop, the struggle is finding your identity. Once you find out who you are and what you're going to do next and so on, you're conditioned. 9 years, you get a $30,000 check, $40,000 check every 2 weeks or every week or so on. And then now you go work for, $50,000, $60,000 a year is a mindset. So I think a lot of young players are now setting themselves up. Like, for example, when I played, no matter what my salary was, I only lived off of $250 a year. So it's just about budgeting things and doing things the right way. So that's why I was saying before, when it comes to having an institute and having a financial institute that can actually help you grow, like and I say this as a black man, I say this as a man from New York City, my goal has always been to change my family's legacy, to go out there and save as much as I can. I didn't play football. Obviously, I love the game. I love the job. But I didn't play this game just so I can go out and be a Hall of Famer. It was to play this game as long as I can, to use it as a platform, a stepping stone, so I can, make as much money as I can to start businesses and go on and be successful in life. So when I walked into JP Morgan, I didn't walk in as a retired football player. I walked in as a businessman. I walked in and said, hey, here's what we need. Let me move this amount of money over and so on. We're talking, when I hear, feedback from people act like I only had $800,000. No, I moved $800,000. Since then, I've moved $800,000 to my other accounts. But I've only moved a certain amount of money to JP Morgan. And that's literally because it's about less than 5 minutes away from my house.
Jimmy Kennedy, thank you so much for joining us and for sharing your story. And we'll be eager to hear how everything goes for you with your new education. But thanks for joining us on our platform today. And Andy Serwer, have a great evening.
Thank you.
All right, and coming up here on the final round, we'll have your winners and losers in today's market. But first, take a look at where the big retail names ended during Monday's trading session. All right, let's take a look at some of today's winners and losers in the stock market. Stocks finishing in the red include International Flavors and Fragrances, on news that the company will be combined with DuPont's nutrition business in a deal struck over the weekend that gives DuPont shareholders a 55.4% ownership of the combined company. PG&E shares also lower after the bankruptcy reorg plan that was rejected, or that the company had proposed, was rejected by California Governor Gavin Newsom, who says the proposal does not comply with newly enacted state wildfire legislation.
Now for some stocks in the green today. Uber, on news that the ride-hailing giant is in talks to sell its food delivery business in India to a local rival. And British American Tobacco shares popping after the tobacco producer received a double upgrade to buy from Underperform at Bank of America Securities.
All right, coming up here on the final round, Bank of America Private Bank's top strategist gives us the firm's 2020 outlook, why they are bullish heading into the new year and the new decade. We're back after this. All right, a stellar year for investors is wrapping up. So what does 2020 have in store? Niladri Mukherjee is the head of CIO Portfolio Strategy at Bank of America Private Bank, and he joined us earlier to discuss.
It really is. Our broad message is that we are beginning to see a cyclical uptrend in the global economy. And you mentioned manufacturing, which could be a really big swing factor for the global economy in 2020. When I look at manufacturing all over the world, we were in a recession for a few months, but now we're beginning to see signs of stabilization, even improvement. I look at factory PMIs in Europe and Japan, that's doing better off the low basis. I look at the market PMI here in the US, which is above the level of 50. Chinese manufacturing PMI is above 50 as well, or nearly in that range. So manufacturing could be doing well, but the core of the global economy still remains the US consumer, which thankfully is in very solid shape.
Can I ask you, Niladri, about this whole idea that we almost went to a recession in the summer and then we're clearly past that? What the heck was that?
Yeah.
I mean, like, why were we almost in a recession in the summer and we're clearly not in one now and everything's fine?
You know, the big factor behind that is what the Fed did and what global central banks did. So you had the yield curves, which were inverted. Some of them were inverted. Some of them are really, really flat. That led to that whole recessionary fear. And obviously, manufacturing was in a recession. This is the third time in this long cycle that manufacturing has fallen into a recession. This time around, if the Fed hadn't engineered 3 interest rate cuts, 75 basis points in total, they fixed the yield curve, they supported cyclical sectors like consumer as well as housing, and that set up the stage for a global reflation that we're beginning to enjoy now.
See, I was wrong. We did need the rate cuts.
Oh.
The whole thing. Remember that?
Yeah, what if we'd listened to you?
I know, right. Good thing all around.
We are at records here in U.S. equities, but also globally. We haven't been this high since January of 2018. A lot of notes have been coming out recently looking to 2020, and we're starting to get this narrative of this, everything's rising together again. So when people are looking in terms of their asset allocation, is it still, the U.S. is going to be the best place to go, or you're going to get outsized gains if you can go outside the U.S.? What are you thinking between those two choices?
It's a great question. For the last couple of years, and nearly for the entire cycle so far, we have been more optimistic on the U.S. on a relative basis compared to international. U.S., I think, is still going to be the highest quality equity market in the world, bar none. But when I look at opportunities outside the US, the valuations are much more attractive. And this is one of the reasons we have told our clients to stay in international equities as a part of their strategic long-term plan. So when you look at valuations, look at the MSCI ACWI ex-US, it's trading at about 14 times. You look at US, it's 18 times. So there's a bit of a gap which can close, but valuations are rarely just by themselves enough to drive near-term performance. There are catalysts that are available that can lead international equities higher. Number one, if manufacturing improves, that will help international equities more. Number two, if the dollar stabilizes and actually declines from these levels, that leads to more risk-taking and higher beta international equities. And finally, positioning is still light in international equities, so there's scope for some of that to close as well. So keep the focus on the US, but have international equities in the portfolios.
And you know, this makes me think not just to 2020, but the next decade. We saw a number of outlooks for the whole decade, and I don't know if you guys have one for the 10 years, but it seems that everyone is assuming it will just be lower returns, right? Oh, it just can't be this good again. And I'm not exactly sure if that conventional wisdom is necessarily bolstered by a view that's anything other than, well, we just had a good 10 years.
Revert to the mean
right.
kind of stuff.
Are stocks mean reverting, and should we just be assuming that we're going to get sub-traditional returns over the next decade?
I think there's some truth to that. If you look at a typical portfolio, right? If you take it a 60-40 diversified portfolio, 2018 was the terrible year for that kind of a portfolio. Stocks were down, bonds were down, mostly because of what happened in Q4. When you look at 2019, stocks are higher, bonds are higher as well. If you look at over the next 10 years, there's a lot of forces at play. One thing we know for sure is that demographics aging, the effect of technology and the Amazon effect, all of that is going to create growth headwinds. So you're looking at a long-term environment where growth is going to be remaining at trend, maybe slightly above, but at trend, inflation remaining at low levels. That sets you up for a portfolio where bonds have subpar returns, perhaps even negative returns over the very long term, but equities also provide you not the similar kind of returns that they have over the last 100 years. If you look at since 1926, equities on average have returned you about 9.5%. Since the financial crisis, we've had double-digit returns on an annualized basis. So some amount of reversion to the mean, and the starting valuations for both equities and bonds are not that cheap as it was in 2010. So frankly speaking, you're looking at a diversified portfolio over the next 10 years, perhaps providing, I would say, moderate returns, but not mediocre returns.
Let's take a look right now at where the markets finished. Records, not as high as we had been throughout the session, and not as high as we could be without what really is a story of the day, besides the records and a Phase 1 trade deal, is Boeing.
Yeah, and news after the bell that the company will halt production of the 737 MAX in January. That's according to Dow Jones. Of course, last night, the Wall Street Journal breaking that story that this was on the table, and it appears the Journal coming back with the confirm on that. We'll see if Boeing says anything in the morning on that. Down 1% in the after-hours session.
That's all for now from New York. I'm Jen Rogers with Miles Edlin, and this is the final round on Yahoo Finance.